Hello traders, Joel Parker here, founder of the priceactionroom.com. I am putting a brief forward here to this video that you're about ready to watch, and I wanted to just give a brief word of explanation about what we did here, what occurred November 1st through the 12th, 2010. We put together a group. It ended up being 24 traders who have struggled in some cases for years, traders who have never taken a trade yet. We actually had one local, someone who'd been a local in the pits going back nearly 30 years, who's trying to transition to the screen. And we came together with one goal in mind as a student, and that was to learn how to read tape. I had goals as well as an educator, as a trader, as someone who was trying to help these individuals, and my goal was to see them succeed in becoming a discretionary trader, someone who thinks for themselves, someone who can sit down and understand the market they're trading and can understand the games that are going on and can see through those games, can take advantage of those games. And that was something that ultimately changed the format that this workshop was originated with. Originally, I intended this to be directly 100% related to tape reading. And as we put this together, it ended up evolving into essentially a mini mentorship. We touch on money management. We touch on the fear and the emotion that we feel as a trader. We obviously talk about reading tape, how to read the tape, where it's best suited, what type of things we should be looking for. We ended up discussing the high frequency traders, the HFTs, how they're impacting us and how that could potentially impact our strategies. Many things that we ended up going with beyond just simple tape reading. But as we worked together over the course of the 2 weeks, I think all of us came away with the same conclusion, even though we never met in person. I think we felt like we came away knowing each other to a degree, come away feeling like we've got new friends, new acquaintances around the world. And so as you watch this, I hope you realize that this was put together and unfolded live. It was not scripted. It was driven in part by the questions and the comments of the ones who attended. And it evolved into something far beyond what I originally intended it to be, or the way that I originally conceived this. So I hope that you find it valuable. I hope you forgive that I'm not a paid actor. I'm not one who is particularly eloquent. I stumble around for words like anybody else probably would when you're working without notes and you're trying not to read something, but you're trying to teach it from your heart, trying to help people understand something that you've made your life's work and passion. And so please, as you go forward, I hope you find it useful. I hope that it affects your trading. There are many subtle nuances in this video, many subtle things that we talked about that would be easy to skip over. But to me, when I go back and I've looked at this and I've edited this together, all of it is valuable. All of it is beneficial for the majority of traders. I do ask a couple things of you as we get into this. This is a copyrighted work, and I do ask that you do not pass this work around. Please respect the work and effort that I put into this, and don't pass this around and give this away to other individuals. This was designed for a specific group of people, and if someone is interested in purchasing that, they can contact me for information on that. But I do ask that you respect the fact that it's copyrighted and keep this work for yourself. For those of you that attended, I thank you. I appreciate what we went through together, and I look forward to hearing feedback from you in the future as to how things have gone and how it's working out for you. And just a couple quick notes as you go through these lessons. When you come to the final tape, which will have our 10th and final session on it, that session will also have live trades, as do a couple of the other days. There are some live trades in there. It is indexed. It is in your table of contents. And those live trades will illustrate very well the concepts that we're talking about and allow you to see that on a real time in sales, on a real dome with real trades analyzed in real time. And is something that you can rewind, you can rewatch, you can go back through that if you have to, and definitely will be very beneficial going forward. So without further ado, I'm going to stop talking here. In the forward, I'll let the video go ahead and begin, and I certainly ask that if you've got questions when it's all said and done, please contact me with those questions. I'm happy to try to give you an answer and make it something that's useful to you. Well, good morning, everyone. Welcome to our November 1st through the 12th tape reading mini mentorship. I am going to be covering a number of topics in this, and although I called it a workshop earlier in the advertising and promotional materials, I have decided to go ahead and make this a mini mentorship of sorts just because I wanted to get this all on record and all recorded here on tape. And so we're going to be going through some facets of your trading that will not necessarily be confined just to tape reading, but we're going to go through some things that will be beneficial in other aspects of your trading. But I want to thank you first of all for deciding to attend, and I hope that something that we can make very beneficial for you and that you feel it was well worth the money that you spent on this. We appreciate that money doesn't come easy, and you guys are making an investment here in your future, and you're hoping to learn something that will be able to pay off over the long run. And so I want to thank you for that and hope that I can give you enough that you feel like you got more than you paid for. To begin, we're going to come in with our required disclaimer. Government requires this to be here. And I have to say, even if they didn't, I would put the disclaimer up anyways. It is a very dangerous business, and it doesn't matter whether you're trading futures, forex, options, equities. There are large rewards there if you're successful, but there are also many potential risks. And so for anyone that's going to look at this mentorship or going to think about trading, I have to say, do not trade with money unless you can afford to lose it. This is not a game for people who are tight on funds. This is not a game for people who are gambling with next month's rent money. This needs to be risk capital because it is likely that you will lose. And I don't want to say that, from the standpoint of discouraging people, but I do say that looking at statistics. I've talked with brokers, one broker that specialized in very experienced traders, very large traders. He had 13% of his traders were break even or better. I've talked with other brokers that were running less than 5% break even or better. And so we have to say the odds are stacked against us when it comes to success. Now you'll see in the second paragraph here a warning about hypothetical trades. I'm not a hypothetical trader. I've never been able to make money with hypothetical or sim trades. And yet we are going to talk hypothetically about some trades throughout the course of this workshop. So that disclaimer does apply to a degree. We're going to be talking about things that we see on the tape, things that we could do on the tape. We may or may not do it with a live account. If we have time towards the last couple of sessions, our goal is to do some live trading. But because we're going to be talking about trades that have occurred in the past, and we're going to be talking about ways of managing trades, some of that is hypothetical because you could have done this or you could have done that or you could have done many things, and it's not necessarily what we did at that particular time. But just keep that in mind as we go forward. And then bear in mind the final paragraph, we are not saying you will become as profitable as I am. We're not saying that you will become profitable at all. This is something that really you need to decide for yourself what's going to happen in your trading career. You need to view it as your own responsibility and think these things through. And then, of course, you bear that responsibility for your own decisions going forward. We're going to cover each day some topics for the day, and then we'll get into the presentation. But here's going to be kind of our course of business for today. First of all, there's a little bit of necessary business being the first day of the workshop, and we're going to take care of that material. I'm going to go through the goals that I have for this event, and hopefully it coincides with your goals. And then we're going to spend a bit of time looking at high frequency traders and the impact that they have on us and the impact that they have on the market and the way that we're going to have to compete against them. We'll spend a bit of time for platform setup, and then when we're through going through platform setup, we're going to talk about bots for a few minutes, and then we'll have some questions and answers that will be addressed there. But let's get right into this, into our necessary business for today. I have offered each of the attendees
the opportunity to submit their own trades. And some of you have already done that, and I appreciate that. And this is something we've offered because we want to be able to help you with your own setup. Now, I would liken this to going to a golf coach. If you go into a swing coach and you tell him that you want to play better golf, and he starts telling you that you need to swing more like Tiger Woods, Tiger does this, Tiger does that, well, it's probably not a teacher that's going to work out very well for you. And I would say probably the best thing to do is find a new teacher. The reason that I say that is, we're not built like Tiger and we're not flexible like Tiger and we can't do what he does. And if they try to force us into that mold, it's not likely to work. Well, the same thing happens with trading. You shouldn't be me or Ken or anybody else. Really, you should be your own unique trader. And so when you look at your existing setup, perhaps you've been experimenting with things for some time. You're trying to find the missing piece of the puzzle that will make it all work. And I don't ever want to tell a guy, throw everything you do in the trash and start from scratch because you have to be just like me. So we're going to take your own setups if you're willing to submit them. We would like to have a chart markup showing roughly the chart pattern that you're looking for. Let us know on your trade setup. Is it a continuation trade, a breakout trade, a reversal trade? Are you looking at fib pullbacks? You're a trend trader. Exactly what are you going after when you take a trade? If you use indicators, we're not going to get a whole lot into how you use your indicators to confirm things. Some of you may submit things that are full of indicators, or maybe 6 or 8 indicators, and others don't use any at all. But bottom line, what we're going to try to do is comment on how you can use the tape and or the dome and improve your own trade setups. So before we do this for anyone, we are going to ask each person who submits trades to sign a brief disclaimer and a release. And the reason we're doing this, if I say this is how I would approach it, you may go in, analyze it completely differently and lose money. You may go in and analyze it just like me and lose money. And bottom line, I don't want to be responsible for those trades. I can tell you honestly how I would handle it if I was trading that setup. I would tell you exactly what I would be looking for on the tape. But bottom line, it's still up to you to do that analysis. And therefore, the liability is with you for your own decisions. The release is just because we're putting this out here. We are recording the presentation, and the recording is going to be distributed after the fact. We just want to make sure that we have your permission to put your name up there. And we won't put your full name. We won't use last names here. But we will mention your trade setup and allow you to kind of explain what you're doing with it. Now, the questions, the protocol for questions. I'm going to give everyone the opportunity several times each session to ask questions. And if you have questions, you can put them out there in the text. I may not address them right at that moment. I will address them, but if it's going to disrupt the presentation, or if I'm going to cover it in a couple of minutes, then I'll just ignore it for the time being. I will eventually get to it. But you may also choose to jot down your questions. With the benefits of hindsight with this platform, no one else will be able to see what you post. And so when you put that question out there, no one will see it except me. And I can respond to that when the time is appropriate so that we don't disrupt things. But you might also keep that in mind that you won't be able to make comments back and forth to each other. If there is something pertinent back and forth, I'll be happy to relay that. But you will not be able to, unfortunately, you will not be able to see the comments of others. It's just the presentation platform that we're using, one of the limitations that's there. Here's what I look at when when I think about the goals of the event. First of all, I want to teach every one of you how to read tape. When I refer to tape throughout the course of this presentation, I am referring to specifically the time and sales window, and I'm going to show you how to set it up. I'm going to show you how I read it, how I use it, and it's my goal to make you acquainted with it to the degree that you can do the same thing. But that being said, some people never get really comfortable with the flow of numbers coming down the screen on a time and sales window. And so I want to also show how to correlate that back to your existing charts, or perhaps some new charts for you. I want to show you how to correlate that with what we see on the dome. Now, dome, your depth of market, most of you as futures traders will recognize that as your entry tool. You can see the order book or the depth of market there. You see the price. You can see the offers and bids that are there. And some of that information is very valuable because it's a lie. and we can use the tape to prove it's a lie. And if that's the case, then we have a trade. Sometimes that information that's there is real, it's true, and the time and sales will prove that it's true. And if that's the case, we still may have a trade. But bottom line, we're going to show how to use these two things together. Now, when I talk about the proxies, that I want to teach some proxies, here's what I'm referring to. Again, because some people can't get the feel of the tape, the time and sales, I will show you ways to use an indicator to get a very close approximation of that. I think it's still faster, it's still more desirable to learn it from the tape, but if you can't, you can't. And so I want to show you some alternative ways of going about it. When I think of other goals, I want you to learn not only how to use the tape, but where to use the tape. So we're going to look a little bit at support and resistance, at market profile, at some chart patterns. We're going to talk a little bit about price action trading, and even though I hate to say this, we're going to look a little bit at indicators. And I'm going to show individuals how they can take that existing information that they have, or perhaps even things that I will show you, and use that as an area where you want to start using the tape to get a trade. Now, because I decided to expand this a little bit beyond just a tape reading workshop, we are going to talk about emotions, coping with fear, doubt, greed, and another thing that I think is perhaps one of the most destructive things traders can do, which is sim trading. Sim trading is beneficial if you're trying to learn a new platform, but beyond that, it is one of the most destructive things that you can get involved with. And so I want to show you how you can eliminate that within 48 hours. And we'll see if you agree that that sounds like a nice idea when we get there to that portion of our presentation. Our trade management, we're going to discuss to a degree. We're not going completely in depth, but I'm going to show, based on special request, I'm going to show what I do when it comes to position sizing, to setting stops, choosing targets, why I decide to scale, and while you may decide not to scale in and out. And then we're going to talk a bit about risk management as well. I want all of this to be information that's beneficial to you. We're going to talk a bit about trading plans. And when we talk about trading plans, some of that are basic things. You know, you have to choose an instrument to trade, a market that feels comfortable to you. But I'm going to put more focus on having a specific action plan that you're focused on when you sit down in the morning. If you don't have that type of an action plan, it's not likely that you're going to have any idea what to do, and you're going to sit there. Eventually, you'll probably fall prey to chasing momentum, or you're going to go to sleep and take a nap for an hour. So we're going to go through kind of a good way to build your plan for the day in a beneficial way, which helps you to focus on something very specific to do in the market. Now, this aspect of our event will vary, and it's going to depend on time, how many different trades are presented and how many questions are asked. But I would like to take at least one or two of the sessions and do some live trading. When we're doing the live trading, we're going to try to spot the high frequency traders. We're going to try to analyze the reactions that occur, figure out what might be a suitable reaction to what we see. We're going to spend a little bit of time allowing you to look for your setups. If you see one of your setups, we're going to invite you to comment on it, and then we can talk about the tape at that point in time and the price action that's there. And then if things work out suitable, I will do a little bit of trading on the YM, which is the mini Dow, and I'll do that without charts to kind of demonstrate to you guys how it's possible to come in and trade with no charts, just off of the time and sales alone. But here's my goal overall for the event, bottom line. I want to show you how to eliminate a losing trade or two out of every 10, and in doing so, want to help you make money. Bottom line, that's the goal. So if it means that you disregard all of this and you stay with an indicator, and I show you how to use an indicator that will give you kind of a proxy for tape, then good for you. You know, we don't really care whether you're using an indicator or not. Don't really care whether you're a price action trader or a tape reader. Bottom line, we just want you to be successful at it. And so we're going to give a number of options through the course of this, hopefully to help you reach that goal. Now we're going to need a couple of things from you. And here's what we're going to ask. First of all, you probably should have some type of charting platform. Most of you probably already do, but there are a couple of you who are newer to trading and you may not have a suitable platform for our purposes. I would recommend NinjaTrader. You can get a demo from NinjaTrader, and if you would like to contact me, send me an email. If you need access to a time and sales in a dome, I will get you the name of a broker who can help you out very quickly with that. Dorman Trading has been a very reputable firm over the years. Many of the largest traders in the country clear their firms through or clear their trades through Dorman, and they do have a brokerage where you and I can open accounts. They will be happy to get you a demo of the NinjaTrader platform. You may also wish to have a notepad just to take down some key points and jot down any questions that you have, and that will be beneficial over the long run as we get going further into the presentation. Our next topic, HFTs. Some of you know what that is, some of you don't. That is my short-term abbreviation there for high frequency traders. And the high frequency traders, we are going to talk about the impact that they have had on the market. And the reason that we're going to start our presentation here is that I'm trying to build a foundation that we're going to build upon over the next 2 weeks. And when I come down and distill everything down to basics, right now, the HFTs are the ones that are tearing most traders up. We're going to examine why that's the case by looking at some of these traders. But we can say this, because of the high frequency traders, we can see the impact that they've had. We do know that the buy side of the market is typically gone. And by the buy side, that's kind of insider talk, I guess, and I better describe what I'm referring to. When we start talking about funds and EFTs and so on that are only long, they can only be long or they'll be flat. That's referred to as the buy side. So we might have, like a grain fund, and they can either own grain or they can close their position. They can't go short. Mutual fund may only buy stocks or sell them and go flat. They will never go short these stocks. That side of the market has essentially, over the last 12 months, been completely destroyed by high frequency traders. Now, anybody that's been around for a few years knows that the buy side of the market was something you never mess with. All of our lives, the buy side has been the dominant force on Wall Street. And now they're in trouble. They're sitting in cash trying to figure out what the heck just happened. We look at the pits. There's a little bit of activity in the S&P pit. There's a little bit of activity in cattle and hogs. But essentially, the trading pit, open outcry, is dead. If you look at the daily volume reports from the CME, all of the pits at the CME group combined on an average day now is doing about 5,000 lots. That's all of the pits combined. That was one trade, one trader 10 years ago in the currency futures. That was a position, 5,000 lots. That was his position for the day. Now that is the total volume for the entire open outcry system. We compare that just to a small electronic instrument. Take the YM, the mini Dow. 100, 125,000, 150,000 contracts is nothing abnormal. We look at the S&P, the E-mini electronic contract, a couple million contracts a day. That's nothing unusual. We see high volume days, 3.5, 4 million. So a couple million a day is nothing. Only 5,000 going through the pits. If that was all S&P, you've got the S&P futures pit. 5,000 contracts there equates to 25,000 E-minis. That's how little volume there is left in the pit. And a lot of this is because of the high frequency traders. So we have to ask this about the HFTs. Who are they? What do they do? What type of impact will they have on us in our trading? And how can we compete against them? Let's get started by looking first of all at who they are. The two monsters in this business, Getco and TradeBot. Getco and TradeBot uh, trade on average greater than 1.25 billion shares. And this isn't per month, this isn't per week, this is per day. Each. 1.25 billion shares each per day. It's not abnormal for them to hit 2.5 billion shares on a busy day, a piece. These guys are going to be invisible to us as traders. We won't know that they're on the other side of it, but they are there and they are very active. We look at some of these firms you've probably heard of. Knight has been a market maker for many years. Citadel, UBS. Renaissance is a new emerging very large fund. Goldman, they've been around forever. Morgan Stanley. There's, in addition to these here, 15 others. And again, this volume is per day, per company, between 400 million and 1 billion shares. These firms here, they are averaging 800 million shares a day. And you think about that. Out of all these companies, 28 of them, there, I had to count them up, 28 of them, and their average is 800 million shares a day. Are they having an impact on us? Absolutely. Some of the new firms that you might have heard of in the news lately: TradeWorks, IBC, Sigma, Two Sigma, Jane Street. 47 other firms in addition to these four that are averaging between 50 million and 200 million shares a day a piece. Their average is 80 million, by the way. So when we look at this, we are talking literally about many, many billions of shares traded every day by this handful of companies, this handful of hedge funds and firms. And uh, as we look at what they've done and the amount of volume that they've put on, we come to some shocking numbers. When you look at the equities markets, from the past year, that has jumped up incredibly large, to the point where now over 70% of the daily volume going through equities is by these roughly 100 firms. 70% of the volume. We look at the futures market. Some of them are up into the 70% range, 80% range, 80% of the daily volume by the HFTs. So we have to stop then and ask the question, what are they doing exactly? What are their strategies? And then we need to look at ourselves. Do we need to change what we're doing to stay out of their way or stay on their side? So we're going to break these firms down, and we're going to refer to these firms as quants, and we're going to talk about 4 different types of quant firms. Now, quants, what we're referring to when we nickname these firms quants, are they're quantitative mathematicians. It's based on math. They have come in and developed algorithms to trade for them. These are not firms that go in and manually hit the buy and sell button by themselves. It is based absolutely on math, and it is executed through what we would call a bot or a trading robot. Essentially, that would be an electronic program which was written to enter orders, and it will enter trades, manage trades, and exit trades without human intervention. So when we look at these quant firms, we have some of them that are ultra high frequency. Their holding period is less than 2 minutes. And here's what they do for strategies. Index ARB. We think about index ARB, and many of you are familiar with this under a different definition. For many years, we've heard of program trading, and we know that there are buy and sell programs that will go off. It was kind of the forerunner of these quant firms. But index arbitrage works like this. Their computers are monitoring an index. It may be the Dow, it may be the S&P 500, it may be the Russell. But they are monitoring the index futures contract, and they are monitoring the cash. In other words, they're monitoring these stocks, the 500 stocks that make up the S&P 500, or they're monitoring the 30 stocks that make up the Dow. And when the mathematical price starts to vary, that creates what they call a premium. And if the premium widens to a certain point, that will fire off programs which will sell one or the other and buy the opposite, and it will arbitrage or push together these two instruments back to where they should be mathematically. Now, for years, we've been able to track this behavior, and bottom line, it doesn't much affect the market. Let me explain, please, what I mean. When we go back and look at a site, there's a website, indexarb.com. And on that site, they will show you the premium threshold each day where buy and sell programs will kick off. So if you have this available on your charting platform, you can track the S&P premium, and you track that premium, and then you open up a little chart of the tick and a little chart of the ticky. You watch the tick and the ticky, and you will notice that when the premium moves to the threshold, almost instantly you will have all 500 companies ticking up or ticking down simultaneously. At the same time, the futures will go the other direction, and it immediately pushes them back into line where they should be and then exits the trade. So we look at that. That's been going on for years, and I would say probably 90 plus times out of 100 program trades don't have an impact that lasts beyond 20 or 30 seconds in the market. It is very quick, pushes it right back together, and they're gone and disappear. Rebate capture. Some of you may be familiar with this, some of you probably have never heard of it. But when you look at the rebate capture, this is something especially in the equities. ECNs, which are the electronic communication networks, the little engines that power or facilitate the communication that allow trades to take place, or the exchanges, they will pay a rebate or a refund to people who provide liquidity to the market. Different way of saying that is that if you place a limit order to buy, you're providing liquidity because it's a limit order that's there waiting to be filled. Someone who places a market order, they're taking liquidity because they're taking some of the orders that was there waiting, and they're removing that from the market. So these ECNs and the exchanges started penalizing the person who took liquidity, the market order, and they gave that quarter of a cent per share to the guy who was providing liquidity. Well, these quant firms started looking at it and said, if we could front run the buy side algorithm order entry bots, we could get the fill before them, and then we could turn around and offer it back out to them, and we could capture that quarter cent rebate on each side of the trade. And so even if we sold and bought at the same exact price, or bought and sold, depending on whether they were shorting or going long, they could do it at the same exact price and create half a cent of profit. Now, when you look at what it actually costs these firms to execute, it is typically less than 20 cents per thousand shares. And the big firms, their cost is down around 2 or 3 cents per thousand shares. So if they can get half a cent per share, then they can go execute, and it only costs them 2 or 3 or 4 cents for 1,000 shares. It's free money, and the price doesn't have to move to do it. Tremendous amount of rebate trading going on in the equities world. Order flow trading. These would be programs that analyze the incoming order flow, and it takes a position based on that order flow. They may have programmed this to try to catch people in losing positions and run over their stops, or they might have capitalized on this and said, we're going to go with the market and run with it. But the order flow trading, again, these are very short-term, very small impact on us when it comes to executing as futures traders. Now, the high frequency quants, their holding period less than 2 hours, so they're still day traders. Strategies they're using, they call it mean revision. I've always called it reversion to the mean, but they actually technically call this mean revision. This would be taking a look at the market and saying the market has been moving this direction for this long. And a simple way of looking at that, let's just imagine a 5-minute chart with a 20-period moving average. Price moves up away from that moving average, gets far enough away. Someone says, this is going to revert back to that moving average. So let's short it, and it'll sink back down. Well, that's what they're doing, and their holding period is roughly 2 hours. We're going to talk more about them over the next couple of days. They also are using pattern recognition algorithms where they are trying to recognize specific candlestick patterns, and they will at that point initiate trades anticipating a maximum 2 hour holding period. And they also are trading on the basis of momentum. They see the upside moves, it's breaking, uh, steady order flow coming in. They may jump on board with that and run with it. The medium frequency quants trading period less than 2 days. Their primary strategies info trading. Now, when we think of info trading, we're talking about institutions that may have a good grasp of what the news release is going to say tomorrow morning. They're going to position themselves today and they're going to sell out when the news is released. It's not necessarily that they're taking this information unethically. They could be accumulating their own statistics and figures, and they have their own information that makes them feel they have a good understanding of where the official release is, and they might trade on that basis. Factor models. This is math so complicated, most people that are involved could not explain to you what they're doing because they can't speak English. Um, and I don't say that from a standpoint of being racist. I'm talking they understand numbers and they talk on such a high level. If you gave the guy a buck, he couldn't go buy a candy bar, but he could tell you exactly what all of these numbers indicate with where the market should be. Stat arb, or statistical arbitrage. This is something that we see primarily in equities. And stat arb, let's look at it this way. Let's say that we have two stocks. These stocks are somewhat related. They might be correlated. They might be negatively correlated or anti-correlated. They know that one of them goes up, the other goes down. They know that if they move apart, they'll move back together, whatever the case may be. They may buy one and sell the other. In a sense, it's like spreading, like imagine a calendar spread on a futures contract where we buy the front month and sell the far month, or vice versa. Well, they're doing this basically on a basket of stocks on a computer model, and they watch these correlations very carefully to make sure their beta stays flat. And they're going to come in and arbitrage anytime these stock prices differ from their model. Again, not so much guys that have an impact on us. The low frequency quants, holding period less than 2 weeks, their strategies primarily fundamentals, and they are also involved in stat arb. So we have to say those guys are not going to be as much of an impact on us as futures traders. If you're trading equities, perhaps they will. But let's go back. We're going to take a look at this and just review it again. We take the holding period less than 2 minutes. The index arb, that is primarily equities and futures. They're going to buy one and sell the other, and then they're going to disappear, and that'll happen several times a day. Doesn't really have a big impact. We don't have to worry too much about that. The rebate capture, that is primarily in the equities. At this point, the exchange that we trade futures on, primarily the CME group, they limit the rebate to $15,000 per month per member. So it's not lucrative. We're talking firms that are pulling out tens of millions of dollars a month, 50s of millions of dollars a month. They're not interested in $15,000 of rebate capture from a futures exchange. However, if you're an equities trader, you've probably noticed that it can be tough to even get filled because they are running so hard in there. The order flow trading, you see these guys across futures, forex, and equities. In the old days, this used to be a large private trader or a large private fund manager, and he would come in manually and bully things around for a couple minutes, take advantage of some stops and disappear. He was looking for areas where he could trap people. Well, that's primarily gone electronic now. And it's, again, very short period, and it is a factor that we will have to deal with in our trading. The high frequency, shorter than 2 hours, the mean revision, that's happening across futures, forex, and equities, and the same with pattern recognition. That will be a factor in our daily trading. And we definitely want to give some attention to this over the next few days as we talk about the mean revision, because we can trade the same type of ways, very easy to do. And if we spot activity that would suggest they're getting ready to short it back to the mean, we would definitely want to be going along with them. And then the longer term guys, the medium and the low frequency 2 day to 2 week holding periods, The stat arb, as we mentioned, primarily in equities, the fundamentals, that goes across all markets, that they will trade that. These are the guys that are responsible for the grind that just goes and goes and goes and goes and goes, and it just doesn't quit all day long. When we see that, we can trade with them. They're not the kind of guys that usually run us over. They may catch us once in the morning, and when it keeps grinding, we may decide to go with it instead of fighting them. So we're not so much worried about them in our specific trading. But let's take a look at this question here. How do we compete? To answer that, really, some other questions we need to ask ourselves. What instruments are we trading? Are there HFTs active there? If so, what are they doing? What strategies are they playing? And then we need to figure out how to spot them if we can, so that we can compete against them. Now we're going to take a look at this graph here. And you want to notice on this graph that this is official data from the CME Group. This was given to me by a senior vice president at the CME Group. I was speaking with him recently, and he forwarded this along. The interesting thing that we're going to look at this point, we're going to come back to this in a few minutes, but the interesting thing that we want to look at for right now, let's take this column here, the percentage column, and in this percentage column, what we want to look at is the instruments that we may be trading. See, when we compare total volume to the bot volume or the HFT volume or the algo volume, as they tend to call it, we see as a percentage in some markets that the majority of the trades that are executed are traded electronically by HFTs. Now, the exchange started getting so concerned about the changes in the last year and a half, that they mandated that any uh, member coming in trading this electronically with an algorithm had to register as such, and they track their trades separately from the rest of the market. So we look at instruments that we may trade. If you trade ags, it's only a quarter of the trades. 1 out of 4 trades that are going to essentially, they're going to be executed by an order entry bot or robot of some sort. If we look at our equity index, this would be like the Dow, the S&P, the Nasdaq E-minis. Half of the trades that occur are executed by bots. Our metals, not so big, 26%. Energy, same way, a third of the trades. Foreign exchange getting up there, 67%. The bonds, notes, 43% of those trades are executed there. Now you see some markets where virtually nothing is. Euro dollar options, if you want to go trade that, good luck to you. I know nothing about it other than I don't want to be there. But they're not seeing much activity by the HFTs. Your 10-year notes, they broke a few of these out individually, 44%. Our Euro FX futures, 68%. We've got our E-mini S&P 500 right at 52% being executed electronically. And the crude, 34%, again, not a huge percentage of that. Corn, 27%. And then we've got our gold down here at 25%. Well, what does that say to you as a trader? If you look at your market and 2 out of 3 trades in your market is being executed by bots, you're going to have to be able to spot those bots. If you're running 15, 20%, 25%, where 1 out of 4 trades is a bot, you still want to be able to spot it, but you're not getting killed yet like they are in some of the other markets. If you're trading something where you feel this bot activity is destroying you and you can't get in sync with it, you probably would be better off going back to other things where they're not real active. The games that go on in corn and soybeans seem fairly simpleton compared to what's going on in some other markets. So that would be one way of competing against that, and you might want to keep that in mind just going forward. Overall, across the CME Group in its entirety, all of its volume, 25% of the volume in total, like on the metals, the total on the grains, 26%, they tend to be lower. The energies, they tend to be lower. And then we're going to see our equities, our indexes, those are going to be higher when it comes to the total percentage there. Now we're going to come back to this in a minute. But before we come back to this, we're going to go through some setup and some layout for our platforms. And I'm going to show you how I set up my NinjaTrader platform. And uh, the reason I'm going to do this as you watch over the next few days, I do it for a very specific reason, and you'll understand it and you'll be able to set up your platform to mirror the same thing. So I'm going to stop here for a moment and we'll get the platform. I'm going to get up a time and sales. We're going to go through and build a time and sales and a dome, and we're going to get them configured correctly so that you will be able to come in and uh, copy what I'm looking at and what I'm doing. So let's break for just a couple minutes while I get that ready. Okay, so welcome back, and I've got the time and sales here, and I've got a dome here, and the market is trading. It's kind of slow right now in the aftermarket, so we don't have much going through for prints. But I'm going to go through the setup on this because it is a pretty, I would say, pretty nasty looking time and sales, and it doesn't make a whole lot of sense to me the way that they configure this straight out of the box. So we're going to go through some configuration changes on this, and I'll just talk you through that. This is NinjaTrader version 7, and I have been on this since December of last year, December of 2009, and I am one of Ninja's partners, so I received this platform early. Other than one day trading on 6.5, I have placed every one of my trades on this platform. Close to 8,000 so far this year that I've traded here, to 8,000 round turns. And of those trades, like I said, I have basically been on this platform for all but 3 or 4 of them. The platform has given me no problems, no grief. Everything has functioned very, very well. And I have to say, I've been very pleased with it. Some tremendously advantageous changes versus the old program, the version 6.5. I will go through a couple of the changes if you're on 6.5, just things that you'll want to pay attention to, some slight differences. But let's get into this. We're going to right click and we're going to go to properties. And when we go to properties, we're going to come over here and adjust these properties so that we've got the best functioning time and sales that we can hope to get. I'm going to put the time and sales here on the side so we can see it. I guess I can't move the time and sales because I've got the properties window open. But first of all, adjusting the height. Now you can drag the height bigger, but it's still only going to print 20 rows. I look at this and say, well, it's only about half the height of the window, so I'm going to change that to 50, and I'll apply that. It's kind of see, I'm going to close this and see if it's tall enough. It's still not big enough to fill my screen. I can drag it down, but it won't print down in this bottom ½ inch or so. So I'm going to come back into properties. I still am going to change. Got to add a few more. We'll go to 55, give that a try. And the 55 looks like that's just perfect for this screen. And that's how you're going to change that so that it fits your monitor. Now, just a side note. I have found over the past few years, I used to trade on dual monitors. I only use one monitor now, and what I'm doing is a 32-inch. And I have thought seriously about going to a 37 or a 40-inch. The reason for that, when you go to a bigger monitor, you get a taller screen. When you get a taller screen, you can fit more rows. I can only fit 55 on this little monitor that I'm recording on, and yet on my 32-inch monitor, I can fit 103. It allows me to see double the amount of ticks or executions go by, and that can be very beneficial. I've got that sized to fit. I've got my size filter at 0 because I want to see every transaction that comes through. I could change my font size if I wanted, and I could make it smaller, what have you, whatever's comfortable to your eye. Display update interval. This is something that changed, and that is on version 6.5 called timer refresh. And on the timer refresh, you only have the option to select that as true or false. If you have timer refresh set to true, it's going to automatically time compress this, and it will push a snapshot through every quarter of a second, every 250 milliseconds, and that push will bring in every transaction that went off in that last quarter of a second. And so you end up with a very even tick, 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 and you can't sense the momentum and the changes in speed and the acceleration. It stays completely monotonous every quarter of a second refreshing. Sometimes it drops half a screen, sometimes it drops 3 or 4 screens. You have no idea, but it still comes in very regular. The equivalent setting here, this would be the 250 milliseconds. If I put this to a setting of 5, it would only refresh every 5 seconds. Well, I don't want that. I want this absolutely live, and so this to me has to be set at 0, because I don't want to have the interval between updates. I want every tick coming in as fast as my machine gets it. Where this will cause you trouble, if you're still on version 6.5, one time in sales running unfiltered, if you set timer refresh to false, one time in sales running that way can run 85 to 95% of your CPU. And you will find each morning in the first hour, if you're an S&P trader, you will probably lock up your DOM and your charts 15 to 20 times that first hour. So you have to just about use that if you're on version 6.5 in order to keep everything running smooth. But if you're on 6.5, you really owe it to yourself. Go back to Ninja, download version 7. They do have the RC version out now. So this is a final release version that's ready to go here. And I have many guys that have been trading with me that have been on version 7 for months. We have not had any significant problems to speak of, nothing that's affected a trade. There's a few custom indicators that they use that wouldn't display, but bottom line, nothing that affected a trade. So the other setting down here that we're going to look at real quickly, the block alert trade size. If I was trading on 6.5, I would set that to 1000. I don't want to see block alerts. And I'm going to just say okay. It's going to warn me that that could affect the performance if the market's moving fast. It doesn't affect the performance. I've been using it for a year. And the way that they allowed Ninja now to use hyper-threading technology, it can run on more than one core of your processor now, where version 6.5 could not. And that's kind of eliminated the bottleneck in the program. Now, I've got a question out here. Do you have to do anything specific about that in order to get that to function that way? And no, you do not have to do anything specific for that. The version 7, you go in and install it. It will allow you to keep 6.5 on your machine. It does not overwrite it. And you can just go right in, install version 7, and it automatically will function on multiple cores. The upgrade when you go from 6.5 to 7, just something to keep in mind, is that it will it will migrate in most of your information, but it will not like your version 6.5 charts. You have to rebuild your charts and your chart templates. But your DOM templates, your market analyzer templates, they will all work just fine. Nothing that you really have to worry about there. You'll just have to redo your chart templates. But anyhow, so we've got this built. I would just right click here for columns, and I will personally just turn off block because I don't want to see block trades. Now here's what I'm going to do next. I'm going to go back into properties, and as I get this window back in here, we're going to start setting these colors up. And the reason that I want to set the colors up a certain way is I want to be able to come in and see, and actually as I'm taping this right here, we see I'm going to hit Alt D, turn on my screen drawing and freeze this. You notice how these prints all appeared instantly, and the whole thing just dropped into view, and all of them had the same timestamp, 23 seconds. All of them were at the same price, various different sizes. We're going to talk about this. Maybe keep that in your mind as we go on to discuss things later. But we're going to talk about bots and the appearance of bots. And when bot orders fired in, that is typically what they would look like. Everything just drops into place all at the same timestamp. We're going to give you an explanation for what this was right here. Long story short, that was a large market order, and this was the executions that it broke off into. And I was able to just to freeze the time and sales with Camtasia by hitting my screen drawing. It allows me to come in and draw. That also freezes the screen. So I'm going to turn that off, and you'll see it go back to wherever it was now. But let's go back to where I was just getting ready to say. The reason that this is set up the way that it is on my machine is that I want to be able to see this with my peripheral vision, And I really cannot stand the way this breaks it up in multiple colors. I mean, we got pinks, blues, greens. If it continued, we'd have golds, we'd have deep pinks, we'd have reds, lime greens. It's just a mess. So here's what I'm going to do. I'm going to look for everything that's labeled as back color. And I'm going to turn everything that's labeled as back color, I'm going to turn that black. We've got at ask back color. And we'll build this and just show you as we go why this, for most people, will be a little easier to see. Below the bid back color. And then we've got between the back color. And then, let's see, I think that's it. We'll hit apply. And you'll notice as these prints start coming through, they're going to look a little bit different now. The color for the background, we're going to change that to black also. We just want all that to blend together. We don't want to see anything there. So we'll hit apply. Now we've got a black background. Now we've got to color our trades that come in. And here's what we're going to do. Here's the explanation for this. If you were trading equities, it is possible for a trade to be executed above the ask or the offer, and it's possible for a trade to be executed below the bid. And the reason for that is there are multiple venues. We do have what's called NBBO. That is the National Best Bidder Offer, and that's our inside price that's displayed. And by law, they're required to display that price within 500 milliseconds. They have to change that price and put that price out there. But if I was in a very, very great hurry to get something executed, I could choose to execute off against other market participants. I could go up and specifically hit Goldman or Instinet or Archipelago. I could go up and reach out and tap them or hit them for a trade above the NBBO. I could specifically direct that order into them. And if that's the case on an equity trade, then I would say yes, if you're trading equities, show that as a separate color. Because that would show a serious level of aggression if somebody felt like they had to get filled so much that they were willing to go beyond the NBBO to get filled. We want to know that. But for futures traders, there's no point. If you've got a tight spread, a spread of a quarter or one tick on the S&P, we know that that spread will always be that way unless nobody steps into the middle. Nobody's willing to step in with a limit order. And if that's the case, any execution that comes in at the market will just be executed off at the bid or ask. We don't have to worry about it getting filled out away from that. So above the ask, we have to say then, what does that represent? What does the ask represent when a trade goes off there? Well, I'm going to move this over for a minute and get rid of that. And we're going to talk about that for just a minute on our market depth or our order book here on our dome. This column here, this is the bid. This is where people buy, and they're advertising that they want to buy. And this is the sell column. This is what we would call the ask or the offer. This is people advertising that they want to sell at these prices. I've used an analogy before. I'm going to mention it again here. Imagine going into a marketplace, and you've got two booths set up next to each other, two stalls, and one stall is buying meat, and the other stall is selling meat. Those two individuals, if they were under the rules of the exchange, they could not do business with each other. They either have to buy it from you or they have to sell it to me, but they can't do business with each other. And that's the way this market is structured. So each of these guys, each of these meat stalls here, these markets, one of them has a sign out and he says, I'll pay $4 a pound if you bring me meat. And the other guy says, I'm willing to sell meat, but I'm willing to sell meat for $5 a pound. Well, they cannot turn to each other and do business. They just simply sit there and advertise and wait for somebody to come up and transact. Well, that is exactly what's happening right here. Each of these levels are people that are willing to buy. And each of these levels over here are levels where people are willing to sell. They cannot do business with each other unless they cancel this and go over there and directly hit this guy. So if that's the case, what does it imply if somebody was advertising that they were willing to buy 81.5 and we see a print come in and hit 81.5? That means somebody placed a sell market order, and since 81.5 was the bid, 81.5 was the print, right? That if we're going to track this under the old consistent rules of coloration, used to be green represented buy or long, red represented sell or short. You're seeing a lot of platforms go to red and blue because of some individuals who are colorblind and can't distinguish green and red. But age old, green meant buy, red meant sell. Well, some platforms come in and they say, well, if anything printed at the buy column price, at the 81.50 price, we're going to color that as a green because it printed in the buy column. If anything printed in the sell column price, 81.75 or higher, we're going to color that red on your time and sales. Well, that's actually not correct. And the reason for that is we're trying to track aggressors in the marketplace. So each of these guys here are trying to buy, and each of these guys are trying to sell, but they're very passive. They just hang a shingle out and say, I'm willing to sell 156 contracts at 82 even. These guys are saying total 34 will buy at 81.5. Well, if they're buyers, they will do nothing. They will not get filled unless an aggressor comes in at the market and hits them. So if that's the case, I look at that print and say, if it goes off at the bid, that required a market sell order. And if it goes off over here at the ask or at the offer, that meant it was a market buy order that caused that trade to execute. So when I come in here and I adjust my properties, I'm going to say this: if it went off above the ask, that meant somebody bought at the market. And if they bought at the market, and I'll try to find lime in here, I want that to be lime. If they go off at the ask instead of above the ask, I'm going to color it exactly the same because I know on this exchange that we're not going to go off above it. If they do, it's just a glitch. It's just an artifact where as the order flow came into your platform, your bid moved before the time and sales printed. So I'm going to color those the same. That means anything that hit the sell column as a market order is going to come in green. I see a green print. I know that was a market sell order. Excuse me, a market buy order. I'm going to come down here to anything that's below the bid or at the bid, and I want the same thing. If it was at the bid, in other words, somebody came over and hit the buyer, that meant it was a market sell order, and therefore I want that to be red. So if I can come up here and find red, and below the bid, same thing, because it won't go below the bid unless I'm trading equities. We'll find red. And now I've eliminated all of these multiple colors and trying to figure out what they mean, and I've got it distilled down to the essential things. So let's take a look at this. We'll make sure we got our settings right. We've got our block alert color. We don't care because we've got block alerts turned off anyways. The only thing that's left that needs to be adjusted is the between for color. Now this would occur on a futures market only when there was a spread greater than one tick. Let's say that on our S&P that it was 81.25 by 81.75, and simultaneously a buyer and a seller both clicked into the 81.5. If that's the case, that print, you can't really say it was initiated by a buyer or a seller because they both came in identical same time. So if that's the case, I'm going to just print this off at white, and the only thing I'm going to take from that is that at that point, hey, be careful, you start seeing a bunch of white prints, there's a bit of a spread in there now. That's all I need to know. Once I have this built, I can come back in here and say, make this the default, set default, and then hit OK. And as our prints come in now, we're either going to see red prints, green prints, and we're going to see white prints if there's a spread. Now, one other thing, and you'll notice this feature in the properties, I'll just mention it here. I'm actually going to turn this lime as well since I changed my default, and I'll say set default. The daily high will be marked off in lime. The daily low will be marked off in red. That's where you see the whole background change color because we hit the high or the low. If we come in and get prints at the half, that's the low of the day. We're going to see those prints come in with a solid red bar across the back of them. So now at a glance or out of my peripheral vision, I can tell whether it's aggressive sell market orders coming in or buy market orders coming in. I don't have to sit there and think about what 5 different colors mean. Now let's get to our dome and our setup on our dome. Same thing, dome's too short. You can't grab it, can't stretch it, can't make it taller. So we have to come into properties. In the properties, we have to add some lines here. Let's take this up to 28. I'll just hit apply, see if that fills the screen. Good guess, we're set. Couple settings here in our dome that we want to be aware of. ATM strategy selection mode. You got 3 options. Display selected ATM strategy only, select active ATM strategy on order submission, and keep selected ATM strategy template on order submission. We want that middle option, select active ATM strategy on order submission. Over the course of the workshop, I'm going to show you on live trades why we want that to be our order submission method. So we'll take that center method, select it on order submission. I don't care to see the advanced options. It just gives me the option to reverse on stop or reverse on exit and on target. I'm not worried about those options. Auto center the price, I've got that set to true. The caption bar display defaults to account, and so it shows SIM 101 up at the top. I'm going to take that and change that to the symbol, and I prefer the symbol because I would rather see it say ES and know that I'm on the contract, and I can make sure that I've got the right contract on my charts and my dome. A couple other settings that I would tweak personally. The middle mouse button is stop market. I don't care about that so much. Last trade displayed in price column true. The parameter type, I want this the parameter type to be the price. You can change that to ticks if you want. Um, Profit and loss display unit, I prefer that to be on currency. Apply that if we have an open trade and there's a profit there, it'll show it as a profit. Cumulative depth, I want this set to true. And here's why. The cumulative depth, you'll notice that there's 5 columns here. That's all that Ninja displays of our book, even though 10 should be available. They only show 5. When I change this to true and hit apply, you'll notice that a 6th column comes in there, or a 6th row. That 6th number is the total of the other 5. And so at a glance, we can see whether it's building on the offer, building on the bid, building on the offer, kind of see what's going on there. The single click order modification, I set that to true. I want that because when I'm in a trade, I want to be able to come in and click right in the center column and move my stop or take profit orders to that price without trying to grab it and drag it. So that's my settings there for the bulk of the dome. A couple suggestions just for practical use for newer traders. By column color, I'm going to change that to green, and I'm just going to go like to a light green. And the sell column color, I'm going to change this to like a light red, and I'll hit apply. And the reason I do that is that just reminds me this is my buy column. If I click in that column to buy, I don't want to accidentally sell when I meant to buy. Green is buy, red is sell. So if I color code those, it just kind of keeps me straight. Now you'll notice there's other settings where you can change your ask price color and your bid price color if it suits you, your entry price color, the last trade color. I don't like this last trade color being bright yellow. I'd rather just see like a gray. Try silver. Yeah, that looks good enough for me. That way I don't have some wild color there that's distracting me. And then I'm going to look at the high. Let's see where that is. Somewhere in here. No, maybe it's further down here. Oh, here it is, daily high. I was looking for H and L. The daily high, I'm going to come over here, and again, I'm going to just grab a green. And for our daily low, I'm going to come over here and I'm going to grab a red. And what that's going to do is when we're at the daily low, we'll be able to see that and tell that that's where the day's low was. That will be visible right in our dome. So when we're coming down into that, we don't have to scramble back over there to look at the chart. It will just be visible that we're there at the low of day. So again, I can hit set default, hit OK, and then my dome is set. Everything's all ready to go. So if I was to come in final tweak on it, I would link these together. I would link that with a chart, get a chart that's the same color, and that way I'm tracking the S&P on each of these. So we can see the prints that came through in white, because we just made changes on this. From here on, everything that prints through should be normal. But that's our basic setup on this. Now, I've got a couple questions that I want to address. One of them, have you ever looked at whether the DOM is ever behind the time and sales? And I think we're referring to in this question, which one is given the priority in processing, which one updates faster. The time and sales updates faster than anything on your platform. It will update faster than your charts. It will update faster than your DOM. And so that's one of the reasons I like to use the time and sales. I would prefer to have those very quick, very fast updates. We look at our DOM, for example, on a busy market, and we've got the last order and the size here, but you may see 30, 40 orders print off here, and this just stays as a 1. It does not update very fast. Um, on the original tape reading video that I put out, when my platform would freeze up, you would see the tape would still keep streaming in, and the DOM would freeze. Even the book would stop updating. And you could look at the time and sales, and the time and sales may be 8, 9 ticks higher than what it showed on the DOM. And all of a sudden, when the CPU caught up, the DOM would jump up and pop up to 8350 and start printing there. The time and sales was always updating all the way along. So the charts will definitely lag. The DOM will definitely lag. They do not update as fast. It's not a defect in the system. They do put a little bit of a delay in there. Just something to kind of keep in mind is a good question. Let's see a couple other questions here. I think we've addressed the ones that I got so far. As far as the question regarding the version 6.5 to 7 upgrade, I touched on that. When you upgrade, it will migrate some of your data, but it will leave both platforms on your machine. You can run 6.5 or you can run 7. You can't run them both at the same time. When you install 7, it will migrate in some of your data, but the charts changed in structure so much that it's not going to want to bring in your it's not going to want to bring in your chart templates, and it's not going to want to bring in your existing chart information. Any workspaces that have a chart in it, everything will be there in the workspace except the chart. The chart won't show up. So just keep that in mind as you update. There will be some differences there. As you do that. If you're still using 6.5, you definitely owe it to yourself to upgrade. It is a considerably better platform. No comparison between the two. And I think as soon as you start using version 7, you'll understand why we say that. It may take you just a touch to get ready to do it. I've got another question here. Is there time while trading in real time to actually look at the DOM and the time and sales and the charts? And he says, my guess is that things are moving so fast, one would not have time to look at charts. Here's what I would say my take on that is. I look at charts as memory aids. I'm interested in price levels. I always have the charts, I always have the time and sales, always have the DOM there on any instrument that I'm trading. But I look at the chart and I pick a level where I'm interested in taking a position. And when it gets into that level, I'm going to then turn my attention to my time and sales and to my DOM. At that point, the number's in my memory. I don't have to sit there and stare at the chart tick by tick by tick. So I always have charts open, but I do not sit there and stare at them. I don't watch them form. I would be more likely to put a price alert on a certain level that I'm interested in. And when price reaches that level and the alert sounds off, then I'm going to come over and start paying attention to it. Otherwise, I'm not going to sit there and stare at it. It just isn't. It isn't worth it. And I've got a comment here from Karen, which echoes my feelings. I would rather have the alert and then turn my attention to time and sales, because you're going to get a headache trying to memorize everything all the time. You look at it when it's important and ignore it when it's not important. Another question here, is there time? Oh, we got that one. Let's see where'd the other one go. For NT65, should you have block alert at 1000 and timer refresh at true? The block alert, to me, it's a waste of space and I don't want to see that. So I set it high, and on version 7, I just turn it off. That allows me, I can come down and put a real narrow time and sales in here, and I can cozy that right up onto my dome. And actually, let me do something. I'm going to come in here to properties, and I'm going to hit set default and hit OK, and I'm going to bring in another time and sales, and we'll narrow this down, cozy this up on the other side. We'll get this over to this instrument, but we're going to come in this time on the properties, and we're going to put a size filter on this one, and we're going to just say 20 lots on the S&P. This, I can right click and say always on top, right click, always on top, and I can put this over the edges of my dome. I can get it up real close if I want to, and that way in my peripheral vision I can come in here, I can watch the dome, I can see the games that are being played on the dome, and out of the peripheral vision I can scan this and I can see the executions going by. One thing that you have to be careful of when you do this, let's just take a market order out here, and and we've got a market order, and we'll put our take profits down in here, and we've got our position right here. You notice that because I've got this overlapping the side of the dome, I can't see the X to close those orders. So if I was to come in and let's say that I was going to put a one lot order and I wanted to throw a one lot order out here, if I get too close, I can't see that to cancel that order. And if I hit close, that closes the whole position, and cancels the orders. So you have to be careful with that you get it spaced where you can still get to your X and cancel the order, and don't completely cover that material. There usually will be one, if they're on this column, you'll have that X over here, and I could cancel both of those orders if I wanted to with that X. So I want to have those visible. But I do like these as close as possible because I want to be able to stare at the numbers in the middle, catch this off of my peripheral vision. It's going to be a beneficial way of looking at things. Um, I've got a question on the 6E as far as filtering that. Do you filter that, to any specific setting? Um, we'll go through this a little more later, but I would say this just in short. When you look at any specific market or any given market, take your time in sales and just look at 100 prints, give or take. And if you look at 100 prints and you separate out the one or two largest prints that went through. So let's say that we're looking, you asked about the 6E. Let's say that we look at 100 prints and we have 1/6 lot. And we look at another 100 prints and we got an 8 lot. And we have another 100 prints and there's an 11 lot. And another 100 prints and the biggest one is a 4 lot. That says to me that that's probably not a contract that needs much filtering. By contrast, when you come into the S&P, I would set a filter at 20 nowadays. So look at the market you're trading, determine out of any given 100 trades what's big size and how many of them are there. And we want something that's going to be a little bit more significant. And if you come to the conclusion that you can't, double digits, there's no double digit prints, then you don't probably even want the filter. At that point, you're just going to let the row of prints catch your eye, and if there's double digits sticking out, you're going to see it. And you're going to say, "Yeah, there was one sizable order in there." But on the if I had to use a rule of thumb on other instruments, I would say probably 10. But you're going to find on the YM, there's not going to be many 10 lots. The DAX, there's not going to be many 10 lots. You get your thick instruments like the ES and the Eurostox 50 and the bond and notes and the German treasuries. 100 lots or dime a dozen in there. So you kind of vary it based on the instruments that you're looking at. And I would say, as a rule of thumb, the really thick instruments I would put at a 20, and then the everything else I would put at a 10 or smaller. And again, there's not much point in even filtering it out at some point. When you get your time and sales and your dome set up, you could go ahead and hit your um, we'll hit your let me just bring over my control center. And actually, I need to. Um, these are kind of in the way because it's always on top. But come in, get a workspace, save workspace as, save this new workspace for tape reading, and then that way, as we go through this over the next couple of weeks, you'll have a workspace set up that you can kind of mirror what I'm looking at. I want you guys to be able to look at the tape on your machines and not rely on it based on my machine. And the reason for that is that there's a latency there in the transmission of the platform in GoToWebinar, and that latency you'll be a couple seconds behind real time. So if you're able to watch it on yours, it will be smoother and you'll be able to get a better idea of what's going on. So save that workspace and then you'll have that ready to go when we come back in here. Let's see, I still have a sim position, and I'm going to just close that because I hate orders that get stuck in the machine, and then every time you go to close your platform, it tells you got orders sitting there in positions and so forth. So we'll be all done with that. Let's see, I'm going to take a brief break. We'll get rid of this. We'll get back to the presentation and we'll take a look at some questions. So any questions that are here, we'll go ahead and just address those questions as soon as we come back. But for now, let's do that. We'll just take that brief break and we'll get rid of this stuff here and we'll be back in 5 minutes. Okay, guys, welcome back. We're going to take back up with the final topic for today, and that is the topic of dealing with bots, bot or not. Just to define this, what a bot is. A bot, it would be just industry lingo across many areas, I guess. But industry lingo in trading, that would refer to a little program that is designed to execute orders or manage positions. Short for robot, and it's not a robot in the sense of what we'd think of a robot, but it is something that's designed to function like a robot. It would function without human intervention. It was programmed and designed for that purpose, and it could go in there and execute. Now, on the simple end of things, we could look at bots and say, well, this could be things like a black box trading system for Forex. So it's a program that looks at the data coming in, and as it watches this data flowing in, it would execute trades without your intervention. You don't have to be sitting there glued to the screen watching it. Well, that's a bot, if you will. But the bots that we're going to be referring to are considerably more complicated and incredibly powerful, and it is the tool of choice of the quant HFTs. So when we look at their bots, these are typically bots that are, it's designed around an algorithm. It looks at the information coming in, it makes all the decisions, and the humans just flip the switch, turn it on, and let it run. And unless the computer pops up and says, hey, there's a problem, it will just continue to run. So bots left a very distinctive footprint when they were executing. And so I asked this question: how would we have identified a bot order 1 year ago? That question would be easier to answer with a little time and sales. And we'll throw some time and sales up here and just look at it for a minute and try to understand what it is um, that we would be referring to as a bot. Remember, I talked about it a moment ago in the tape, and we see another situation here. And I'm just going to hit Alt D, do my screen drawing. That will allow me to come in and draw some here on this. We're going to get this flurry of orders right through here, and we can see that all of these orders came through at the same exact time. All of these orders came through except for the last two at 81.5, and there was varied size on those orders that came in. A bot footprint meant that we were actually able to see the bot even though it was trying to hide its true intention or its true size. So you imagine a trader, sophisticated trader, who's trading very large size, and maybe he's placing 500 lot market orders or 1,000 lot market orders or 200 lot market orders. And he had access to a bot that would allow him to click to buy 500 lots. And that little program, in the time that it takes us to release our mouse key, could actually send out 60 million individual orders. So instead of sending out one 500 lot buy at the market, he could break that up and say, send 500 orders to buy one lot each at the market. A guy says in his mind as a tape reader that one lots are insignificant and he filters them out and doesn't watch them. And he doesn't even see this 500 lot market order go through. If you were watching on your time and sales, though, what you would see was that all of these prints just instantly dropped into view, and frequently you would see your time and sales, half of your time and sales, or 3/4 of your time and sales would drop into view, and just instantly that whole thing would appear. Now we could contrast that, because normally you would go back and see your prints, and you would go tick, 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 and there was a little bit of space between the prints coming in. But a bot order a year ago, the whole screen just dropped into view all at the same timestamp, typically at the same price, and there were no buy orders in between. And so when we saw that, we said someone large is camouflaging their size. They're using a bot. Well, things have changed, and I'm going to get rid of this and get rid of this. Things have changed significantly because of changes that were made in the market. And so we're going to go back and identify that. It will affect us as a tape reader, and I will be the first to admit I was wrong in what I interpreted, and I'm going to explain why I interpreted it the way I did. I'm more than happy to tell people that I was wrong, and at the same time, ironically, I still made money with it because the understanding was wrong of what it was, but interpreting it as to what I should do, I was still right. But let's go back through the history, back into late 2005, and this was some changes that was made by the CME. They changed their execution engine coding from a method of coding which is called RLC coding. They changed that over to fix fast coding. That affected everything that was trading there at the CME, with two exceptions at that point in time. It didn't affect the ES, it didn't affect the NQ. But on everything else, it changed the way that they were representing executions to us as traders. So as an example, at that point in time, when they changed that coding, they altered what they had been doing for years, ever since electronic trading started, and they really didn't even tell us anything about it. Now, if we come up to 2007, as of 2007, remember the CME, CBOT, the Merck, and the Board of Trade merged and became CME Group. And at that point, the YM, which was the mini Dow, which traded on the Board of Trade, that now fell under the auspices of the fixed fast coding as well. But we have to look then at what changed or how that affected things, and where the change took place actually that affected us on the ES and the NQ and the YM. That change actually took place when trading opened Sunday, October 4th. And so we think about what occurred at that point in time. Friday, October 2nd of 2009, if someone placed a 1,000 lot sell market order on our time and sales, we would see a 1,000 print at the red. It just showed us one execution on our ticks. On the other side of the engine, though, for the back office purposes, they had to break that out into actual executions. And it could be as many as 1,000 different executions for one lot each. It just depends on what was next in the execution queue. If the next thing in queue was 1,000 one lot guys, then we should have seen 1,000 executions, not one execution for 1,000 lots. But they realized that they did not have the speed to send this information out through the pipe, and by the pipe I'm referring to their outbound data flow lines. They did not have the ability to process the information on a platform. So what they chose to do is they looked at the guy that placed the market order, and they said he's the guy that matters because he wanted it bad enough, or he wanted to sell it bad enough, that he was willing to give up a tick and sell it at the market. And so rather than showing our customers the actual executions that made up that transaction, we're just going to show them the market order. Well, if we back up to 2005, late 2005, early 2006, across all the other instruments, they changed because there were not that many big market orders. And they felt it wouldn't pose a problem. They didn't even tell anybody they changed it. But in September of 2009, they said, we're going to change the way we're doing our tick reporting. And they did not clearly say, this is what we're doing. They just said the change is going to come. Now, at that time, they gave us a couple speculative pieces of information. They said on the ES, on a normal trading day, we will transmit executions that were greater than 200 lots some 1,800 times a day. And they said when we make this change and we stop aggregating trades, it will now happen around 400 times a day. They said on these three instruments, which were the ones affected, the YM, the ES, and the NQ, you should see your overall ticks for the day go up by 2.5 times. Now we were kind of torqued off, a lot of us were at that point, because for years the CME group said we do not aggregate trades. So all of a sudden they're coming out saying we're not going to aggregate trades anymore. And we're going, wait a minute, you said you never did. But they had been. Well, when they made the change in October of 2009, they came to the conclusion that essentially what had occurred was the bandwidth was there. They could now send this data out through the pipe. The processors were fast enough. They felt they could now keep up with it. And so they changed that. So Friday, October 2nd, a 1,000 lot sell order at the market would print as a 1,000 lot, one tick red. And at that point in time, it was relatively easy to see what the large market orders were doing. That's where everybody was using these bots to try to conceal that. We come to Sunday, October 4th, when the market reopened, that same order could display as 1,000 individual executions, one lots at the red, and they would all push through with the same centisecond or 100th of a second timestamp. So you can imagine then that it greatly increased the load on us as tape readers, because now every single execution was coming through, and before that was only needed and visible to the back office. So you kind of look at what they changed and you say, well, in one way it made it more accurate, but at the same time it made it less useful. And bottom line, they made that decision and we saw the change. The tape sped up. All of a sudden it appeared that bot orders were coming through there. Instead of a string of ones, we saw 1, 3, 5, 7, 11, a 20, 14 ones. It would just all push through random. So after about 2 weeks of watching this in early November 2009, I contacted the exchange and I asked the exchange at that point, what were you doing before and what did you change? He told me that prior to this, they would look at the centisecond timestamp, the 1/100th of a second timestamp, which the exchange was using at that point, and anything that was executed with the same exact timestamp, they would just aggregate and push through as one tick. He said this was not based on the order size. We were aggregating based on the timestamp. Well, that kind of blew my mind because that went completely against what I understood was happening. And yet here's the guy at the exchange saying this is what it was. Well, because of what he said, then in a sense, it gave the illusion that the bots had changed and that these bots now were no longer using strings of ones, but they were just using random size and putting that together in such a way that it showed up on our platform without being visible as big market orders. Well, I very quickly changed my trading, and before I used to look at one or two 300, 400, 500 lot orders coming in, and I said that's enough confirmation for me, I'll go along with them. When it was at a point of interest, it was at a turning point in my mind. All of a sudden, when it changed, I had to go from a 50 lot filter to a 20 lot filter. And I realized within 2 weeks' time that I needed to wait for a string of prints for 15 or 20 filtered orders that were greater than 20 lots. And then I could see a comparable turn in the market. Well, ironically, because this was the exchange engine um, that had changed, not bots, it still ended up being right, and I still ended up making money with it, and I was still trading essentially the same thing I had seen before. So to get to the bottom of what occurred, I had a question from one of my customers. They had been discussing it. He was trying to find out for sure what was there. Was it bots, or was that just the way they were showing every execution? Contacted the exchange, pulled some strings, called in a few favors, and was put in contact with the senior VP who was in charge of implementing that decision. And he set that straight. And he said, no, what is happening now is that if that 1,000 lot market order comes in, we present to you the actual executions that it took to complete that order. And they all come through instantly with the same exact timestamp. And yes, it looks like a bot, but it's actually the exchange engine. Ironically, he said that they have had many complaints from members who are tape readers, and they're complaining, saying all we needed to know was that somebody placed a 1,000 lot market sell order, and now your new system is slowing down our platforms, it's clogging our bandwidth, and it's less useful. So it's more accurate, it's less useful. He said they have been, for the last month or two, they have been deliberating changing back to the old system, which would be beneficial to us because it slows the tape back down. It groups it back together with the intent, which was a market order. And we don't care, we got a 1,000 lot market order. Who cares whether it took 1,000 executions or one execution to get filled? We just want to know that somebody was aggressive enough to place a big order. So, long story straight, when we look at the behavior that's been there over the past year, it looks like a bot and it acts like a bot, but it's not a bot. It's the exchange engine. So when we see those orders that just collapse into view, the entire uh, time in sales, half the time in sales, it just collapses into view, and there may be ones and tens and 17s and a 100. What that's showing us is there was a large market order there. That market order got matched off against numerous different orders. Some of them were little, some of them were big. And so now when we see that drop into view, that would have a year ago been transmitted to us as one large market order. Now it's coming in as a flurry of orders, 15, 20 of size over 20 lots on the S&P, and then numerous, maybe half a screen or a full screen worth of ones and twos and sevens. So the reason that we're mentioning this is that these changes have drastically affected the market. And since they have affected the market, we want to make sure that we understand how these orders are coming in, what it means, and essentially this is still allowing us with our time and sales to track the large market orders. We just have to put it back together in our head and say, okay, wait a minute, it just, we just had 400, 500, 600 lots collapse into view instantly. Somebody just placed a 600 lot market order. I'm right here at a turning point. I see it. Obviously, this large trader sees it. He's going in on it. Let's go. Let's make it happen. Um, you can't find a bot now, at least in this market, because of the way they're presenting it. The bot is no longer visible. It all looks like a bot, and you wouldn't know a bot from the exchange engine at this point in time. So it's still very usable information. We're just going about processing it in a different way. Now, speaking of bots, we're going to talk about a new type of bot, and these bots are quickly being rolled out, and they are referring to them as predatory bots. These bots were designed specifically to come after buy-side funds. And when I refer to buy-side funds, the buy side ruled Wall Street for decades. And this would be your big institutions, your big funds that would come in and buy and buy and buy and buy and buy. And they did not short. They were always long. And if they felt that it had reached value, and it wasn't going any higher, they would sell their position, go to cash, and find something else to buy. Those funds transitioned to algorithm trading themselves. And when they needed to buy 100,000 shares, they would just tell the program how many they wanted, and the program had parameters as to how far it could pursue it and where it was going to buy it. And at that point, it was on autopilot and it would build the position. The quant funds, as they started looking at things, they came back in and said, we can take advantage of this if we can find a way to sniff these buy side funds out, find them working, then we can take advantage of that. And so when these predatory bots fire off, there's a couple ways that we'll see it. Some of it is just a very rapid price advance without much size, and it is primarily in the equities. But it is coming into the indices, into the futures, into the Forex markets. So, we have to ask, how do they do this? How do they sniff out these algorithm bots, and how can we spot them? Well, they are using what are called ping orders. And the ping orders are orders that are placed by the predatory bot when they think that a fund algorithm bot is getting ready to fire. And they will try to trick that fund bot into firing. In essence, they're using an order type that has been around for quite a while, but they're using it electronically. And you guys might have heard them, the FOK orders or IOC orders. It was fill or kill or instant or cancel, immediate or cancel, depending on your platform. They had 3 basic names for it. But they took a fill or kill order and they would throw it out there as a limit order, and they might throw 3 or 4,000 shares if you're trading equities, or 3 or 4,000 lots on the S&P E-mini, and then instantly the order disappears and is canceled, and then it's back and it's canceled, and it's back and it's canceled. And traders used to do that. They would throw some orders out there. They might even take a 1,000, 1,500 lot position in the E-mini just to test the waters, just to see how quickly the order was absorbed and what happened with it, and then they would use that as they continued on in their decision. But over the past year, it has become faster and faster and faster, where you look at it and say there's no way a human is doing it that quick. And it is the ping orders being submitted by a predatory bot trying to trigger a buy-side fund algorithm bot into going to work. And if it can then get that buy-side fund algorithm fired, it will turn around, because of its latency. It has less latency to the exchange because they're co-housed inside the exchange server facility, and they will step in front of that buy-side fund algorithm, and they know that the buy-side fund, their algorithm, is almost always based on VWAP or TWAP, volume weighted average price or time weighted average price. And when it goes to work and buys, they know it will typically buy within X number of ticks. They will come in and step in front of it by virtue of having less latency. They're faster, and they will absorb all of the incoming order flow, and then they will turn around and offer it right back out to the algorithm as soon as the algorithm bites on them. Well, how do we see this working? It's by looking at our DOM. And so on the DOM, I started noticing this. I commented on it in the room about a year ago, that this started becoming very visible on the NQ, where somebody would come in and throw out 1,500 lots. You only had 40 or 50 there at the inside price, but they would throw out 1,500 lot even every time, and it would appear 1,500 gone, 1,500 gone, 1,500 gone, 1,500 gone, and sometimes it would cycle 2 times, 3 times a second. And I watched this thinking, what in the heck are they doing? It never made any sense. Well, this was one of those first bots coming into the NQ that was using ping orders, and they would just flash and gone, flash and gone, flash and gone. Well, long story short, when we look at that now, it is an indication that they are trying to trigger a buy-side fund bot. And if they think that buy-side fund is getting ready to buy, they're going to try to trigger it into buying, and then they're going to step in front of it. They're going to bid in front of it. They're going to absorb all of that order flow. They're going to turn around and offer it right back out to the fund. And they're going to try to gain the rebate on each side of that and make their half a cent. And if they get a tick or two out of it, they're not going to complain about that either. So definitely something that's changing. We have to say, how much is it affecting us in futures? Well, here's our answer. Let's come back in here. We'll look at this again. Let's get a, let's go red. We'll get a box. This percent column right here That wasn't a good color. Let's get rid of that. Let's go blue. Something that'll show up on this a little better. Still didn't show very good. Let's go fat, and we'll go blue. There we go. This column right here, what we're referring to in this graph, and this is the same one we looked at earlier, which showed us the percentages of volume that are now being transmitted by bots. This is looking at the message count. And what the exchange refers to as message count would be orders that are submitted and then canceled. And if you look at the numbers, it can get pretty staggering here. Like you look at the Euro FX futures, basically 80% of the orders that are placed on any given day and canceled is a predatory bot. 94% on the options, 80% total in that category. The E-mini S&P, on the options, 71%, 92% on the options. Total of 75% of those orders on the S&P that are placed on any given day. Orders that appear and that are just promptly canceled, those are those predatory bots. So it is happening very, very frequently. If you look at your foreign exchange totals up here, 85% of your foreign exchange totals, those orders that are coming in and canceled, they're just probing, trying to trigger another bot into firing. Again, we don't see it much on the metals. It's slower on the ags, lower on the energies. It's getting up there where a lot of that activity, that probing and pushing and exploring and trying to trigger something, it's occurring by bots. Used to be live people doing that were pretty shrewd and doing good with it. So the goal that we have going forward then, if we take this information, is how do we use this? Well, first of all, can we identify them? Can we learn how to trade them based on their own strategies? If they're coming in for order rebate, we have to realize that if we spot that on an equity, on a stock, and they're going after the rebate, we realize that we've got maybe 5 to 9 cents that original fund bot will trade in before it cancels and waits for price to drift back down. So if we see that very quickly, we can buy at the market, and we can plan on being out 6, 7, 8, 9 cents, and then be careful because it could drift back down. We see that kind of activity on the futures markets. We know that they don't get the rebates. They can't do tens of millions of dollars a month in rebates. They're limited on their rebate capture. So if we see that there, we realize that predatory bot is doing something different. It's trying to trigger an explosion in price, or if it can catch another bot and get that bot to go long, it's going to try to run over it to the short side. But my understanding, speaking with the gentleman at the CME and in what I've observed with it, it is more likely to go with it and try to front run it. If it can get that bot triggered, it's going to start buying up in front of it, and it's going to try to run it up 5, 6, 7, 8 ticks, and then it's going to offer it all right back out, and down she'll drift. She'll come right back in. So kind of a goal that we'll have in the trading session. We'll see if we can identify that, show you what it looks like, and if we can identify it and find a way to trade it, we're going to be farther ahead than anybody else that doesn't have this information. So I originally was intending on some questions here, and I think we've addressed most of the questions that everyone has put out as we've gone through this. Just for full disclosure on this here, as I started this presentation today, I recorded the presentation, and then the recording fell apart on me, and it deleted the files. And so I ended up with no recording of our first session. So I incorporated the questions that were there back into the tape because I have the logs still, and I just incorporated the questions back in as we went. So the questions that were asked today have all been covered in here, and I had to just basically re-record, kind of just redo my slideshow presentation in order to get things all squared away and have the first day back on tape. I will go ahead and take a look here at day 2 and what day 2 is going to cover. And on our second day, what we're going to look at is, as we examine the prints themselves, what can we learn from it? We're going to try to take a look at where we're going to use tape reading skills, where it's going to be beneficial. We're looking at some ways that we can identify reversals with our time and sales. We're going to talk about trading just off of the tape alone. And then we're going to give a couple drills for you guys that are trying to get this down, to start looking at the time and sales, to start improving your skills and your ability to understand what's going on there. So that will be the next section of our tape, and we'll go ahead and stop here for day one of our November 2010 tape reading mini mentorship.
Yeah, Pete, with your question, that would normally be the way that a lot of people would get in. They would either on a pullback, or they would get in as it broke to a new high. I'm just kind of curious what you guys preferred. I've found over the years working with people that the majority of people preferred reversals, but not everyone was very successful at choosing reversals or getting good points there. So the uh, the polls staying pretty consistent, and you can select more than one answer. But even though you can select more than one answer, with all of you having voted now, 92% on the reversals, 50% trade continuation moves, 42% breakout, breakdown, 42% momentum. So it's pretty clear that the by far the preferred strategy is reversals. And we're going to go into the reversals today, start looking at trying to identify them. And I didn't try to load this by making that the first answer, by the way. I've just I put them in there because I felt that's probably where things would end up. And ironically, that's exactly where it ended up. Number one, two, three, four. And they were exactly in that order for your choices. The reason that I see that just in working with people, there is a comfort level with certain types of trades. And since so many of you have the same comfort level, certain types of trades, what my goal is to say, let's look at how we can improve that type of trading. Because if you talk to a lot of traders, they will tell you that trading reversals is a newbie strategy. That's a failing strategy. But bottom line, it is something that can be done very successfully if we know what to look for. So I'm going to close the poll out here. And I think you guys should now be seeing the title screen. If I could just get a quick a yes if you've got video. Okay, looks good. I guess we'll let that stand for our audio test too, because you wouldn't have heard me if I didn't say that. So sounds good. We'll get going here then. Again, today, as we go through things, if you have questions, throw them out there. If I can address them without interrupting the flow of the presentation, I will do that. Otherwise, I will come back to the questions. And there were a couple yesterday that I missed comments because I couldn't get this window to work correctly. And then when I finally detached it from my control panel, it allowed it to start working. So we'll try to keep on top of those today. But like I say, if you've got questions, feel free just to put them out there. I'll work them in as we go. Here's what we're going to do. We're going to start again with our disclaimer, just a word of warning, and we say it every time. It is a serious business that seriously hurts people, and it does need to be done with money that you can afford to risk. We're going to try to show in the course of this, and we'll probably go through this tomorrow, but we're going to try to show how we can minimize that risk to the point where we can make good decisions emotionally, um, be in a good mental state as we're trading, and yet still be risking money and still be making some money. But we have to realize, especially for the futures, those are pretty good sized contracts. A lot of times we get distracted by the fact that the margin is $500, and it doesn't sound like it's that big of a deal. But you have to realize that something like the S&P, if you want to figure the actual value of the contract, you multiply wherever the S&P is. If it's at 1100, you multiply that by $50, and that's the actual value of the contract. So frequently we're talking about a contract that is somewhere $65,000 contract. Now we think about stocks. There's no way we could go trade a $65,000 position for $500 of margin, but that's what people are doing when they trade futures. So it can be pretty easy to get a two or $300,000 position, and then people are shocked that it took $1,000 out of their account when things go wrong. So just keep those factors in mind. As we go through this, like I say later, we'll look at some better ways of trying to get into the market, get some exposure there without setting ourselves up to be financially destroyed for it. For today, these are going to be kind of our topics. We may take less than 2 hours, we may take more, but it's going to be something that it will depend in part on questions, and I'll try to make it as clear as I can because today is going to be kind of pivotal in defining what exactly we're doing, what exactly we're looking for, and how we're going to use it. So before I get too far into this, actually, let me just mention one thing to everyone. I did have some problems with the recording yesterday, and so as a result, I'm going to stop the recording a few times today, and we're going to take a couple more breaks today than what we took yesterday. But the reason the recording got so large, Camtasia starts putting they stop the files at 1 gig in size, and these raw recordings are very large. Um, it crashed when I was all done and lost the entire recording from yesterday's session. So essentially, what I had to do, I went back through yesterday and redid the session just on a recording. And so the recording, you should have received by now a link to be able to get this downloaded. And so the the recording that's there, I did cover everything that we covered yesterday. I worked the questions that were there back into everything, and then uh, we'll get going with that uh, presentation here this morning. We're going to stop every half hour and just save the recording so the file doesn't get over 1 gig. Apparently, when it takes those files and tries to merge them back through, makes a big mess. So the recording that I sent you out, just so you're aware of it, that is a WMV file that'll play in your Windows Media Player. That is a low quality recording, and the difference in size, you downloaded that at around 68 meg. The AVI file, which will be the final file that you get, that is 480 meg. And so just for the day-to-day recording, it's a lot faster for me to render a Windows Media Player file. So day to day, I am going to send out a file at the end of the day, but that file is going to be a low quality recording. So just for you guys, if you're here and you don't want to download it, don't download it because there will be a full recording at the end that will be the AVI, which will be very, very clear quality. The quality of that will be the same as what is here on my monitor that I'm presenting from. So I wouldn't worry about, like Gary with your question, I wouldn't worry about downloading everything unless you want something specifically from that day. You'll still have the links. So if you wanted to come back and download one of the days, you can. Those links will be available for 14 days and then they're going to disappear. And it's going to limit you to one download per person. But like I say, you'll get the full quality recording at the end. And I did go ahead. I wanted to see how long it took to do it. I did go ahead and put in a working table of contents. Uh, it actually didn't take that long. So there is a table of contents on each of these, and then it'll make it very quick and easy at the end to put them all together and get them out to everybody. So got a couple questions here. Um, we'll get to these questions at the end uh, about the time and sales window, if that's okay, unless you have to leave early. If you have to leave early, let me know and I'll put that up. But for the time and sales properties, we'll put that up at the end of the day. I'll come back and just review through the questions and make sure that everything is, everything has been answered. Um, Tom, same goes for your question, or I guess it's more of a comment um, about the large S&P charts. Um, and you asked the question, do I ever watch the E-mini from the big contract? And no, I don't. The big contract, there's no volume in it. There's no reason to watch it. And when you say that this is the large traders, it's not. The large traders aren't trading the big contract anymore. The large traders are trading the E-mini. So it's not, there's nothing really that viable, I guess, uh, about the big contract that makes me want to watch it. Um, when you've got that open outcry contract and it's trading just a few thousand, 4,000 lots a day. There's no reason for me to care what they're doing. They couldn't move the market one tick with that. So they're basically trading one instrument back and forth in that pit, and they can move their little instrument around, but that instrument doesn't necessarily have the impact anymore that it used to have. So, well, let's take a look at this here. The things we're going to discuss today. Obviously, you've had a chance to read this. We are going to look at the reversals, and we're going to go through some things that you're going to have every time there is a reversal. You will either be able to say, I don't see it and I don't think it's going to reverse here, or you will be able to look at it and see some of these factors. And so I think you guys will find this beneficial, since that clearly is the preference for your trading. But I would start here with this statement, and you guys might feel this already if you've been watching the markets for any length of time. When you look at the time and sales, it essentially is noise, and I would say throughout the trading day, for most of the day, it's just noise. And to try to trade off of that, we will go through that eventually, because there is always interest in how you would do it if all you could look at was the time and sales. But it does drain you mentally. To me, about 20 minutes, 30 minutes at the most, and I just feel like I've been trading for 14, 15 hours and I'm done. I'm ready for a break. And I've never worked much with people that were able to do it. One of you that is in here has seen Hubert do this, and I think you would probably agree. You've seen the same thing. Hubert can do it. Hubert Sinners. Um, Again, it's something that he can't teach it, and very few people can figure it out. And I've experienced the same thing when I've tried to show people. There's not a lot of payoff for all the mental work you put into it, but we'll go through it anyways. So if that's the case, if we're not going to take our trades 100% off the time and sales, then we have to say that at most points, the time and sales is just noise. And I would consider that to be the case unless we're looking at good areas, at good potential points for us to take trades. Now, we looked at this. You guys obviously have some interest, some of you, in continuation moves. And as we talked about with Pete's question, you take a continuation move and you have to ask on a continuation move, um, how do you go about getting into a continuation move? I've seen two ways of doing it that were successful. One of it would be, if you feel that the trend is going higher, you're waiting for a pullback and you're going to buy the pullback. Um, Another way of getting into it is saying, as if it breaks this prior swing high and continues higher, then I'll let it get me into the trade. You're going to place a stop entry order, and you're just going to come into this on the fly. So there's an interest there, and we want to find areas where this will happen. We've got the breakout, breakdown moves. We see a sideways consolidation or a base. Everybody used to call it a base. Now it seems to be consolidation is the term of choice today. Um, Again, at those kind of points, we're going to see indications on the tape that will give us a clue as to what's about to happen. And it's going to happen very quickly. It's going to require us to be paying attention at that point, and it's going to require us to make quick decisions at that point. But bottom line, the question that we all want to understand is, where do you look to the time and sales when it comes time to make a decision? So I would say, in the past, I've defined it this way, and we'll go through what this means. But some of you trade in such a way that you will have simply static points where price is likely to change direction. Some of you will trade in such a way where it's dynamic. It's a dynamic point. And here's what I mean by that. We're going to take a look, first of all, at static price points. And I'm going to do something here. Some of you have seen me talk about this before, but I'm going to do this again because there's many of you that haven't seen it, and I want you just to think about what it implies for our trading. Static price point, we've got numerous things here that many people base their entire trading strategy on. We've got a floor pivots or pivot points, as sometimes they're referred to, and people put a lot of weight on those lines. They got their S1 and their S2 and their R1 and their R2, and they've got the pivot line, and they will base an entire trading strategy on a mathematical calculation that was based on yesterday's high and low and close. You've got another school of traders who is into a market profile. They like the value area high, the value area low, the point of control, and when they see price start to move, they're looking at any virgin point of control around them as potential targets or as potential reversal points. Short-term traders, we get the short-term traders frequently, uh, what they're going to be looking at, like they take a tick chart, they're looking at the swing highs and the swing lows. Those are going to be areas where the time and sales will be very valuable. For other traders, high of day, low of day. We come up into yesterday's high. That was it yesterday. That was resistance. That was where there were enough sellers to finally overpower the buyers, or at least the buyers gave up. Flip that over for the low side. Is that a valid area to go to the tape? We have to say, yes, that is a valid area to start looking at the tape. Some of you have subscribed for a long period of time to the opening period high and low. And some guys have done that for years for 5-minute opening periods. Some mark off the first hour, some mark off the first 30 minutes, and they expect some type of reversal or activity at those levels. We get the typical support and resistance that we're taking off of a chart, just looking to the left. We've got trend lines, we've got channels. But when we look at these levels, the reason that we're calling these a static level, there's something that each of these things has in common. You can look at this in advance, you can put an alarm on it, and then you can quit watching. Now, if we can do that, in some ways, that allows us to come in and spend 5 minutes or 10 minutes at the beginning of the day, and we sit down and we build ourselves our little action plan for the day, and we say these are the levels that I'm interested in. I'm going to put an alert there, going to put a line there, whatever we use, and we're going to just simply wait for price to get there, and we're going to look at the reaction. Now, is that a viable trading strategy? I would say yes, it is. I've done that for many years using some of those very things. Simply waiting for price to get to a specific level that interests me. And at that point, I'm watching the tape, I'm watching the price action, and now I'm going to decide whether I feel that it's a reversal, whether I think that it's going through. And I will either take the trade or not based on what I see on the time and sales. So I have to say, yes, that works. Now, if that's the case, we could take what you guys have already been doing, perhaps for years in some cases, and all you simply have to do is refine it by using the tape to confirm that entry or to blow it off and say, nope, it's not working right now. We're going to talk about that more when we get into the management part of things. But just in brief, um, when we talk about a trade and we're getting ready to get into an entry on a trade, there may be a point where it's not doing what we expected it to do, or it's not doing what we wanted to see in order to confirm our trade. And yet on a chart, technically it still hasn't violated it to the point that we're going to go the other direction. And it hasn't violated it to the point where we just blow the trade off and say, nope, can't do it. So, we can look at these points, we can give a little leeway there. I remember an analogy when I first started trading. It was a firm Pristine, many of you have heard of it. They've been around for, I don't know, 15, 16 years teaching people how to trade. One of the things that I always appreciated from their teaching, in spite of the fact that most of it didn't work too well, they did a lot of work with moving average, and they always liked the 200 period moving average, and that was where you took the majority of your intraday trades on. They always said it's like a rubber band. It can stretch a little bit. So if it went one tick through or three ticks through, it didn't violate the trade setup completely. They went ahead and watched the candle pattern form, let that uh, play out long enough to know whether it was still going to go ahead and give them their confirmation. And their confirmation was based at that point 100% on price action. And so we have to say the same thing with any of these lines. And bottom line, what you're going to have to do as traders is you have to look at the instrument you decide to trade and say, how much room do I have to give this? Does it need to be 3, 4 ticks if you're trading the S&P? And at that point, if it goes on beyond that, uh, it's gone through to the point that I no longer want to enter it. Or do you say, I'm trading crude, uh, 15 ticks through? It still would be a good trade for me. You start looking at how far it carries through day by day. You build a filling for that particular instrument, and then you're able to come in and trade that, and repeat that time after time. You'll be able to be successful with this type of strategy based on what you're already doing. You just are using the tape to filter it now. So when we look at the static price points, these are things that in advance and usually far in advance, most of them, we could put those lines there, put those alerts there. So how does that differ from a dynamic price point? Well, when I talk about a dynamic price point, I'm talking about something that's moving, it's alive, it's moving up and down. We can't look out way into the future 2 hours and say it's here. It's something that frequently unfolds in real time, and it's reflected because of what the market structure of the day is. Now, when I refer to the market structure, I'm talking about the uh, tempo of the day, and it's down on the day. This is the way that it's setting up and structuring. It's a slow tempo. It's grinding to the downside and so forth. And we could come in and say there are some ways of looking at this that we can't predict out into the future too far, but we know that there will still be reactions there. Well, again, we want to figure out, are there areas like this that you're already using? Are there areas like this that can be spotted? Now, when I look at that, I would say yes, uh, there are some of these points that you guys are currently using right now. What are they? Anybody trade a moving average? Anybody trade price action, where they're taking a cue specifically from one candle, moving over the top of another candle? Anybody put a Keltner band out there, a linear regression channel, Bollinger Bands? You start thinking about that. Those, at best, you're going to see just a few minutes of heads up when it comes into that. If you're trading a moving average crossover, maybe that's a little different than somebody that's trading it as support and resistance. Pristine strategy, which worked very well, and there's still some validity to it in many degrees today. Uh, you're just simply waiting for price, where it's been in an uptrend, to come down into a moving average. And when it comes down into that 20 period moving average, if it's rising, and they always had 75 filters to blow the trade off, but essentially they would wait for it to come down into that moving average. They would then view that as a support area. And when it traded higher on price action, they would go long. So you have to say, at any of these points, if you were looking at it to contain price or to stall price or to reverse price, that would be a valid point to come in and start looking at your time and sales. So the the problem that we run into is this: if we're using a moving average, or we're using price action of a candle, um, we're using a Bollinger Band or a Keltner channel or a linear regression channel, in some ways, if we just use that by itself, it essentially would put you behind the game. You're going to be late in seeing a signal because you have to wait for the 5 minute candle to close. You have to wait for the indicator to roll over. Whatever happens, you're going to be getting an entry that frequently is 4, 5, 6 ticks in a market like the S&P, or maybe 10 or 15 ticks behind in a market like crude. We got a question here, which I will address here. What did they consider price action? They primarily traded 5 minute candles for all intraday trading. And they wanted to see a 60-minute chart in an uptrend. And then when the 5 minute had a pullback to support level, they would wait until that final candle, that pulled back into the moving average. Their trade signal was when you traded above that low candle. In other words, you would have 3, 4 candles down. When it made that low candle, you had some bottoming tails on it. When it traded above the prior candle, that was their signal to go long. They didn't have to close there, but they had to see that at least trade above the prior candle. So in that sense, it was pure price action trading for the entry signal, but it was the support and resistance came off a 20 period moving average on a 5 minute chart. So the lagging tools, I've always said, if you want fast confirmation, when you think you're at a good price level, there is nothing on your platform that will plot or react or change faster than your time and sales. We talked about that yesterday. Your time and sales will still be running when the entire platform locks up. The time and sales will keep streaming in. So, to me, the time and sales then is something that we can use at any point in there uh, in that trade. It doesn't matter whether we're still using our indicator. If you're using one, don't take what we talk about to say you have to quit. If you're still using a straight price action, it doesn't mean you have to quit. You can still take 90% of what you're doing and then go to your time and sales and use that time and sales to come in and either give you the confirmation to take the trade, and you're doing this with minimal confirmation. The result is you usually get a better price point. Um, or it's going to blow the trade off and say, no, this is not the time. So I'm going to stop here for 2 minutes. We've got half an hour behind us. I'm going to just stop our recording and then restart that. It takes just a minute for that to produce the little video file. So I will be back in 2 minutes. Okay, so we're back. I appreciate your patience in doing this, but I just want to make sure that I don't have to talk through the whole thing again. 7 hours a day of talking, I'm going to lose my voice. So um, that file, just for those that are interested, when they record these, I'm recording AVIs at a very high frame rate, and the 27 minutes that we had was just shy of 1 gig. And then when I edit those down into the final files, they actually end up smaller, but it really chews up some CPU and memory when you're trying to put them back together. And I was putting the file back together last night, and the thing just crashed, and the whole recording was gone. So couldn't be retrieved because it was still stored in the temp folder at that point, and it had just been deleted out and cleaned out. So anyways, so let's continue here. We've got the question: how can time and sales help when we're trading a setup from an indicator or from straight price action? These are things that some of you have heard me say before, but these are the things that we have to pay attention to when we're looking at the time and sales. I don't know that they're in any particular order of importance. I'll tell you when I'm done which is most important to me, but these are the things that we will be trying to take from the tape. Now, a guy may look at this and say, I can't track all this stuff. It's too much for me. And you don't have to track all of it. You may take part of it. You may take one of these things and really focus on that. You may take two of these things and really focus on that. and build your trading strategy around it, and it can still be very effective that way. So let's talk about what we're referring to then when we talk about speed. You guys, obviously, if you open up a time and sales of the S&P E-mini, and you open up a time and sales of GC, which is gold, you can tell the difference in speed. One of them is blurring by where you can't hardly focus on the price or the size, and the other one you could study on the same height of time and sales. You could study the last 15 minutes and see where all the prints were in the last 15 minutes. When we start watching the speed, there's several reasons that this is important. The speed that the tape goes by, I could tell you just watching the speed when we're coming into a news release, and I have found myself on many occasions in many trades where I forgot about a news release that was coming up, and because of the change in speed, in my mind, I immediately said something just came out. Um, I missed a news release. If I look at the clock instantly, and it's 8 o'clock, and I'm going, crap, totally forgot to look at what releases were out today, but I could see it change on the speed. I would suggest that within 30 to 40 seconds of the open, I usually have a pretty good feel for whether we're going to have a sideways day, like a grinding type of day, or a real volatile big range up and down and whipping around kind of day. And I would get that impression primarily from the speed and from watching open after open after open after open for years. And I got a feel for the speed, and I can look at the speed of that tape and go, that is slow. It's running slow today. Yes, it just sped up based on what it was doing at the pre-market, but it's slow today based on fast days. It's slow today based on days where price was explosive and it was moving back and forth in 15-point ranges. It is so slow that it feels like I'm already in the doldrums, and I'm thinking this 30 seconds in, I expect that day to be kind of a slow grind. Doesn't mean it won't move 20 points by the end of the day, but in my mind, I'm already gearing myself to say I like bigger targets. I like to get a runner, and if I could get a runner and just have one trade for the day and I'm still in that position 15, 18 points later, that would be ideal for me. So when I see that type of lackluster speed, it's just the pace is very slow of the prints coming in. It says to me this is not my kind of day, and I know that 30 seconds in. The speed of the tape, there are other factors that we can take just based on the speed of the tape. And we think about price levels of interest. Everybody talks about the large traders that are coming in trying to run stops, trying to probe price levels. And you can see the excitement. You can see the tape speed up and slow down. And you can see that long before anything shows up on the chart. If you've been watching for 20 minutes, and during that 20-minute period, at any given point, you could look back and you could read the hour, the minute, the second, you could read the full price, you could read the lot size, and you could go down your time and sales, and you could say, okay, well, those four prints came in together with the same timestamp, and these two did. It's a slow tape. And it's not likely that the market is going to be moving much. It's not likely that it's going anywhere. It's just drifting along. It's chopping along sideways. And so it's very important because, we take trades, we're looking at a reversal, and there's no speed on the tape. There's no, I would say there's no gusto. There's nothing happening there. This may not be the reversal that we're looking for that takes us to the high of day. So it is important to start gauging that speed. And what I prefer to see, this is just my own preference for my own personal trading. I would like to see the tape going by fast enough that all I can do is focus my eye on the decimal point in the price. And all I want to see is the last digit to the left of the decimal point, the first digit to the right of the decimal point, and I want it to blur by so fast that that's all I can see. That's what I prefer to see. Those are the type of conditions that I prefer to trade in, because there are opinions there. There is buying and selling. They are trying to push this one direction, and that suits the trades that I prefer. I would like it going by so fast that I can see in the size column whether it's single digit or double digit or triple digit, but that I can't really focus on the numbers much. You may prefer something slower, that's not that volatile. You know that you're going to have to gain an understanding of what is good for you, what's good for your trading setup, but that is a very important factor. Now, I want to compare this back to something some of you may be familiar with. In fact, I know. Make sure you're in here. Yeah, want to make sure that you guys kind of understand where this goes back. That there is a definite and profound basis for this speed of the tape being important. Um, some of you I know have used and are using Pit Audio, and some of you have never heard of it, and some of you have heard of it and have never used it. But Pit Audio, for years, there have been what are called squawk services, and they have a microphone suspended above the pit, above the S&P pit, and they have a commenter that sits up above the pit, and he calls out the bid and the ask. He calls out the fist fights and the ice, the scratching and the wrestling that goes on, and everything that's happening there. And as he looks down into that, he's got a nice overview of the action, and understanding their hand signals, he can give a good overview of what was going on in the pit. You could subscribe to this and you could have his commentary, and then on his commentary you would hear a little bit of the background noise of the pit, or you could hear a separate feed which was just the microphone of the pit. Everyone that I have ever known that successfully used that, that understood that, and I'm talking about uh, off floor traders. They came off the floor, went to the screen. They would never ever listen to Ben comment on what was going on in the pit. They listened to the noise of the pit. And what they looked for, if they were in a position and they heard that explosion in sound where everything got just frantic and screaming and yelling and everybody's trying to execute, that was typically when they would start exiting their trades. Now, there's a direct correlation to what we see on the tape. When we see that absolute explosion that comes in, and we're going to talk more about this in a minute, but when we see that absolute explosion, it's indicative either of a move beginning or a move ending. And that's what experienced traders that have been in the pit, that's what they want from Pit Audio. They know that that explosion in the pit is either going to be a reversal point, or if it's been quiet and it hasn't been moving, they know that that explosion is going to be more indicative of a breakout. Well, the Pit Audio is still available, and the problem with it is that the pit doesn't have the impact that it used to. But it's interesting to note that it's the same thing. It's that frantic activity that will either kick a move off or stop a move in its tracks. So the speed of the tape and being able to judge the speed of the tape is very critical. And at the end of our session, I'm going to go through some drills um, to try to help improve the way that we can track this. It does take a little bit of practice. The size the size of the prints is what I'm referring to there when we see these executions coming through. Now, we laid the groundwork for this yesterday by talking about what the exchange has done and the way that they're presenting the prints to us. 1 year ago, you would have simply looked for large market orders coming onto the tape. And if you saw 2 or 3 large orders, 300, 400 lot orders, and this was happening at a point where you expected a turn, that could be, in many markets, all the confirmation you needed. You get 1 or 2 large orders. Well, because they've changed the way those orders are presented to us now,
we have to kind of gauge size more on the basis of a flurry of prints coming in. So we see half our screen or three-quarters of our screen drop on the time and sales that's unfiltered, and we see 15 or 20 drop into place all at the same timestamp on the filtered size. Now we look at that and say there is some size. There was a large market order. We can quickly, we know it was half our screen, and we've got 100 lines on our screen. We know, okay, that was a minimum of 50 lots. We scan our eye down it. Most of them were sevens, eights, nines, and tens. We can look at that and say, okay, there was 900 lot market order. So it's a little different than it used to be, but it is an important factor on the tape. And I have always felt you can look for two things. You can look for what the small traders are doing, and then you can trade against them, or you can look for what the large traders are doing and you can trade with them. If you do one, you just about automatically are doing the other. I think personally it's easier to look for size than it is to look for the small traders. But that is an important factor that we're going to pick up off of our tape. Now we talk about control, and when I talk about control, you will frequently watch the tape. And I encourage people to look at this and even to go back and look at it on replay. If you have, your replay recorder on, or if you have version 7, you can go back and download a replay and watch the tape again. When you watch a move that is just, it's running hard, you can tell definitely without even being able, you don't even have to focus on the tape, but just having it in your peripheral vision, you can tell who is in control. You will see 30 or 40 red prints for every 2 green prints. And it will go and go and go and go with that being the case. And you may come up to a point, and this may be one of the levels that you've chosen. It may be a pivot point, it may be support and resistance, it may be a moving average, but you will reach a point where price has either gotten dear enough that sellers come onto it, or it will get cheap enough that buyers will come into it, and you will see the change in control. Now you got to bear in mind that takes some observation to get comfortable with. You're going to have red, green, green, red, green, red, but there will be periods, and these are going to be the periods where price is moving and the market is active. You will see very clearly that it is one-sided market. You can identify that again, peripheral vision. You don't have to see the size. You don't have to see the timestamp. You can tell it is all red, and it's been all red for 10, 15, 20 minutes. Well, that doesn't necessarily do you a lot of good getting into a short, but it can tell you a couple things that are beneficial. Let's say that you've watched this for 20 minutes sell off, and the sellers absolutely have grabbed that instrument and they're driving it into the floor. And all of a sudden you come into a level and you see big size start buying. And I always say if it's been a sell off, the first flurry, or if it's been a rally, it would work either direction. The first flurry that happens is very likely some profit taking by guys that are smart. Second flurry that happens at that price level would usually, to me, be, I would consider that initiation of new trades. So we will reach a point where all of a sudden you can sense that the sellers are starting to lose their control. That is very important to me, and you don't see that all the time. The reason you don't see that all the time is that many times the market is two-sided. There's just as many opinionated buyers as there are opinionated sellers. They are equally aggressive in placing market orders. And as you're sitting there watching it, you got 15 red come through, and then 15 green, and then 15 red, and 15 green. And when that's the case, all you can do is file that away. That's information that you now know that you didn't know a minute ago. So you're now looking at this saying it's very two-sided.
don't know who's going to win. We could just end up in a range. It can prevent you from getting into a trade at that point, thinking that you're going to get a big runner because you realize that it's very two-sided. To me, the best thing that you can find is the period of time where one side has been seriously in control and they lose that control. Yeah, maybe you guys could just type out here what that would be indicating. Your sellers have been completely in control 15, 20 minutes, and now on the tape you see them starting to lose that control. You see the green prints getting more and more aggressive. The market buyers are getting more and more aggressive. Uh, what do you see happening? Okay, exactly. Karen's first one out here. Reversal coming. Um, several comments are coming in. When we see that reversal, we have to say, and I'm going to put a chart up in a minute. We have to say on the chart, we're not going to buy into that picture very quickly. But on the tape, when we see that change in control, that is the fastest, quickest indication that you have that there's going to be a reversal. So if you guys like reversals, let's put the two and two together. What do we do with it? Wouldn't that imply that we wait for that to come into our level where we think, okay, this could be a reversal point? There's a very logical reason to view this as a potential reversal point. We've watched the sellers in control. So now we've got these two things in alignment. What do we need in order to take the trade? And we see that change in control. When there's been that change, that is to me the best difference. Now, how could a continuation trader be watching the same tape and the same chart and come up with a completely different trade where he's going to short it? Let's take the same scenario we're discussing. Price is in a downtrend. They've been selling it for 30 minutes. They come down into a level where buyers start stepping in. We see the green print start coming in on the tape and they get more and more aggressive. The market buyers are coming in more and more aggressive and price starts to move up. Where does the continuation trader start watching that tape? See, he's looking at that and he sees them take control away from the sellers. And now he's simply waiting for the sellers to come back into the tape with the aggression that they had earlier. And so as he watches that rally back up, he may be looking at a fib retracement, and that's going to be his price level. He's saying, hey, I want to get this up here to the 50, 60% retracement level. And then I want to see that change in control again, where all of a sudden we've got aggressive buyers coming back onto this instrument. Did I say buyers? Aggressive sellers coming back onto this instrument. They're going to take control back from the buyers, and now we're going to get our continuation to the downside. So for each trading strategy, they can watch the same tape and they can take what they need from it. Now, the guy, and let's just think about this in terms of filtering out losing trades. The guy that's watching it for a reversal, it may get to his price level and he cannot see any evidence that the buyers are taking control from the sellers. What does he do? He passes on the trade. And if he would have just entered the trade 100% based on the fact that it was to yesterday's low, it may have worked out, it may not have worked out. But if he gets to that level and he actually sees that the sellers are trying even harder, what do? You blow that trade off. You want no part of that. Um, the continuation trader, he watches that coming back up into his Fibonacci retracement zone that he's interested in, and he sees that the sellers have tapered off, and he gets up into that retracement zone, and he sees that the buyers are aggressive, and he sees a couple feeble prints come through on the sell side, and the buyers just keep buying and keep buying and keep buying. Is he looks at that and says, this is a chart setup that I like, and it's very successful for me. But at this point, sellers are not stepping in and trying to take control. And so he blows that trade off and says, not here. Now, doesn't mean that he can't enter. It may go up another point, and then we see the sellers coming into it. If he does, he may say it still didn't violate the overall chart pattern, because we didn't come up and make a new high where I think, now our trend is changing. So he may still come into that. He may say, now I've got to move my target. The target's going to be before the prior low because it rallied higher than I thought, or so forth. But he can still, just by watching the control on the tape, he can still come in there, make a good decision, filter that trade out, and improve his win-loss ratio. He can take a 50-50 setup like a Fibonacci, and by filtering it, he may turn it into a 60-40 win-loss ratio, not changing anything, just watching the tape, seeing who takes control where. So if you're a patient trader, I would say this is probably the best thing to watch. You're going to watch out for the situations where it's very mixed. And if it's very mixed, you have to realize that it's probably a scalping market. And if you know how to scalp, you scalp. If you see that one side is firmly in control, then you can either trade that for reversals or you can trade that for continuations. Um, you're just going to look at that control. And this is what I meant earlier when I was saying we may decide to only focus on one aspect of this and make that our confirmation. It doesn't mean that we have to see the speed change and the size change and the control change and the results and the interest. We may just take one thing and say that is very dear to my trading plan. I can work that right in with what I do right now and make it happen. So I would say control to me, the trades that I like the best, and this is where I would be willing typically to go from a 20 lot trade to a 50 lot trade, would be based on changes in control. When one side is clearly in control and I see them lose control, that's where I'm really willing to step up my size. Um, I'm putting that out there for your reference, as to what my personal preferences are. Doesn't mean that's going to be the right thing for you, but that's what works for me. Now, a couple questions, and Tom, I kind of touched on this, I guess, unintentionally. You ask, how can we spot follow through? Well, you think about follow through. If we were talking about this strategy, or this scenario earlier, we've got a sell off, sellers have been in control. We come down into an area where it looks like it's going to bounce. How do you spot follow through to that? You see the tape speed up with sellers. You see the size pick up. Big sellers coming into it at that low. You see the little attempt to wrest control from the sellers, and it's immediately met by big, huge size coming in selling. What does that tell you? This thing is going lower. They are not interested in giving the bulls a chance at this level. They're pushing the pedal to the metal, and they're getting even more aggressive. And we have to stop and say, why is that important? The reason that's important is you don't find very many smart traders, uh, and I shouldn't say smart traders. Let's define it as smart money because we don't want to insult someone's intelligence. You don't find smart money selling lows, and you don't find smart money buying highs unless they know that it's going higher. They're very confident that it's going higher. They're intending to push it higher. They're intending to push it lower. So if we're looking for follow through, we're looking for the big boys to be doing something that big boys don't do. And that is to come down there at a dead low up against support, and that's where they start initiating big size. That should answer that sufficiently on that basis. And Karen, your comment that the hesitation when you're waiting for some confirmation, and then because of hesitating missing your entry, that is, to me, one of the biggest problems that traders face. When we look at the really big issues, I think it's moving your stop further and further away. Letting something that would have been $100 loss turn into a $5,000 loss. It's the hesitation. and you know in your gut, you're sitting there looking at this going, I felt it, I smelled it, I could taste it, and I was scared to pull the trigger, and now it's down where I would have already been taken off my first lot, and I don't know whether I should still enter or not. And it's frustrating. It damages you emotionally, and that's where I've faced that. I've been through the same thing that you're expressing here. You hesitate, you miss the entry, you kick yourself. The way that I dealt with it was to say I just need to see minimal confirmation on the tape, and if I can get just a minimal confirmation there, that's good enough for me. I'm going to take that trade. Um, by doing that, will you get stopped out? Yes, you will. And you have to be able to realize, as a trader, 3 or 4 trades out of 10 are going to stop out, and it doesn't matter. I, Brian, the comment that Karen made, she said that what she has found is that she might hesitate waiting for some type of confirmation, and by hesitating, I have missed the entry. Now, where Karen's coming from with this, I'm assuming, Karen, you're talking your confirmation off of charts or confirmation off of some of your tools that you've developed for yourself. You're waiting for that confirmation there, and then because of that hesitation, it's moved far enough, um, that you're looking at it going, don't know if I can still do it here. And Karen, do you mind if I mention the market you trade? I know you're planning on putting up charts anyways. Okay. Um, we're talking about crude, and for anybody that's traded crude, and Karen, has got some very good things going with crude. But anybody that's traded crude will realize that it can put 15, 20 ticks down faster than the S&P can move too. And if you wait and you hesitate, frequently you're already so far away. Now you're going, stink. I was going to do this with a 12 tick stop, and now I need 32, and I still see it going lower, but I don't want to give it a 32 tick stop at $10 a tick. So it is a very fast moving. You really have to be kind of a cast iron stomach to come in there and trade crude. You feel like you're stepping in front of a freight train. It can be a very dangerous market to trade, but it can also be a very lucrative market to trade. And for people that don't like to sit there and grind for an hour on the S&P, the nice thing is you're right or you're wrong, and you usually know that pretty quick. You don't usually have to sit there for 45 minutes to figure out that you're going to get stopped out. So, well, let's stop here for a moment. We've got another half hour behind us. I'm going to reset this tape and save that, and then we'll come back to points number 4 and 5, which would be the results and the interest there. So I'll be back in about 2 minutes, as fast as this can save this file. Okay, so back again. Just we've got a couple that came in late, and just for your reference, guys, the ones that came in late, the entire recording yesterday got lost, and I went ahead and just redid the presentation and worked everybody's questions in and re-recorded it. But what's happening with these files? It's just the way Camtasia handles things. It records an extremely large file into temporary memory, and then when you finish up your recording and turn it off, it takes that and processes that file back into the actual AVI video. And it apparently, what I found out happened after an hour of fighting it. It will take these and put them in 1 gig chunks, and then when it tries to reassemble all of these 1 gig chunks of video that's in temp memory, it can crash. And by having nearly 3 hours recorded yesterday, it ultimately just crashed, and all of the stuff that was stored in temp never got processed into AVI files, and it was something that couldn't be retrieved. So I'm just stopping every 30 minutes, um, so that I can limit that. At 30 minutes, it will take just right at 1 gig, um, to record or cover 30 minutes. So where I'm stopping, I'm basically just processing that 1 gig video out of temp memory into an AVI video,
and then saving that video. So that's why we're kind of hesitating and stopping, and we're going to have to just do that throughout the rest of the presentation. So getting back to the presentation, we got a comment from Karen, and this is exactly correct. She says, what will happen, and we're speaking again of crude, what will happen is that when you revisit the same price where you were thinking about your original entry, they will very frequently run it back through there. So you get a chance, you've got a trade, you hesitate, you miss the trade. When it comes back again, you're scared to touch it again, because it's very possible that they're going to go through. And so it's demoralizing. You sit there and you track it and you watch it and you see it and you hesitate and you don't get in and you miss the trade. You beat yourself up, and then that can lead to making more stupid mistakes, or ultimately it makes you feel like giving up as a trader, because you can't pull the trigger when you get there. So again, when we can start focusing on some of these things on the tape, hopefully that will help individuals to get that that speedy confirmation. You obviously have to have a method you trust. This is something that's hard to back test. You have to almost do it in real time going forward, because you don't have a back test engine that can run the tape and interpret what you would interpret out of the tape. So you kind of build this as you go forward, and then as fast as you can start trusting that, that's where you're going to implement it. That's one of the reasons why I've encouraged individuals to take their existing setups that they're already comfortable, they already trust the setup, and that way it's minimal uh, things have to change in order to implement the tape into it. If you say, I'm going to throw out everything I do and I'm going to go look at Joel's chart and I'm going to look at his tape, but well, you may be months trying to get this thing figured out. So let's talk about the other two factors on the tape. Um, Results. What am I referring to here? Let's imagine a scenario where you've rallied up and you come up into a high, and as you come up into this high, you see a tremendous amount of selling coming into it. And let's say then that you chicken out and you hesitate and you don't get in the trade, and big size is just flooding this thing, but they can't push it back 2 or 3 ticks. And you watch, let's say we're watching the S&P, just so you can compare scale. We're watching the S&P, and you watch literally thousands of sell market orders hit this, and they can't knock it back 2 or 3 ticks. And we have seen enough come through to say this is not profit taking. This is initiation of new trades. And so at times when we hesitate, we get lucky and we find something like this. So now we're watching it going, what in the world's going on with this? And so we might sit there for 6, 8, 10 minutes, and over the course of that time, we may see 30, 40,000 sell market orders go by on the tape, and they can't push it back more than 4 or 5 ticks. What does that tell you? See, they cannot get anything for all the size they're throwing at it. They're getting no results. So they're trying as best they can to come in and reverse this market, to knock it back down. And somebody so big, that they weren't anticipating them being there, but somebody very big has stepped up and they are absorbing all of that order. So we sit there and think at that point, then couldn't we say that that's really it's about all we can compare it to is divergence. They cannot get any results for all the size. You know that normally 40,000 coming in at the market to sell is going to knock price back 5, 6 points. And now all of a sudden they can't knock it back 5, 6 ticks. Can that be an indication to us that we need to take that where it is 5, 6 ticks down and consider going long? I have watched traders who would do this deliberately, and they would hold a level and buy and buy and buy and buy a level, and they would allow it to come back into them. They would actually try to allow the appearance of a breakdown,
and they would allow the appearance of a breakdown because they were trying to get 1-2 lot guys into going short. They wanted more to buy, and so they would back it up. After doing this, they would back it up another 2 or 3 ticks, and you would see another flood of 1 lot sell orders hit the tape, and then all of a sudden they would sweep 3, 4, 5 levels and literally take out 15, 20,000 contracts and just go blazing right through the high. So if we spot something like that, that can be a very beneficial thing to consider going for the breakout. Now, is this something that I personally would sit there and watch for? Would I deliberately hold off all entries and just sit there and watch for them to get no results for their size? And I would say no, personally, I would not make that my strategy. You don't see it as often. But where I see this is frequently when you miss an entry and you're sitting there cussing yourself and you realize it didn't go anywhere. And you start to watch and you watch and watch and watch. All of a sudden, it creates a situation where you could take a fairly low risk trade from the standpoint of dollar risk. You don't have to risk a whole lot at that point to find out whether or not you're wrong. And the potential gain, not only can you get the run to the high, but you can get the run through the high. And if they were able to sucker in 15, 20,000 shorts, those shorts are going to stop out within a tick or two of going over the high. So if you can get through that, you may very quickly pick up a little 2, 3 point explosion and out where you only needed to risk, a point or 5 or 6 ticks on the S&P to get that. You can get yourself a 2 to 1 or 3 to 1, uh, when you're looking at the potential reward. So, like I say, I wouldn't personally make it my only strategy, but if you recognize it, it's definitely good to pay attention and decide whether you want to trade along or not. The final point here, the interest. Um, this is probably correlated fairly closely to control. But when I think about interest, you can tell at times, let's say on a rally, you can tell that there is just absolutely no interest in selling that. You guys have probably seen that move that just it runs from one side of the range to the other side of the range. It goes from low of day all the way up, all the way through the entire first hour and a half trading session, and it does it in one continuous move, and you don't ever find any interest from sellers. You'll get 2 or 3 prints, and then the whole screen is green. 2 or 3 prints, the whole screen is green. 2 or 3 prints, and at some point again, you will start to see some interest or some nibbling at the sell side. So it's very closely related to control, but it is something that's important for us. If we see that there is absolutely no interest, there can be some specific strategies for entering on that basis. I have showed some of you what I refer to with it, um, in this type of a scenario is basically coming in on a tick chart, correlating this back to a tick chart. And if we correlated that back to a tick chart, we may be looking literally for just a 2 tick pullback. And again, we're talking something like the S&P where it's not going to wiggle like the NQ would or the crude or the Dow, but something where literally there is so little interest on the sell side that there's a hesitation, teeny little bit of selling, you get a 2 tick pullback, and then the buyers are right back on it. If you're doing that, one thing a guy can do is if you remember the number where it's stalled, and you remember this from looking at the tape, or you look at your tick chart, I personally don't like stop entry orders, but that would be the type of situation where I would use a stop entry order, and you put that just a tick over where it's stalled, and the next push through, you're in the trade, and if it doesn't push through, you're not. You don't get in. But again, at some point on any rally,
you will start to draw interest from sellers. At some point on any sell-off, you will start to draw interest from buyers. So as we're doing this, um, these are the critical factors on the tape, and you don't have to master all of them. You don't have to master four of them or three of them. You can take one of them and make your whole confirmation for your existing setup, and you can improve your win-loss ratio by that. Now, I've been asked before, which is the most important to me? To me personally, for my trading, I like speed, and secondly, would be the control. Um, I don't pay as much attention in my own personal trading to the size. I'm not fixated on it. Yes, I want to see some size come in, and uh, that's changed, as I mentioned yesterday, from October of last year, where I used to look for one or two large orders. Now I look for a flurry where I get 15 to 20 that just drop into place instantly, and I can see that drop in on my peripheral vision. I'm not necessarily 100% focused adding it all up in my head. I probably do that subliminally to a degree, or I shouldn't say subliminally, but subconsciously. I've always in my head calculated very quickly what's there just based on the size, and it's not that I wouldn't put my pinky finger on the line and say I could tell you within 5 lots what was there, but on a 2,000 lot surge, I think I could consistently tell you within 100 what's there. So I'm not fixated on it, but the speed and the control to me are the ones that I personally prefer. Doesn't mean that that will work best with your platform or with your not platform, but with your setup. But this is just the way that I would approach it, just for disclosure here. Well, the next section here, and actually before I leave this screen, if anybody has questions about any of these 5 items, go ahead and throw it out. If you have a question, just type a yes and hit enter, and I'll wait for you to get your question asked. Otherwise, I'll keep going if nobody puts a yes out there. Okay, so going, gone. We'll close that out. Oh, we got a question. A question about speed. Go ahead, Karen. While she gets that question ready, just in the future, if I ask if there's questions, maybe the fastest thing is just put a Y or put a Q for question, and that way I'll wait and allow you guys time to type your question up. So, but I'm going to just pause here for a second, wait for her question. Uh, Andrew asks, will you be going through some examples? Yes, we're going to try to do some live trading, and we're going to look for these things when we're doing the live trading. So if I cannot do this, let's just say that we get to next week and the market is lousy and we're not able to see some of these things. What I will do for you guys is I will make available to you a little archive of trades, and I will clearly label what we're seeing. Um, if does that seem reasonable to everybody? If we can see it, we'll pull it up and look at it and see it. But if not, I will take some recorded examples of each one of these things and give you just a little 6-8 minute video to watch, and that way you can replay it several times. So I'm going to make a note to myself here to do that real quick. So. And what I'll do is I'll make those available to you guys on my screencast account. And well, actually, I'll tell you what I'll do. I'll put those on the recording. When I do the final recording, I'll just index that into the recording and put them right there with it. Okay, so Karen's comment here, sometimes the orders are coming so fast that it is hard to get a handle on what is happening until it slows back down. And can you cover that at some point? That is it's very true. And I think, Karen, in some ways, tape has or crude has one of the weirder order flows, and I was kind of surprised to see that they really don't have that much bot activity in there in crude, because it definitely can have a strange order flow for the amount of ticks, or I should say, the actual executions that go through, I would expect it to be doing 1 million contracts a day. But I guess maybe in some ways that's just an artifact of having the majority of trades be one lot trades. You don't see a lot of big trades there. So they can come in very fast, and I'm going to go through some drills to try to help this. I want this to make it where it can be second nature. I kind of came to the realization, looking at what I do with tape, that in many ways a lot of it is so automatic. I don't consciously even think about it. It's just there. I've been doing it for 5, 6, 7 years. I just react to it. It's there. I don't even think about it. And I think you guys have helped me, because when someone's asking questions, I have to come back through and find a way to put that into simple terms of what I'm actually doing that I don't even realize I'm doing. But I will go through some drills that will kind of help with that, Karen. Um, a couple other comments here too that Karen made in looking at different markets. I will do that because the character of the markets is so different, that some markets have different aspects of this. And so to record some trades and to record some of this type of behavior, it will be on a few different markets. So we'll definitely make that available. In fact, I'll tell you what I will do, guys. If you don't mind waiting an extra day or two, I'm going to continue just posting up a low quality version each day. But if you guys don't mind waiting an extra couple days when we're done with this, is I will go through some existing recorded trades that I have, and I will put in some call outs and relabel some stuff. It will take me a little bit of time to get it edited together, but as opposed to making this contingent on finding something next week in live trading, is I will just put that in there, period. It will be valuable for you to have, and that way it will be right in there in your recording, one way or the other. So you'll have your daily recording, and then the week after our presentation, I'm only going to be in town a couple days. I was planning on just editing that and getting the whole thing out real quickly. But if you don't mind waiting a few days for the final thing, I will take those trades and do it into the final edit. So, and if anybody wants it more quickly, I can put it together without that and send it to you, but I would prefer just to do it as one piece with one table of contents. So just email me if you want the high quality recording more quickly. The low quality recording will still be sufficient because we're not doing a lot of high speed or movement at this point. So, but that will definitely give you guys some value out of things. Let's continue here with the presentation where we sit, and I've got the question: what happens on the tape when price reverses? Now, we've discussed these elements that are critical: the speed, the size, the control, the results, whether they're showing interest in it. But we're going to take a trade and a hypothetical trade, and we're going to say, here's our scenario. We're looking for reversals. Most of us prefer that anyways. And now we want to ask, how can we identify that? How can we make this work? So here's a scenario, and I've pre-labeled some of this just for the purpose of the next few minutes of discussion. But I would say this: can you guys see my cursor? Okay. Actually, I'm going to try one thing. Can you guys see, you can see a blue circle there? Okay, and everything's recording. So let me just, I will just use the markers on this and the arrows on this, because that will make it a little easier for you to understand what I'm talking about with this setup. Where we're going to be talking about is this move up here. We've had a move that's running up. We see a little bit of selling. You can see this on the chart. You can tell there was a little bit of selling came into it. It ran up again, and sellers hit it again. So this is the scenario that we're going to talk about.
in trying to pick some kind of a reversal on this. Now, this could be a scalper. Um, this could be someone that's trying for 4 or 5 points. But here's what I want to make clear with this. I don't care what instrument it is. I don't care what the price is. We're looking at a general price pattern where it's ran up into an area, and as it comes up into that area, we're trying to identify it as a potential reversal. So if that's the case, I would say this area right in here for a chart reader, that would be an area that would catch your attention because you had a pullback and you rallied again and you had a double top. And by the time that price got down here, it's now evident that that was at least a short-term double top up here. And so when you come in at that point and you break this level, that would be for many people the first indication that you've got a reversal. So let's think about this for a minute, and we're going to analyze this purely from a price action standpoint. Two ways that I would say a guy can trade this type of stuff. One of them is just to have, right here at this level, you're going to have a stop order sitting there, just a sell stop. And you're going to take that on the fact and you're going to say, this is price action. It broke that prior low. And I'm going to enter here and I'm going to put my stop above this high right here. That would be a typical reaction for many price action traders. The second type of price action trader is he's going to come in and he's going to allow this swing low or this pivot to break. And when price rallies back up into it, he's going to try to get short right in here. And he may just put a short out there. He may put a limit out there and let it hit him. He may, uh, he may watch for some type of confirmation. He may look for a topping tail on the candle, or you name it. People will look for various types of confirmation. He may do this on the basis of a fib retracement, but he's not going to take this on the fly right here at this point. He's going to let it break and he's going to let it rally back up. Now, I don't know where you guys fit in that, but I would say that probably would describe what most people would do if they were looking at that type of situation. Now let's come back over, and now we've got a high and we broke the high. And for people that are looking for reversals, again, they're going to start looking for some type of indication that that there's a change, that they want to short. So again, at what point in here would a person confirm it on a chart? And to me, when I look at this, I would say that there's a couple zones where people would confirm this on a chart or enter this on a chart. One of them would be right here. When I look over here on this side, of this equation, when we tried to rally back up and couldn't, I would say that a guy probably would come in here. If a guy was, I would say a decent price action trader, he's going to be getting short right in here. And you have to say, in either scenario, did they get themselves in trouble? Would they have felt some heat? Would they have gotten rocked out of this trade? Would they have gotten decent targets out of it? And so on. Well, you can tell that the guy that got here would have felt like he's in the money and then it comes right back through him. Would he have gone to break even and gotten stopped out? You have to say yes, he probably would. For your information, this is a tick chart and this is about 4 points right here. So if a guy got, a 1.5 move on the S&P, which by the way, this is the S&P, if he would have gotten a 1.5 move, would he have moved his stop to break even? Very possible. Would he have gotten stopped out? Yes, he would have. Same thing would have happened right over here. He got in on price action when it broke this little green candle's low. He got his 1.5, 2 points, and it immediately came back and would have taken him out at break even. So I have to look at this and say, could we have identified something on the tape to get an entry up in this area? And I would say, for any of you guys that have traded with me, you see me do it. That's typical for what I try to look for when I trade. And I think, the guys that have been with me in the room for a while,
would verify that when I trade very frequently, the entries are within 2 or 3 ticks of a high, and we'll run them clear back down towards a low. That to me is one of my preferred trade setups. I like to look at this at the highs and at the lows, and that's what I'm examining. That's what I'm trying to find. So I have to say, if I could have got that up here in this area, up high, this would have allowed me to capture the bulk of a 4-point move, where here I would have just gotten to break even and gotten ticked out. Very likely. Same thing happens up here. You capture 2 3-point move. I'm scaling out, at a couple points and at 3 points. It would allow me to get off a couple targets, and in getting to a couple targets at that point, I've got a runner, and if it goes for the low of the week, who cares? I'm going to be there. And if it turns around and takes me out on that last lot or two, then that's fine. I gave it a chance. That's all I ask for, is give it a chance to break yesterday's low, give it a chance to start down on a daily chart and so forth. So I have to ask then, what do we see up in these areas up top that would cause us to take the trade? So that's going to be the basis of what we're talking about as we go through these next series of slides. The things that we're going to mention here, I'm going to go through 7 different things that we could see on the tape, and this is not, I could probably come up with 3 or 4 more, but these are the ones that would be the most compelling to me. And I don't say that all 7 of them have to be there, but I do say that the 7 things would be there on any given day, and on any given reversal, you will see at least 1 or 2 of these on any reversal. So a guy may look at this and say, I don't need to see all 7. I don't need to see 5 of them. I really like this one thing, and when I see this one thing, that now is going to trigger my trade. So that will be the focus of the next series of slides, is the trade setup, and I'm going to have that little small chart on each slide. But for right now, unfortunately, I'm at 30 minutes. This is as bad as having commercials on a pick and TV show. But I'm at 30 minutes. I'm going to stop real quickly and save this set of the recording, and then we'll pick up again. So if you've got TiVo, just fast forward. Okay, so we're back. Hopefully that's not too disruptive doing that. It takes just a minute to do it because I have to take a 1 gig CamRec file, convert that to an AVI, and then save it. So it takes just a minute to process something that big. So let's get into the factors here, or the things that we would see at reversal points. Again, we're talking about these areas right in here, and I realize this is kind of a small chart, but we're talking about coming back up into that. When I talk about the 1 lot buy order speeding up, does anybody want to hazard a guess as to why that would be significant? Exactly, Brian. Newbies. You think about that. Why would somebody come back in at this point as 1 lot traders? Why would they come back in and enter? And again, if we were to look at this, let me go back. If we were to look at this little green candle here, we see 1 lot buyers coming in all aggressive. So at that point, I would assume that is likely new traders who think this is going to be a breakout. And you will see that very frequently. I think it's ironic as a trader, because I have heard so many professionals say trading reversals is a newbie strategy, and trading continuations is a professional strategy. But I'll tell you what, watch the tape and you will very quickly be convinced that at any little swing high, swing low, high of the day, you're going to find a million newbies in there buying that, and you're not going to see the big guys buying that unless it truly is a continuation. So if that's the case, one of the first things that I want to pay attention to is the 1 lot guys, the new traders that are coming in on this little pullback, and they're just streaming in, going long like crazy. Now again, that would be, when I say speeding up, that would be relative to the original rally that we have here. Relative to that rally, we have the pullback, and now the one lot buyers are coming in all aggressive. That would be significant to me when that is coupled with point number 2. We have the same point on the chart. The one lot guys are coming in and the big orders are gone. You have to say, if that's the case, does that give you all the confirmation you need? Could you take it on that basis? Newbies are coming in, big guys aren't coming in. We don't even have to see sellers at that point to say this at this point in time, and I could be wrong, but at this point in time, this does not look like a continuation move. This does not look like it's breaking to a new high. We've got newbies buying and no big buyers. Now, we might see that change as this moves right up into the high. And again, I apologize, this is a small chart, but we're looking at this little double top. It comes up into that high. That could change. And if big buyers come in right at the top, what does that tell you when you're sitting here thinking about a short? You guys can throw it out there. I'll let somebody answer it. You're coming up into this high for the second time. It's been newbies, and now as you come right into that high, you're getting ready to pull the short trigger, and you see 15, 20 large buy market orders come in. Okay, exactly. So you guys understand this, what's going on. Kevin says wait. Brian says nope. When we're looking at this, it's telling us if we're thinking that's a short and we're looking at it for the reversal, we're getting ready for a reversal, we just got flagged off. Don't take the short. If you exactly, Gerardo, if you got short, be careful. You better be getting out because you might have done the wrong thing. So what do we need to see then when it comes to the buy orders, the large buy orders for the market you're trading? Um, if you're trading a market like crude, you don't see a lot of 10, 15 lot prints. So if you were going to try to sit there and wait for and Karen, I'll specifically reference this to your type of situation. If you were going to sit there and wait for a flurry of large buy orders, you're probably never going to get it. The tape is going to get very frustrating. So if you're trading something like crude and you come up into that type of a scenario, you're looking at it as a potential uh, reversal area. If somebody does place a large order, what are you likely going to see on your tape? Let's say a guy comes in and puts a 40 lot sell market order on crude right into that high. Okay, speed increases. I would define it this way, Karen. I would say you're going to look for what appears to be a bot, because it's not very likely that waiting in the queue is a bunch of 50 and 80 lot traders. You've got a fairly thin dome. You know that most of the orders waiting in the queue are going to be one lot orders. And so you can watch the one lot buyers coming in, and you got buyer, 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 buyer. If there's a large buyer there, what you're going to see is half of your time in sales on your one lot side, your unfiltered side. You're going to see half your time in sales drop in instantly, not a tick at a time. And this is where it's, I think, very critical to have a no time compression on your time in sales. You're not going to see this drop in one tick at a time. You're going to see half your screen. You're going to see 40 or 50 lines drop in instantly. And in your case, that is probably going to be the warning that somebody's buying this through the high. You're not likely to see a 40 lot buy order, and you're not likely to see a 40 lot sell order if sellers come in. If somebody big comes in, you're likely going to see what appears to be a bot. And remember, that is just going to be the execution engine, the way that they're showing prints. That execution engine is just going to put through every single execution. So for you guys And again, I really do encourage people to keep trading the instruments that they're comfortable with and that they like. Don't change to try to copy me or emulate me, but take the instruments that you're already working with and that you already understand and apply some of these things to it. So you have to stop and think about it then, the difference between Karen trading crude and Ken trading the S&P. What Ken would need to see is he's going to have to see that there's uh, no large buy orders coming in. And if he sees those large buy orders, to wave him off the trade, he's going to want to see 15 or 20 of them come in simultaneously along with a big flurry on your unfiltered tape. But for somebody like Karen on the crude, she's going to need to see, to blow the trade off, she's going to have to see a big, huge one-shot push, where everything drops into place like we were talking yesterday. They've all got the same timestamp. They all came in instantly. And she's doing this with an uncompressed time in sales. Then she says somebody just placed a large market order to buy. So you may be anywhere in between there. You trade in the NASDAQ, there's a little more activity. You're trading the 6E, a little more activity. You're going to see some 8 and 10 and 15 lot guys coming through. And so you're going to have to correlate this back to what's normal for your market. Now, remember, we talked about this yesterday. I will mention it again right here. To decide what's normal for your market, you're going to have to come in and say, out of any given 100 prints, what's the big prints? What's the large prints? And then you watch another 100. What's normal? Is almost everything ones and twos and you got a couple sevens? You're going to have to take your instrument and you're going to have to fit this to the instrument that you're trading to decide what you need to see to determine that there's no large buyers, or that there are large buyers, or that large sellers are coming in. Those to me are two critical things, and this would be foremost for blowing the trade off and saying, nope, not going to do it if this happens. When we come back up into that high, here's some additional things that will go on. Very frequently, as you come up into an area, you will see the print slow down. It's almost like everybody's lost interest in it. And if you see that happen, it's very possible that this is going to become a short-term reversal point. It might sound contradictory, but frequently you will see these fire off where you get this big flurry of newbies coming in. There's no big buyers in it. And then the prints slow down and it's just like it hangs there. And you almost feel like, whoa, the platform just froze. And then the very next thing that happens is here comes a flurry of sell orders. So if that's the case, and I was looking at that trade for a short at that price, I would already be in. At that point, I know my parameters. I already, in my scenario, I already know what my potential target is before I run into this low. I know that I've got to get through this one first, but I'm taking the short up on this move here and saying it's time to go. Now, coupled with the flurry of sell orders, I've got a qualifier here, is that frequently you'll see the sell orders come through the first time and it moves price down a few ticks, and then it might take 2 or 3 times as long to recover back up to that. And when you see that happen again, these are things that can warn you that a reversal is getting close. So, you can pay attention to that, and at that point say, time to get my finger over the over the mouse, get ready to click that order in there. So, Pete, I see that you've got your hand up, and I'm not sure if you had a question or if you had just hit that when you put a comment out earlier. Did you need anything specific? Okay, okay. I was just going to say, if you had a question, go ahead and type it in there. So no problem. Uh, Point number 5. This is something that I would say is going to be more visible on the dome, and you'll hear me, if you've ever traded with me, you'll hear me say this a lot. They can't go bid. They can't go bid. Um, what I am referring to, and let's just look at a dome here real quickly. The the dome and let's reverse that for the scenario that I'm talking about. Let's say they can't go offer. Let's assume that in this given point, here's our offer, and let's say that the sellers do clear this level out, and the offer drops back down, and then you see some buyers come back in, and the offer came in fairly small. The buyers come back in and they clear that level out. And so now there's no offer at 2887 in this case for this dome, but the bid isn't here either. Let's just imagine that they're not here. They're not willing to step up to 2887. Now we start thinking about what that means when they can't go bid or they can't go offer. If the buyers will not step up into that, that would be one warning. They cleared out the offer that was there, but now they won't go offer. They won't move up in there and take that level. They won't come up here and hit 2888. If we look at that type of a scenario, that frequently would happen around those turning points. If they come up to a level on the dome, they may clear a level out, but then they won't step in and take the level that they just cleared out, and they immediately lose it. You might look at the same scenario for the sellers coming in. If they got cleared out of 87s and there's nobody at 87, will they take that level back? Will they go offered there? So see, if we're looking at this based on this type of activity, we could reverse that. It could be buyers can't get a level to go bid, sellers can't get a level to go offer. They're just not willing to step in, and what I always call it is firming up. You've probably heard that before, but when we talk about firming up, we're essentially talking about it that they take a level and they're not willing to come in there and build a nice thick offer at that price, or they're not willing to come in there and build a nice thick bid at that price. So you take this scenario, they can't get a level to go bid, and if they do put a bid there, it's a little small bid, and they can't firm it up. They can't get 300 or 400 to join them. If you're on the S&P, they can't get 700 to join them. It just sits there with this little teeny bid, and they will not step into it. Again, those are the type of things that you'll see. You'll be seeing this on your dome as opposed to seeing this on your time and sales. Now, if you're experienced with watching the tape, you will see this on the tape. And the reason that you'll see this is you'll see prints go off, like you'll see 2887 go off uh, green, the where market buyers were hitting it, and then you see 2887 go off red, you see 2887 go off green, you see 2887 go off red. If the same price keeps switching colors on you, it's an indication that they can't get that level. Somebody can't take that level and hold it. And if somebody finally takes that level and firms it up, then it's going to go that, they're going to take it the other direction. I don't know if that makes sense trying to explain it that way. I think when we put a video here showing this, it will make more sense uh, to that. These are some things we're going to be looking for later, and I will definitely have examples of these things in the video. But when we come in and like Brian says, the bid dried up, they're not willing to step in and bid there. It's a good indication that we've got a turning point. The dome, again, if we have a small offer that's sitting out there, some markets you'll see this where the offer will get down 2-3 lots, little tiny offer sitting there, and the buyers will not hit that and clear it out. They put a little small bid out there, and the reason I talk about this in this scenario is you don't just have an instant reversal. Even on a V bottom, you don't just have an instant it printed and it's gone and it never came back. That's the 1 out of 10 thing. You will always see these little scuffles, little fights. It may last 30 seconds, it may last 2 minutes, but you come in there and you think about that. In our particular scenario where we're sitting here looking for a short, is there's a small offer, the sellers have not jumped on it yet, but the buyers that were there will not hit that offer. They're not going to go market buy there. And then when you got the bid over there and somebody steps into an empty slot like crude or like the NQ or the YM, where you do see a spread open up here and there between the bid and the ask, the bid steps in and instantly a seller hits it and it's gone. Bid steps in, instantly a seller hits it. Those are little clues that you've got a reversal coming. And then I would say this would probably be frequently your final confirmation or your last thing that would happen, and that would be the big sell orders. And remember, we talked about this yesterday. The way that they're showing this to us on the tape, it's going to look like a bot order where half your time and sales drops in at once. Or if you're trading, like something thin, uh, to see the large sell order, it may be 2 or 3 screens worth of time and sales that just blur by instantly with the same timestamp, and they're all sell market. So when you put that sequence of events there, it really helps us to appreciate that coming into that reversal, you've got a reversal on a chart pattern. You're coming into a prior high, you're coming into a resistance area, and so forth. Um, Now you've got the clues to look for to either say no, not yet, not yet. But at the same time, you have to say this: um, what happens at this point in time on your tape? It may not give you the confirmation to enter, but it may not blow the trade completely out of the water and say forget it. You may see it get one tick higher and then the large sell orders come in, and you were just getting ready to blow off your short and they make a one tick new high, and all of a sudden we got sellers coming out of everywhere. And then you say, okay, screw it, I'm still going. It didn't get high enough beyond it to convincingly convince me it's not a breakout. So you may still take that trade. So the thing that I want to point out is that just to watch for those things on the tape without looking at a chart probably won't be beneficial. That's not how you would trade strictly from the tape. And the reason for that is when you think about all the things we discussed: speed up, slow down, big sellers appear, big buyers appear, they disappear. Those things happen all day long. But when we come into a level that we've predetermined as a dynamic level, like we're coming into a moving average, we're coming into our Keltner band, and we see this activity starting to occur, and we say, that Keltner band just on its own is a 50-50 trade. That moving average on its own is a 50-50 trade. But coming into that price, if I see this on the tape, I'm going for it. The static level, we come into a prior high. I actually prefer, most of you guys that have traded with me know I actually prefer to see 3-4 tick new high on the S&P and just get a little poke above it, because frequently that's where big sellers are lurking, waiting for that new high. So when we come into one of those levels, we should be able to have a trade defined that is fairly clean. We look at that trade setup and we know this is step one. We've got a price level. Step two, that's going to be these factors on the tape. And when I see those factors on the tape, step three, I'm entering the trade. That's the process that I've used for nearly a decade um, of profitable trading, and it's been through any type of market conditions that have existed in the last decade. I've done that on stocks, I've done that on indices, I've done that on commodities, and it's worked on every one of them. I don't trade options because I can't speak Greek and I can't understand options. I never wanted to waste my brain cells understanding options. I figured if you got to have a computer to figure it out for you, then it's probably beyond what I want to play with. But any market condition, I've traded this year after year after year profitably, and it's worked. So to apply this back for your own use, I would say define 2 or 3 of these things. You start trying to recognize these things, and as you recognize them, look for them on your existing setups. If you're already looking for reversals and you're looking for a reversal confirmed by uh, by an indicator or two, take a shot at that And as your indicator is telling you to go, you got to bear in mind that's probably a little bit delayed. It's a little bit lagging. But as you're coming up into those price levels where you might be looking for the reversal, ignore the indicator for a minute and look at your time and sales for these factors. See if you can identify those. Start experimenting with that, and try to do that before you throw what you're doing out. Try to take this in and replace something that probably doesn't matter as much and that will just slow you down in the long run anyways. Now, I ask this, and I think this is one of the most important things that you can get from tape is, what is the best thing you can get from the tape? And I really do think in some ways the best thing that you can get from the tape is the ability to avoid a loser. If you've got a setup that works fairly well, you're still getting stopped out 5 out of 10. Can you dodge a couple of those losers by what you see on the tape? So let's go back here, and we're going to go to, hopefully I get this right. We're going to go back to this point, and let's imagine that we see exactly the opposite. Let's say that as we come up into this high, the one lot buy orders disappear. Newbies aren't buying. Let's say that as we come up into this high, not only are the newbies not buying, but we see that large buy orders are starting to come in. Let's say that as we come up into that and those buy orders are coming in, that they actually speed up coming into that high. Let's say that instead of a flurry of sell orders, we just have 2 or 3 orders that go off, and then more green, and then 2 or 3 sell orders, and we get the impression that they're taking profits, just in case, not that they're initiating new positions. Let's say that the levels, instantly when they take a level, buyers are stepping into that and they go bid there. They clear the offer out, they immediately step up, they go bid at that price, they firm up, thicken up, however you want to define it. You get to your dome when there's a small offer out there, it's immediately hit. You get the bids that are put out there, they're not cleared out. And then any sell orders that come in at that point, let's assume they're not there. See, we went into this with a total impression, um, of what was going to occur, and it didn't happen. So if that's the case, um, we got flagged off of that trade. Are we going to trade it both directions? You can. It just depends on how comfortable you are. If you don't mind flip-flopping back and forth either way, you might have gone into this with the expectation of a short, and you may turn right around and go long because of what you see. It can give you a trade either direction. A guy that's looking for continuations, what triggers you in as a reversal trader is going to keep him out as a continuation trader, and vice versa. So you can keep that in mind. Um, I've got a comment here about that, time and sales properties. I'll tell you what I'll do. I'll email you just a snapshot of that when we're done, and that way you don't have to go through the whole video to get to it, since you need to take off early. That way you can just look at that and make sure that yours are matched up. If anybody else wants that, I'm happy to send that to anybody else if they want a snapshot of my time and sales properties or my dome properties. I'll be happy to send a snapshot out. Just throw it out here in the link, and I'll get your names before I close out. So the uh, the factors that I see here, again, if we can come in and we can take uh, these factors to confirm the trade or to blow the trade off, typically we're going to eliminate 1 or 2 of those losers that we would have gotten. And it doesn't mean we don't have to be 90% win loss to be profitable. You know, I'm sitting just shy of 74% for the year, out of all the trades that I've executed. I've had very profitable years and very profitable trades, where I was running 50%, because of management. But if we can get to 60 or 65, you can print free money as long as you can sit on a trade. The The drills, we'll go through a couple drills real quickly, and then uh, we'll allow some questions, and then we'll call her a day. We're just over 2 hours right now. Uh, First of all, when you look at your time in sales, one of the things that I encourage people to try to do is to put your time in sales right next to your dome. Don't look at the dome, look at the time in sales, and try to figure out where the bid and offer are, and then look at the dome, make sure you're right. Look back at the tape, figure out where the bid and offer are, look at the dome, make sure you're right. To me, if you want just like a memory aid, the bid, if you're configured correctly, the bid is red and offer is green. We got 3 letters, we got 5 letters. Bid is red, offer is green. Does that make any sense? Probably not. I'm kind of anal with little dumb memory things like that. But anyhow, I tend to look at it that way. Bid red, they're both 3 letters. Offer green, they're both 3 letters. So I see a green print, that's where the offer is. I look at the time in sales, I can tell you automatically where the bid and offer is. And if I see that flipping back and forth, back and forth, back and forth, back and forth, I know they're not firming up. They're not able to hold it. So start trying to work on that. Do that around times when it's dull and you're trading. You're not near levels that are worth executing. But just sit here and look at that and see if you can identify where the book is. Where the bid offer spread is. Next thing that I would encourage people to try to do, if you know what delta is, fine. I'm going to give a very simple definition. The bid-ask delta, what that refers to is you take all of the trades that are executed at the bid, and you take all of the trades that are executed at the ask. So we're talking about actual executions. We're not talking about the volume that's out there on the bid and the ask that's displayed in the book, but we're talking about the actual executions that went off at the bid. So we think about that. All of the trades that executed at the bid, that was market sell orders. And all of the trades that were executed at the ask or the offer, that was market buy orders. So if that's the case, they're going to take all of the market buy orders, everything that hit the ask, they're going to subtract everything that hit the bid or all of the market sell orders, and that's your delta. So if you had 1,000 buy orders and 200 sell orders, your delta for that candle or for that period, it would be 800. If you had 1,000 buy orders and you had 2,000 sell orders, your delta would be negative 1,000. Now, there are little indicators that you can use. You can put that on your chart to track that. And Ninja has some on their forum. I've got to brag about Karen, whether she wants the credit or not. She's got one that she's made that's very nice. I actually like it better than anything on Ninja's forum. But I would say, to me, I track that in my head. And could I come on the nose to the number and line up with Karen's indicator? No, I couldn't. But I could tell you whether the delta was positive or negative. So as you see those prints go through, if you're kind of keeping track of it in your head, see if you can start to figure that out. Grab the indicator off of Ninja's forum and put that on there, and then don't look at it and try to figure out roughly where it was in that candle. Now, if you can't do that, at least try to figure out whether it's positive or negative. The more buyers at the market or more sellers at the market, because that is what moves the market. Market sell orders drives it down. Market buy orders buys it up. If you go back and look at let's say you take a 1-minute candlestick chart day after day after day, and you have the delta of those candles, about 98% of the time, every green candle, every positive candle that closed higher is going to have a positive delta, and every red candle, 98 times out of 100, is going to have a negative delta. There will be some times where there's a little bit of divergence. Some markets are a little bit different. Crude frequently tends to move because people pulled their offer more so than because there was a lot of buyers that went through it. But generally speaking, your delta will be whatever color the candle is. You'll either be close to neutral, you'll be positive on a green candle, you'll be negative on a red candle. But if you can try to do that, uh, it can be a very handy thing to kind of run that in your head. Yeah, Kevin, you mentioned that there's a program called Market Delta. Um, the problem with that for many people that try to switch to Market Delta charts, like the volume footprint charts, is it can give you a historical perspective, but it can also make a chart that takes a lot of thought to figure out where price actually went and where it traded. And if a trader had never looked at anything else and they learned on Market Delta, I think it would work great. But for people that have been looking at candlesticks for a couple years, to go back to volume footprint, it can take so long to process that it's not hardly worth it. That's what I really like about what Karen's done is simple. Yeah, you got buy sell volume on Ninja, which will give you that. You have to have your platform on and running. If you switch charts, it disappears and starts at that point. I believe it's not one that continues to record or update. We've got a question within what parameters, meaning do you calculate delta based on time or is it regardless of timestamp? I personally tend to do that more on the basis of swings in price, swing high, swing lows, it pulls back. What was the delta when it starts changing? Where does the thing change? I don't think that you have to sit there and know this. I think it's probably more valuable for guys that are using minute candles than tick candles. We're going to go through some of that in subsequent sessions that will clarify that a little more. But the point is, if you can kind of figure out where the delta is by looking at the tape, then you don't need the other things anyways. You can sense that the sellers own it. They're dominant. You check your delta. Yep, there was 2-to-1 sellers in that candle. You watch the next one. You feel like the buyers own that one. You check your delta when it's all done, and don't cheat. Don't look at a candle. Don't look at your delta footprint or your volume footprint, whatever you're looking at. Look at the tape, decide what it is, and then look at the candlestick and see what happened. Were you right? Did they truly own that candle? So Karen made a comment here that she's kind of getting the indicator cleaned up so that it works. It was limited to version 6.5 and trying to get that cleaned up and working on version 7. And she says when that's done, she could offer that for a very modest fee. It is a handy. I've looked at it, and for gaining a little bit of a historical perspective on that, I definitely think it's a lot cleaner than the one that's on Ninja's forum. It's definitely a lot cleaner than um, uh, like the volume footprint. Um, I think for what Karen has done, she has paid some individuals to do some programming for her, and if she could defray that expense, it's probably more than fair um, to do that. So if anybody's interested, let me know, and I can pass that on to Karen, and just send me an email if that's something that you have some interest in, and if you guys don't mind, I'll just forward your email to Karen. So. Tom, just send me an email because if it's on this chat session, I probably won't remember to send you that. So just send me an email and mention that you would like to know when Karen's got that ready, and I'll give your email addresses to Karen, and Karen can contact you when she's done and let you know what she's going to do with it. So another drill here. Let's go through these and we'll get finished up. Um, when you're looking at your dome, we were talking about whether or not the bid can stay at a level, or whether or not the offer can stay at a level. And again, I think it's beneficial to be able to track that off the tape because you're already watching the tape. At that point, if you can see it on the tape, it just eliminates having to stare at the dome. If you can't, you can't, but I would definitely say try doing it. And so what you want to do is go to an instrument like Crude or the YM, something where you frequently will have a one tick spread come in there, and watch them jockey back and forth on the tape, and then try to determine whether they're able to come in and take a level and hold it. And what you're going to see when you do this is you're going to come in, let's just say we're talking on Crude at $80, and our spread is 80 by 80.01. So they come in at even, and we've got prints at even, and then we have prints at 01, and the color is the same. Now, if we have the same color prints at 0, at even, and then we print at 01, we know price just moved up a tick. But then if it immediately moves back to 0 and it's still green, we know they couldn't hold 01. They couldn't keep 01 bid. They lost that, and 01 is now offer. So as you go back and forth and watch this, you can see it easily on your dome, not as easy to see on your tape. But if you can see that on the tape, then you can pay more attention to the tape. Again, you don't divert your attention to two things. You're able to watch it on one. Will it melt your brain after a while? Yeah, but try it for 5 minutes. Keep your dome there. Keep it far enough away that you can't cheat, but kind of focus your eyes on the tape and see if they can hold that. It can be a very beneficial drill. And then finally, I would say, especially if a guy is trying to trade without frequent use of charts, but he wants to take some levels off of charts and then he just wants to trade off of the tape. The drill that you're going to have to do, the thing that you're going to have to do, is you're going to have to create in your head an imaginary tick chart. So you can start at any given point in time, and you could even draw it on paper if you want to, but it can be very effective. As you sit there and watch this, you see at current price where it is. Keep in your head what it would look like as a candlestick and where you are in that candlestick. You're right in the middle, you're in the bottom third, upper third. And so as it expands out and we wiggle back and forth, up and down, in your head, you're building a candle. And try to make a little tick chart. Try to make a little chart in your head and figure out where the top of this candle would be, where it keeps getting rebuffed, and figure out where it would be on the low side, where the buyers come back in. Because that's going to be something that you're going to have to be able to do, essentially, if you're going to trade without the chart. You're going to do this in your head. So if you're going to try this, do this on the YM. I would say this is the easiest instrument to do this on for this drill. Is go to the YM, start building yourself a candle in your head, let it wiggle up and down, keep expanding that out. If you have to say it out loud, say it out loud. 58 by 59, 58 by 59, you're watching it. And then it expands out, 58 by 60, 58 by 60, 58 by 61, 57 by 61. They push back down. You keep expanding that in your head. And if you got to say it out loud, say it out loud. Once you start getting that bracket, at some point that bracket will become large enough that you can trade it as a scalper. And at some point you're going to be able to take that bracket, and when you break that bracket and you get a pullback into that bracket, in your mind you would view that as a Fibonacci retracement and you're going to take a trade. But this drill is where you have to start doing that. Now we're going to talk more about that type of trading later, but for right now, this is where you have to begin. Is you've got to sit there and say, in my head, here's this candle, here's the high, here's the low. For a beginner, do a high-low bar. As you get better at it, you'll almost subconsciously, you won't just have a high-low bar. You'll have a candlestick where you've got your open and close. You know where you started tracking it. You know where it went for lows. You know where it went for highs. You know where you are right now. And not everyone can do that. If you can't do it, don't feel bad. I've always said I don't think one person out of 1,000 could, but a couple here have asked about that and wanted me to address it. So I'm going to show you how to do it. But I would say if this gives you a headache after 5 minutes, don't waste your time, because you'll still be getting headaches in 3-4 years. And there's things on the tape that you can take out very quickly. There's no reason to take 3 or 4 years trying to do this just so you can trade without a chart. I will stop there. If there's any final questions, throw a yes out there, and we'll address the questions. And if not, we've got I don't know where we're at. I guess we're about 2 hours and 15 minutes, 2 hours and 20 minutes. And if not, we'll stop there for the day before we all have a mental meltdown. Like I say, give me a yes if you got questions. Otherwise, we'll go ahead and bail out and call her a day. Appreciate that, Andrew. Thanks. So you guys go ahead and just put your questions in. I got a couple that have questions, so go ahead and throw that in there. And In fact, while you type those questions, I'm going to stop my recording and save that. I don't want to go too long unless the questions are real brief. Yeah, Kevin, whole thing is on video, and you should have gotten an email from my account at YouSendIt, and that account has a link to let you download. Yesterday, um, like I said, I had to re-record that, but there will be a link each day. It actually, I was able to edit it together very quick and put a very brief table of contents in. So I will send a link each day. I will go back through for the time and sales and the dome properties. Let's go ahead for those that wanted it. It's out there, and I will pull that out of the log before I close. I will jot down who wanted it and send it out to them. Actually, you know what? It'll be easier. I'll just send it to all of you, and then if you didn't want it, just delete it. I'll just send a snapshot to everybody. That'll be easier than trying to write it down. Can I do the drills on the 6E, or does it not lend itself for what we learned today? Some of the drills will work better on the YM. I would say especially the last one, where you're trying to build the candle in your head. It will be more effective trading the YM than it will the 6E. But you can do the drills on the 6E. You can do the drills on anything. It obviously would be easier to do the drill on gold because they're coming in slow, but it really doesn't matter. I would say if it's hard to keep up, go to GC. Go to your uh, December GC or your February GC. I can't remember which one's becoming active right now. Should be rotating into February gold pretty soon, if we haven't already. I can't remember where we are. November 1st. Yeah, we still have a few days on December GC. But if you can do it on the 6E, do it. If that's what you're looking to trade, Sean, do it on the 6E. So, it's not, there's no wrong answer there. But I definitely would say of all the instruments that I've traded without having a chart up and visible, the YM in reality is by far the easiest, and it's probably the only one that I would do it on a consistent basis if I was going to do that day by day. I wouldn't mess with it on the S&P, wouldn't mess with it on the 6E, wouldn't try it on crude. They just don't move in a pattern that works with the way my brain processes. So, well, I think that covers everything for questions. Don't see anything else coming out there. I appreciate all the comments and the thank yous from everybody. And like I say, I will have a video up probably within a couple hours. And it will just be a low quality recording that you'll ultimately want to delete at the end. And if you don't want to download it, don't worry about it, because we will have the full recording later. So I appreciate the input and the questions. I have only received a couple trade setups, and so if you guys still can take a quick snapshot of where you like to take trades and send that to me, that would be great, because we can give some personalized advice for that. Um, I won't be talking about it for another day or two yet, but if you can keep some of that stuff coming, it will be beneficial for everybody. So thanks again, everybody, and you guys have a great day. Like I say, I will send out everybody a snapshot of my property, so we don't have to worry about that. And anybody that's interested in talking to Karen, send me an email, let me know that, and I will pass your name to Karen along with your email address. And I'm assuming I have permission to do that. And then we'll be back in at 12 p.m. Eastern tomorrow, and we'll again be right about 2 hours or so. And at least this time we know we got the recording of it. So thanks again, and we'll see you tomorrow. Okay, we'll do a quick sound check. I was having a little bit of trouble with our sound this morning. Does everyone have sound? If you do, give me a quick Y or a yes. Sounds good. Looks like we got sound there. Had a little bit of difficulty with it and didn't realize the headset had gotten knocked out of the USB port just slightly and wasn't connected. So sorry, we're a couple minutes late. Welcome everyone here to our third day of the mini mentorship on tape reading.
and hopefully you guys got a little bit of rest after yesterday. Sometimes it can be kind of confusing. You going through some new things, some new ways of thinking about the market, and we're going to try to keep it a little bit simpler here today as far as our content goes. And probably some things that are fairly basic for most people, but I do think it's beneficial as a trader to look at these things. To begin, I'm going to put a poll up, and bear in mind the poll is anonymous. Can't see how you vote, and I will put up the results of this when it's done, just so you can look at the percentages. But you should be given a choice here in a moment. And read down through these options. What we're going to talk about is sim trading or simulated trading. And we'll just allow a minute until everybody has a chance to answer to this. And like I say, just be honest with it. We may tailor the presentation a little bit depending on what people say in terms of a response. So I'll give just a minute here for everybody to fill that out. Okay, so I'm going to close this out. I do show that everybody did respond to the poll. This doesn't show me who responded or how they responded, but it does show me that 100% of you have had an opportunity to vote. So whether that's accurate or not, I don't know. But here's what I'm going to do, and we'll just let you take a look at what the response was across the room. We got 42% that usually trade live more often than they trade sim. We've got a quarter of you that usually will go to sim either after one loss or a series of losses, and you'll go back to the sim and try to figure out what was going on. And then we got about 1 out of 5 that occasionally trades live, 1 out of 5 that's sim only that are still learning. So the numbers on that, I have found that over the years of working with people, virtually everyone that I've worked with started out on sim and stayed on sim for quite a great deal of time trying to learn not only the platform but learning how to trade. And so when I look at that, I do see some dangers, and I've seen the dangers for years. It used to be going back until about a year and a half ago. The only thing I did was private mentorships, and it was just a word of mouth referrals where people referred me to their wealthy buddies. And so I have been able to observe a number of the problems that come from sim trading, and that is going to be a bit of our focus today. And I'm going to make some suggestions here today that I would usually do in a private mentorship with someone. And this is going back where individuals were paying $15,000 for a private mentorship to have me come sit with them for a week. And I'm going to show you the same thing that I showed them. So take it for what it's worth. I want it to be something that's of value to you, and hopefully you can think about this and put this into your trading plan. But we're going to get going here. You should be seeing, well, I've got a defect it looks like on there. Let me change this. Again, standard disclaimer. One thing I will point out about that today we are going to talk about some hypothetical or simulated performance, because we're going to be taking a look at some charts. And as we look at those charts and we talk about those charts and we're talking about trades, it's obviously not trades that we've taken with real money. So just so you know, when we talk about how things could have gone, would have gone, or should have gone, it was hypothetical because we're just analyzing charts and looking back at it. So the topics for today that I want to go through, first of all, I am going to talk about sim trading. And as I mentioned, we'll make some suggestions there. I'm going to take a look at a few things that you can use. And these are things that I would say they're not as clean as tape, but these are things that you can use um, if you cannot figure out the time and sales. If you fight it and fight it and you spend a few weeks trying to figure it out and you just can't get comfortable with it, here are some things that will get you reasonably close. We're going to go through an action plan for the day's trading, and I'm going to just show you on a platform the process that I would work through or think through in my mind to start my day. And I would do this a few minutes before the session typically. And that's what sets out for me the map that I'm going to follow for the morning. And then I'm waiting to see what price does and where it goes. And then we're going to talk about some of the advantages of using price levels. Some of you are using, indicators. Some of you are using other methods of filtering or triggering trades. But we're going to talk a lot about picking good price levels and why that's important. And then we'll conclude with something that's just a fairly basic exercise. We're going to look at a couple of markets, and we're going to see what we would consider to be relevant size if we were going to put filters on and run 2 time in sales, just so that we could have something that was a little slower for the bigger traders. So that's kind of where we're going to go today. The sim trading, if I could get some feedback from you guys, I would appreciate it. And what I would like to see, if you guys don't mind typing in here, uh, reasons that you can think of to sim trade. And I'm going to allow a couple of minutes for this because I'm always trying to figure out why people do things and why it makes sense. And we started out with a poll, and we realized that uh, not one person selected no, they trade the live account only. So everyone in here is in the same boat. Everyone sim trades. But if we could get some reasons for that. So I'll just give 2 minutes here and you guys give me some reasons to sim trade. And again, we've got a couple in here that are newer to trading. We're just referring to the simulated accounts that are available on most platforms where you can go in and place trades, manage trades, and so forth, but it's not with real money. So I'll share some of the responses here, and and you guys obviously have some points or some reasons that make sense, and some of you may be looking at things very specific to your situation and so forth. But we've got some nice comments here, and so I'm going to just mention those. Unfortunately, what happens if I try to display this to you, even if I put this list out into the display monitor, GoToWebinar will not display one of its own windows. So I could have this sitting right on top where I couldn't even see what I'm presenting to you, and you won't see it. So I'm going to share a few things that ones have mentioned um, as a rationale for taking trades on sim. One of them, the markets change and you continually lose. So we think about that, person that has been trading a while, not doing it to learn their platform, but they just see some changes in the market and all of a sudden they're getting tore up. Uh, One says we can't lose any money, but you can't make any either, though. Um, I've always told the guys in the room, I get a kick out of it. We joke about our sim lunches in there, but the problem that we run into frequently with that, like as mentioned, you can't make any money, and you're putting a lot of effort there for nothing. We've got some that use it to test out a strategy. Some that say they're new to futures, and so the setups that they were using trading news and earnings on stocks don't work on futures. So they're trying to develop some trading setups. And sometimes one says it does it when it doesn't feel in the mood to trade. One says to get familiarized with the order entry platform. Another one says that they sim trade if they've lost the limit for the day and want to see if they can figure out what was going on. And then makes a good point that otherwise it's like a video game. Doesn't really, doesn't really do a lot of good. Uh, to practice this setup, when I'm too busy to trade live and pay attention to the market. So, and I would say that in that case, you're analyzing yourself pretty good. You're recognizing a situation where you could be in trouble. Uh, distracted. It's not a good place to be trading from. Um, Another one says that once they've taken a loss, it's easier to pull the trigger on a sim account than on a real account, and there's no money at stake, so they're not risking more. But the problem again that he's pointing out, that he can't make back what he lost. Uh, another comment here, a little lengthier comment: to learn the platform, learn the method, to get confidence, and so they're relating some of the sentiment that they've gone through. They went through a period earlier where they became gun shy due to losses, and then the sim trading made it worse. And so they say now they only sim to get to know the platform, and a few sims to make sure they're following the rules to a new method. And the point that is made here by this gentleman is the same viewpoint that I've had of sim trading for many years. He says sim actually lowered my confidence. And I'm going to go into some of the negative impacts that I've observed from that um, over the years. A couple final comments here. There's a lack of consistency, so fear of blowing an account out again. And then another one that says looking for a result to believe in, or basically, like some others have phrased it, trying to get the confidence uh, in a strategy or in a method of trading. So when when we look at those reasons, obviously you guys have thought it through, and there's a reason that those things feel comfortable. And what I wanted to do is I wanted to compare the list of things that you guys came up with the list of things that I came up with, and then I'm going to explain my list on that. So for my list, here's what I have down. Number one, to learn a platform. If you've uh, ever switched platforms, you realize that it can be very difficult to go from one to another, and all of a sudden you're just getting torn up. You can't figure out the buy buttons and the sell buttons, and you're not sure how the strategies work. Like on NinjaTrader, and you're trying to program the ATM strategy, and you want to make sure that the strategy is going to function right. Um, you need to be able to do that on Sim. You don't want to put a live trade on that you're intentionally just going to close out at a loss just to make sure the strategies work. So when I look at it from the standpoint of learning a platform, I do see a lot of value there, because you can take live market data, you can put that on, you can make sure that automated trade management strategy worked correctly, and you might need to check the entry types, the order types, make sure that the trailing stop is working correctly, and you can't really do that unless you have that running on market data. And who wants to do that with real money? Just they're not taking the trade for any reason other than to get the platform down. And so I see a lot of value to that. And I appreciate that with Ninja, that you can freely go back and forth between sim and real. And I used it in the beginning, like everyone did. I wanted to make sure I understood how those trade management features worked. For some of you that are in here, like ones that have migrated over from trading stocks, maybe something you've never even seen before is the platform, the NinjaTrader platform. Others are using TradeStation across things where they've been able to use that platform for equities and futures. But it is definitely a valid reason there. Here's reason number two that I came up with. And even when I thought about it, I still couldn't come up with anything other than things I've seen that will hurt people. And while you guys make some points that seem valid at times, I want to take a look at the destructive side of things, and the almost the illogical or the unreasonable side of sim trading, to show you why it can be damaging. But I also want to show you a way to get out of that, and a way that will do that without hurting you financially. So when I think about sim trading, here's what I think. We're trying to learn how to trade, and we're going to use an analogy with sports because it seems like we all can relate to sports usually. So we're talking basketball here. Um, for you overseas guys, I probably should have had football or something that is popular over there. I don't know how popular basketball is around the world. But let's say you've been selected. You were drawn to shoot a free throw on a basketball court in front of 20,000 people, and you get 10 grand if you make the basket. Now you think about a scenario like that, you realize there's going to be a lot of pressure, there's a lot of money on the line. but they've given you 1 week. So I want to think about that. How would you go about preparing? What would you do? I would think that if we asked everybody to put a comment out here, most people would probably say they would head down to the basketball court and they would make sure they had a regulation basketball set to regulation pressure and a regulation basket, standard height, and they would shoot free throw after free throw after free throw over and over and over until the minute they had to walk in there and shoot that free throw for 10 grand. But I have to say this, how many of you would come in here and say, well, I'm going to take a basketball out in my backyard and I'm going to just throw it up in the air about where I think a basket would be. And I'm going to do that for the week. So if you put it into a perspective like that, it makes it seem ridiculous. I mean, you would have to say that all of that work, everything that a person was going through, did absolutely nothing to prepare you for reality. So I'm going to talk about a couple of experiences real briefly that I went through that I personally observed with others. And it's kind of humorous. I will say this just in fair disclosure, fair warning to people. Um, today's session is not going to be so much about tape reading. And so if someone's missing work or someone's having some trouble, just bear in mind that we're going to talk about some practical things, but it's not going to be a necessity necessarily for the tape reading itself. It's talking about trading in general. So, and we've got a couple that just came in. I'm going to just bring you guys up to speed real quickly. We're talking about sim trading and why it's destructive. We put a poll out. Everyone in the room does trade sim at some point. Sometimes it's sim only just for learning. Sometimes it's occasionally live trading, but usually sim. A quarter of the room usually goes to sim after a loss or a series of losses, and just shy of half of the room trades live more often than they trade on sim. But I'm kind of going through some of the dangers and the problems that come from this. One experience, I'm going to relate 3 experiences that I've seen where trading and sim trading are concerned. Uh, my brother decided he wanted to be a trader a number of years ago, and he had seen my trading, see what I was doing with it, saw the money I was making with it. He saw me sell my business and work in my pajamas, and that sounded pretty good. So he got a sim account and he wanted to trade Forex just because of his schedule and set up $100,000 account, sim account. And he was taking 50, 100 lot trades where, you're talking, like 100 lot trade, you're talking $1,000 a tick. And he would be up or down $50,000, $75,000, and over the course of 3 months that he sat there sim trading, he had blown out 3 or 4 of these $100,000 accounts, gambling and playing games with it. And he didn't want to take a stop. He didn't want a losing trade, and he was trying to make himself believe it was real. He gets finally to the point where he starts making a little bit of money on sim a little bit consistently, and he figures that it's time to go ahead and put an account out there. So he opens an account, just a mini account. And if anybody's ever traded Forex on a mini account, if you do 1 lot of the euro US dollar, it's $1 a tick, or as we would say in the Forex world, it's a pip, a price increment point. Same thing as a tick, essentially. The spread was two ticks, 2 pips. So when he initiated his first trade, instantly the trade was $2 against him. Well, he had been throwing around positions where he was doing, $1,000 a tick, and it never bothered him. And he had convinced himself that that felt real to him, and he viewed it just as seriously as real money. So I get a phone call from him, and he says, "Dude, I took my first live trade, and I'm in trouble." He's like, "I don't know what to do. I feel like I should just close it out." And I said, "Well, what's going on?" And he says, "Well, I don't know what's going on. This thing is down. It's down $7." And it's, anybody that's ever watched the 6E
on futures or watch the euro US dollar, um, you think about your spread, you're down $2 because of the spread, and it's only moved 5 ticks from where his entry was. And he's down $7 and he's crapping his pants. Now I kind of look at that and I have to say it was one of the most foolish things I've ever heard, because I knew his financial situation. His house is paid for, his cars are paid for. He's got a very, very good income, no money pressure whatsoever. He's down $7 and he's freaking out, calling me on the cell phone, trying to figure out whether he should just bail out and close it because he can't decide what's wrong. So, I looked at that and I thought, the bizarre thing is that we can sit there and convince ourselves that that sim is beneficial, and yet it's actually setting us up to deal with dangerous emotions and panic and potential failure down the road. And I told him, I said, if you saw a $20 bill blow by on the street, you wouldn't run to chase it. I know him. I know he wouldn't walk across the street to do it. And yet $7 and he's messing his britches. So I see that type of reaction, and I've watched many traders when they tried to go from sim to live, and they absolutely could not do it, and they're right back on sim. They get a loss, they're right back on sim. They sit there, they hesitate on 4 or 5 trades, they go right back to sim. Um, they'll get ready, they're working themselves up for this, they're deciding that they're going to go ahead, they're going to take this live, and they hesitate 4 or 5 more trades, they go right back on sim and trade sim another week. And ultimately, I would say that there's something that happens here. We frequently see traders that are pushed into this market that should not be in this market. And what I mean by that, when you look at the pattern day trader rules, if a guy was going to go in and trade 100 shares of a $5 stock, which would be relatively safe, worst case, you risk 500 bucks. That's what you lost. They tell you you can't do that. As a day trader, you can't trade in and out of that stock as a day trader unless you've got 25 grand in your account. If you do that, 4 times in 1 week, where you trade in and out once a day, 4 times at some point during a week, they freeze your account and you can't initiate any new trades. And yet they'll let us take that same $500 and come in here on a futures contract, and if you punch in today's price on the S&P, you multiply that, uh, that value where it is at 1185, you're talking $60,000 contract. They'll let us take a $60,000 position with our 500 bucks, but they won't let us take a $500 position with our 500 bucks. So we get into a position that is dangerous, and in the back of our minds, we know it's dangerous, and it makes it very difficult to keep going back to it and pulling the trigger, and it can take money from us too fast. So I don't know if anyone has experienced anything like that when they've tried to go from sim back to live, that it can be very difficult to do. The the other story that I want to relate, and I'm going to relate a third story to show you some of the danger in not sim trading or not trading correctly according to size. But I'm going to talk first of all about a second event, and a couple of you guys have heard me talk about it and laugh about it in the room, and we joke around about the sim lunch because of this guy. And he's a buddy of mine. I talk to him all the time. I tease him about it all the time, but he decided he wanted to be a trader, opened up his sim account. I worked with him online, and I did it kind of as a begrudging favor. Didn't want to do it. The guy was just extremely hyper, and I felt he was going to be a gambler, and so he got his sim account there, and so each morning I would talk with him about it and explain things, and I explained the platform to him and got him all comfortable with how to place an order, and he's all ready to go. And this guy, if you could look up the word tight in a dictionary, his picture would be right next to it. He had money, actually had a lot of money, and everything he owned was paid for free and clear, no debts.
was in a solid financial position, but he literally they were so tight, and it was the reason they had money, is he would take $5 a month for spending on like pop or a hamburger or something of that sort, and his wife got $5 a month. So he comes in and he starts sim trading, and I had cautioned him about sim trading, and I said, you have to make it real. This is, the emotion that's going to be there. And he's like, oh, I'm scared to death. He's like, I'm scared to death even on sim. Well, he goes in there on the first day and he makes $600, just in his little morning of playing around on sim. And he gets so excited, he takes his wife down and buys her a steak lunch. And he's eating his steak lunch before he realizes that it wasn't real money. And he honestly thought he had made $600, and he was so excited he went down, bought a $40 lunch, and his whole allowance is gone, everything is blown. And he's sitting there going, "You got to be kidding me. What do I do?" Again, I think what it illustrates is that essentially when we're sim trading, we are so out of touch with reality that it's how can it possibly do us good? And so we laugh about him in the room about our sim lunch, that we can go buy if we did something on sim. You can get your sim lunch, and I tease him about it all the time. Now, that being said, I'm going to jump forward here a couple slides and and make a statement, and then I'm going to explain why I also say this. For each person that comes into trading, we know, we're told up front that we have to have risk capital. And that money that we're putting into the market, it should be something that is sized or suited to our situation. Yeah, Brian says sim steak here, so that's we'll send sim steak out at Christmas for everybody, I guess. Maybe that's what we'll do. But anyways, we look at our situation, what I risk, what you risk, what the next guy risks. It's probably going to be different in every case based on our situation. The first time I ever worked with somebody and did a mentorship with somebody, I was trading, but I also owned a business. And I was out at a customer's home and I saw that he was trading. And so I struck up a conversation with him about trading, and I showed him a couple things. He was asking questions and he's been losing money. And I asked him, this was in late March of the year, and I asked him how the year was going for him, how he was doing. And he says, well, I'm down 380 grand so far this year. This is day trading. And he doesn't know how, but he's just trying to learn. And by March, he's already down $380,000. And I about messed my pants. That's uh, to me, 380,000, 400,000, 450. That's a good year for me. That's a good year of gains. And he's blown that out in 3 months just trying to learn. And I said, "Well, what's your end plan for this? What are you doing with this?" And he says, "Well," he says, "I figured I could give it a year, year and a half, and if it didn't work, it didn't work." And he had no problem with it. And I was astounded. But he had lost that much money and he was going in trying to learn trading 20s and 50s. Didn't make sense to him to try to make money with ones first, with one lots. He felt he needed to go straight to 20s and 50s, and he was getting his butt kicked. And yet, the ironic thing is he was risking an amount of capital that was appropriate to his situation. And he did have a solid plan with it. Is he realized he could lose 1.5 million and it wouldn't affect his life. And if he couldn't get it by that point, he wasn't going to be a trader. He would just allow his financial advisors to handle his money. So, I go back to our topic a moment ago. We've got regulations that say we can't trade a stock, a low price stock, and try to get a 15, 20 cent move during the course of a day.
because that's too dangerous. We can go into the futures market and trade whatever we want to trade, and that's a-okay. We take there's some of you guys are not in the US, and I don't know what the regulations are country by country. But for those of us that are in the US or in countries who regulate like the US, we have other things that we could trade, like CFDs, contract for difference. And a CFD, we could go open an account. And I shouldn't say we could because we can't. It is available to people, but it's not available to people in the United States. Technically, if we lived in Canada, we could go open an account with a firm in London, trading contracts for difference, CFDs, and we could trade, the S&P 500 chart. We could go trade that CFD at 1 pence a point. Essentially, we instead of risking 12.50 a tick, we could risk a few cents a tick, or we could size it anywhere we wanted in there, and we could go learn with an appropriate amount of capital on the line for our situation. But in its wisdom, the regulatory commissions say no, U.S. citizens cannot trade CFDs. So we start looking around the different instruments that are available to us. And for guys that are trading $4,000 or $5,000 of capital that are hoping to make a success trading, there really is nowhere to go. There's nothing that you can trade essentially that's safe. They'll let you go into the futures, let you go into the options, but you're pretty well stuck with something that is going to have you trading more size than your account should be able to withstand. So when I look at what they've done, and I ask the question, how can you break away from the sim accounts? I'm going to think just a minute for some of the dangers that I see with sim accounts, that the story's illustrated. Is you're out of touch with reality. It's comfortable, and so you can go in there and do it and do it and do it and do it, and you go back to the live account, and now you can't function, you can't do it, you can't deal with the pressure, you can't sit on the winning trade. You're up 2 3 ticks, and it goes back against you by 6 or 7, and it comes back 2 or 3 ticks positive, and it goes back 6 or 7 negative, and it comes back 1 or 2 ticks positive, and you kill the trade. You never do that on sim. So sim tends to give a guy a sense of confidence, but the confidence that he gains cannot carry through into the live trades necessarily. So a guy can come in very confident. They come back, the confidence has evaporated, and they're making bad decisions again right away. I do have one comment here on the CFDs. The the CFDs, and it depends on where you open. The comment is that CFDs won't let you go as low as 1 cent per point, and there are firms out there that will go a pence. There are ones that will let you go a pound a point. Some of the London firms. There are ones that will let you go just about as low as you want. And the spread betting, which is kind of that seemed to be something that really grew out of London. And there were actually some advantages to London-based traders because they don't have to pay taxes on it. The spread betting will let you go lower than that. But there are some firms out there that will let you cut that down considerably lower on the CFDs. And ironically, the U.S. says, well, that's too dangerous of an instrument, but CFDs are the most widely traded instrument in the world, more than any future, more than any stock, more than any option. Um, Very, very widely traded contract. Yeah, I was watching that. I'm at 39 minutes. I appreciate that, Gerardo. I'm gonna reset this here for just a minute. Now, what I'm gonna do, just in preparation for stuff a little bit later, um, I'm going to put up a poll, and the poll's going to be on trade management. And so I'm going to put that up, and I'm going to stop the recording and reset that real quick. Again, I will just mention that the polls are anonymous. Um, you can't see who voted what way. So just be honest with it. We'll kind of tailor the presentation to some of the responses here. Okay, so we got this back. I'll put the results up here. Let me close this out. Everybody's had a chance to pick an answer.
So as you look at this, you know what you voted, but you can kind of see that even rating your own management, it's obvious that things would be better if it was done differently. So so when you look at that, essentially with these numbers, one person essentially would feel that they've got not many flaws. There might have been two that selected that actually, but for everybody else in the room, there's definitely some room for improvement. So what do you guys think would be one of the most valuable things that you could do when it came to management? Would you agree that one of the most valuable things you could do for management? Let's see if the screen. Oh, it shut off the screen sharing. That this would be one of the most valuable things you could do. So we got people putting some comments in here. To let the profits run, to trade more products and scale out more, to be able to interpret the tape, to be able to follow the trading plan. And see, those are common things that blow most people apart. Just by the way, with the comment on interpreting the tape, I virtually never ever will manage an exit on the basis of the tape. Um, it is for the entry and the target. My profit is always going to come off the chart, and so we're going to spend a little bit of time on that. I will show you guys how I manage and what I think has been very successful for me. Um, everybody's temperament is different, and their emotional control is different. The guys that trade with me in the room, um, well, in fact, I've got a nice croupier stick from like a craps table for raking the money off the table from my buddy Ken, who's in the room, and he keeps telling me, take the money off the table, take the money off the table, and I'm going, no, it's not to my target yet, it's not there yet, it's not there yet. So as a kind gift and a joke, he got me a little croupier stick that sits on my desk now, for raking the money back off the table, raking the chips in. So I I look at that management as being something so critical, even though we're talking about tape reading in this primarily. um, to be a successful trader, to me, says we've got to spend a session talking about management, because that's where most people ultimately, even if they can get the entries pegged, they're still going to fail because of the management. So a couple of you, I think, have hit on what I feel is the key. um, we've got three comments out here about scaling out, try to get risk free, let the runner run. Another one that says let the runners go instead of just taking the profits. And I think you guys will see, if we get some live trading and start looking at things, that is a critical part of the trading, is being able to let those runners go and really make us some money. But for now, we'll get back to, in this poll, we're going to talk about the management, but I wanted to get an idea of where you guys were at. But let's get back to trying to find a way to get off of the sim and not allowing that to hurt us. And the way that I'm going to suggest doing that, I want to give fair disclosure here with it. Um, I guess I want to try to present a balanced and accurate view of what I'm going to suggest for you guys. And each of you guys are going to have to look at your own circumstances and decide if that's relevant to you. But I have found that the majority of people have accounts that are definitely not large enough to be trading futures. Um, I frequently turn down customers that contact me, and they've got a $5,000-6,000 account, and then they want to spend a couple $3,000 of their savings uh, for education, and then they tell me they've been unemployed for a couple years. Their unemployment is about to run out. Their wife's income won't pay the bills.
they can't find a job. And as sad as it is, I can't work with people like that. I don't feel that it's ethical. I don't feel that it's fair, because the chances, when you get all of this pressure, the chances of making it big are so slim. It's just stealing from somebody that can't afford to be stolen from. So to me, when I look at the conundrum that people are in, we've got an account that's too small, but it's the only market that we feel safe with, because it's regulated and because uh, there's a little bit of protection there for us, and we end up putting the money in there, and we're trading too big, which forces us onto the sim. It forces us into bad management and into bad decision making and so on. So I have suggested for a number of years to clients that they seriously consider looking at the Forex marketplace. And I'm going to try to give you just a balanced viewpoint of what Forex, presents in terms of dangers, but why it also can be very attractive. Uh, you guys may have opinions of Forex. In fact, if you don't mind, uh, just while I'm talking, throw out what you think of Forex, just a positive or negative. You don't have to make an extended comment. But a lot of people have heard so many stories about Forex that they're scared to even touch it. And I have found, ironically, there are many, many times the number of Forex traders that there are futures traders. But for some reason, a lot of us as futures traders hear this negative rap about Forex. So here's a couple of the problems with Forex, but then I want to take this to some of the advantages that Forex can give people if a person is really serious about building himself into a career trader. First of all, Forex is not a regulated market, and we've all heard that. And it is regulated in a degree now. They are starting to put some restrictions on it. First, they changed the capital reserve requirements for U.S. brokers. I have some changes that have affected many clients, and they're mad about it. That they came in and lowered the leverage from 400 to 1 to 50 to 1. And so, these changes, they are trying to rein it in because it has become so fraudulent. I have had a guy in Spain after me for 3 years trying to get me to back him in starting a forex brokerage. And his sales pitch to me is that you cannot lose. All you have to do is get customers, and you take the other side of the customer's orders and you take their entire account. And he has contacts with MetaTrader, and he has shown me documentation within MetaTrader from the back end side, from the broker side. There are over 60 settings in MetaTrader that a broker can set to take your account. He can do it fully automated. It's programmed into the platform. And he keeps using this to try to convince me to start a forex brokerage and take people's money. And unfortunately, there are enough unscrupulous people like this in the business that they will open up a firm simply because they know most people lose. They will take the other side of those trades. Those trades are never put into the broader market, into the interbank market. And the brokerage takes the other side, and you lose, and they own your account. And all they have to do is generate new customers. So there are some dangers to the Forex marketplace because of that. I have had accounts at around 30 different firms over the years. I have traded Forex for a number of years. Out of the 30 firms, I only found 2 of them that were ethical and honest. And here's what would happen when you started out trading. You're told when you start out trading that you're guaranteed what you see is what you get in terms of pricing. So if they're quoting you a one tick spread, they guarantee you that when you click, what price is there is the price you'll get. And there's a little asterisk there that says, except in unusual market conditions and fast moving markets. So you open the account and you start out trading, and every entry is an instant fill at your price. No slippage, no games, no messing around. Within a month's time, you cannot get them to fill an order. And what changes is they're tracking the account, and if they realize that you're a profitable trader, they turn off your auto execution. They will not take the other side of your trade, and most of them cannot even go into a tier 2 bank and offset your order. If they can, eventually they'll give you the fill, but if they can't, I've had brokers that requoted me for a solid hour. And by a requote, what I mean is they tell you up front, unless it's a news related thing, you'll get the fill where you click. Well, you click buy me at this price, and it pops up a message and says your order is being transmitted to the market. So you wait 20, 30, 40, 50, 60 seconds, and then it pops up and it says the price quote has changed since you clicked. The price is now at, and they give you a new price. Do you still wish to submit this order? So you say yes. 30, 40, 50, 60 seconds, it pops up and says, the price has moved since you submitted your order. The price currently is at such and such. Do you still want to submit this order? And I have done that on a couple of occasions just to see whether they would ever fill it. And I went over an hour and they would not fill the order. So it told me that broker doesn't even have a connection to a tier 2 bank. They're running a complete 100% bucket shop on the basis of a quote, and they're taking a quote, off of Reuters quote feed, and they'll make a quote for you. But if you're a successful trader, they will not fill your position. Period. And it would typically change within about 3 to 4 weeks, and all of a sudden you couldn't get a fill. And I have had that happen at every broker where I opened an account, with the exception of two of them, that within the month I could not get a fill. So they are sitting there taking a look at things and they're saying, this guy's successful. We will not take the other side of him. And we don't want to let him have a share of our other customers' money because we want that money. And he's typically right. So we're just not going to give him a fill until he leaves us. That he'll just get disgusted and leave. So you have situations like that arise, and you have to say that puts a bad taste in your mouth about the entire marketplace. Um, some other common things that forex brokers will do to you, disreputable brokers, is a practice called shading. And I'm going to mention I'm mentioning these things for a specific reason, because I really do believe in full fair disclosure, and I'm going to make a suggestion to you guys. I want you to consider it seriously in view of your own unique situation. I at least want to warn you of what's there, and I also want to show you the positive side. But the practice called shading, they will take a quote coming off the interbank, and this would be the rate that your largest banks trade amongst themselves with. And then the what are called the tier 2 banks, this would be banks that were a little smaller. They weren't these big monsters like Citibank and Chase and so forth. Um, the tier 2 banks will typically try to trade into one of the tier 1 banks. So you might get, like, your local bank. If you had to do a currency transaction, your local bank would be like a tier 2 bank, and they would go to someone who's agreed to handle their trades. They might go to UBS or Citibank, and they say, could you please provide us a quote? Well, UBS will look at the interbank quote, and then they will change the quote by a couple ticks, give that quote back to your bank and say, do you want to execute at that price? And that bank says yes. Well, the bucket shop will take that a step further, and they might move it by 10, 15, 18 ticks and give you a quote, because they know, worst case, if they have to offset into the market, they can do so and immediately put you back at an 18 tick disadvantage. So everybody provides their own quotes. There is no exchange. There's no price matching engine. You don't have tick data. You don't have a time in sales. You can't even get accurate volume data. because there is no place to get volume data. Each broker has its own book, its own volume, and it's not relevant to what the broader market or the interbank market is doing. And it doesn't matter whether the firm says they have a dealing desk or not, they all do. If they don't have a dealing desk staffed with people, they have an algorithm trading against you. It is there at every firm. They have to have a dealing desk because of the nature of the business. So it's either electronic or it's manual. So there are some dangers there. And where you see these horror stories and the bad things that happened, it is primarily coming from the fact that most of these brokers are complete disreputable crooks who went into business and their only goal was to take their customers' accounts. But that being said, I want to look at the flip side of things. If you do get a reputable firm, you have a market which is by far the largest daily dollar volume of any market. It's larger actually than all stock exchanges in the world put together in terms of dollar volume. So it definitely has liquidity, and it has liquidity 24 hours a day. And if you get with a good firm, um, your liquidity is there 365 days a year, 7 days a week, 24 hours a day. News events over the weekend don't hit you. Your stop will still be honored. You can still go $10 million a click on the weekend when everything else is closed. And you've got the ability in this marketplace to scale your size relative to your account. So I'm going to put the names of two firms out to you guys, and I'll leave it up to you guys, how far you want to go with this and what you do with this. For a large trader, the best firm out there is Dukas Copy. It's DUKASCOPY. And it is an ECN business model. So they do provide true quotes. They don't take the other side of the trades. There is a unique advantage that Dukas Copy offers large traders that you will not find, to my knowledge, in any other market, in any other firm. And what they will allow you to do is they have a process, what they call bank guarantee trading. And as an example, I have an account that is sitting in a very large New York bank in one of my corporation's names. I have a trading account at Dukas Copy that is in that corporation's name. I do not have a penny sitting with Dukas Copy. My money is in my account, in my name, in New York City. And Dukas Copy has the right to post funds into that if I make a profit, or they have a right to pull funds out if I lose. You will not find another situation like that, to my knowledge, as a retail trader anywhere. But to get that benefit, it has to be $250,000 minimum account size. So to me, when I've looked at the dangers of the Forex market, everybody heard of Refco. Refco went under. They basically took the customer accounts. They went to their bank and they said, we want to borrow X number, this many hundred millions of dollars. And for collateral, we're going to let you hold these accounts as collateral. And they took those accounts where all the customers' funds were aggregated together, and they said, you can hold those as collateral. And then when Refco lost the money that they borrowed and they couldn't make it good, the banks came in and they had the rights to your money, and you didn't have the rights to your money. Now, this can happen in the Forex world, and they tell us it can't happen in the futures world, but bottom line, it does happen in the futures world a lot more than people realize. But in the case of Refco, people only got back 35 cents on the dollar after roughly a 3-year legal battle. Well, everybody looks at that and says, man, it's dangerous. I can't deal with the chance of that happening. So if a person is a large trader, it's the only situation I'm aware of in the world where you can have the money in your account, in your name, in your bank, and yet you can still go trade that money in another institution who can't touch your funds other than to post or credit losses and and gains for the day. There's a couple dangers to that. They just recently started taking smaller traders. It was a $50,000 minimum account, and they didn't allow trading in small lot sizes. Their accounts, for my accounts, the smallest size that I can trade is $100,000 positions. The standard size is $250,000 positions. But they have been absolute, honest, ethical, straight up, and they've provided account protections that I cannot get anywhere in any market. The other firm is it's Owanda, and I don't know. I will show you the trading platform in a minute, and we'll talk about it then. But what I have found with them, with Owanda, their reputation in the industry was that they catered to small traders. And Awanda had a different business model many years ago, and this is where it can be of a lot of value to some of you guys that have smaller accounts. They would allow a guy to open an account years ago when everybody else in the industry was $100,000 lots only. They would allow you to open an account and put $5 in it if you wanted to, and you could trade $1 into a euro or $1 into a pound or into a yen and run your trade. And you couldn't make money, you couldn't lose money, you know, on that basis. It cannot move far enough to allow you to make money. But by the same token, it would allow you to place trades with real money where there was a measure of accountability. They limited the uh, the leverage on their accounts 50 to 1 when everybody was going 400 to 1, and they said that's not safe. And Awanda kind of got a reputation in the industry as being a goofy little place for small traders. And yet, about 3 years ago, when they put on the capital reserve requirements out of hundreds of U.S. Brokers, there were only 14 of them that were able to meet the $5 million requirement. And of those 14, only 2 of them would have been able to meet the $10 million requirement that they proposed. Here's what's interesting. At that point in time, Saxo Bank they had the greatest amount of cap reserves, $455 million of cap reserves, and Awanda had $287 million of cap reserves. And then you looked at the next largest, and they were like 8 million. So it is an extremely large firm, and I'm going to put the I've got a couple requests to put the name out here. And you guys hopefully will get that in a little chat message there. But the firm that I'm referring to right now, it was started by a gentleman named Olson, and it originally was called Olson and Associates, and so they took that O and A, but then they started pronouncing it Owanda. So for whatever goofy reason, they've got some little story on their site why they started pronouncing it that way. But it was Olson and Associates, and the other one was Dukas Copy. So you guys should have something in your chat there that shows you the name and the website. But here's where I think this can be beneficial to you as a trader. And I'm going to, if I can find my platform, I'm going to just put the platform up here, and I want to point something out to you guys. Get this all kind of resized. On the platform, they allow you to come in on your accounts, and you can create as many sub accounts as you want. And so just for the purposes of showing you this, I just created a sub account, a secondary account, and I transferred $50 from my primary account into it. And here's where I really do, there is a reason I'm going through these things with people, because for guys with smaller accounts, to succeed as a trader, you're going to have to be able to take a trade that is a good size trade relative to your account. So here's here's the setup that we've got with things. I transferred 50 bucks in here. Haven't taken any trades on it. Like I said, I just set up a secondary account for the purposes of doing this. And interestingly, for guys that are interested in hedging, they just took away the ability to hedge in the Forex market. All you have to do is just open another sub account, and you could take a long-term, uh, uh, short position in the euro US dollar, and you could open a sub account and take a short-term position in the US. You could have 15 different positions in the euro US dollar, and none of them will affect the other ones. You just open a sub account, put a little money in there, and take positions there. But here's where I think it can be beneficial. You could put 20 bucks in here, and if you put a $20 bill in here and you took trades on that basis, that it was real money, that $20 bill is going to do more towards making you a trader than 10 years of sim trading will. Because that $20 bill means something to you. You don't want to see it disappear. So you can come in and you can structure your account in such a way that when you go to place an order ticket, it will configure that order ticket for you. And I'm going to show you real quickly how you can do this. If I can find the window that it opened up. Here it is. I can come in for my trading purposes, and I can go to the euro, and I can set this up specifically for the euro, and I can say when I trade the euro, I want to trade 500 units. Now a unit would be, if I did 1 unit, that would be converting $1 into a euro, or converting 1 euro into a dollar, depending on which way I went. But I could set this to be a percentage of my account. I could set it to be a specific dollar value, or I could say units. So I'm going to just leave that units. I'm going to say my trade size is 500 units. I can say I want my default stop loss to be 50 pips, or I could come in and say I want my stop loss to be 2% of my net asset value, or in other words, the entire 50 bucks of the account, or whatever the value was if I had open positions. Um, and I can set my default take profit. I could make that 4% or 5% so that I put myself in automatic order that gave me a good risk reward. So for my purposes, just in setting this up, I'm going to say, I on the euro, uh, on a trade, I want a 40 pip stop and I want a 200 pip take profit. And then I'm going to just apply that, by saving. And I'm going to show you what happens when you go to place an order. I can do market orders, I can do limit orders, whatever I want to do. But I want to show you guys something. I put in that 40 tick stop. And we think about a 40 tick stop. If we were trading the S&P, um, when you think of what you're risking there on a trade, at $12.50 a tick, you take a 40 tick stop on the euro, on the 6E currency future. Not many people have an account large enough to take that type of a stop and say, yeah, I can risk $500-600 a trade. But if you look down at the bottom here, I can take a position where my stop is going to cost me $2. Now I look at that and say that's real money, but it's $2. It's not significant. It won't hurt my life. It won't affect me. Can't put my family out on the street, but by God, it can teach me to trade. It's real. It's relevant to me. If I lose that 20 bucks, I'm going to be mad. If I blow out a sim account, who cares? It's meaningless. And so when I look at the value that's here, I have to go back and say, okay, we open up a futures account and we have to put 2,500 or $3,000 in there at a minimum, and we're risking that entire 3,000 bucks, and it's very likely that we're going to lose it. We come into an account like this, we can put 50 bucks in there and we can say, you know what, Forex, they're totally crooks. It's a gruesome industry. Everybody takes advantage of it. There's no protection if the firm goes bankrupt. Guess what? I'm risking 20 bucks or 50 bucks. It doesn't matter. It's not like I'm blowing out my $3,000 account. If it goes bankrupt and I didn't get back but 20% of that in 2 years, who cares? But bottom line, it teaches me to trade with real money on the line. So I go back to what I said earlier. We can't imagine if we were trying to learn how to shoot a free throw and there was money on the line, we wouldn't imagine going out and taking an imaginary ball and throwing it at an imaginary hoop. We would want to do the real thing. And so for some individuals, one of the most successful things they can do is take an account like this and use this as they're learning how to trade. Now here's the problem, but I'm also going to point to the solution. We come into this market, and let me just close this. Oh, and by the way, just in case you're wondering, I'm going to change this to 1 unit. I'm going to change my stops to pips, and I'm going to put in here. I'm going to say that I would take a 1,000 tick loss. That 1,000 tick loss would only cost me 10 cents. So you can scale this infinitely to the point of stupidity. So um, for a guy that's just working with a couple $1,000, to put 100 in here and trade $100 of real money and actually be able to scale out at multiple price points. See, I could come in and I could put a 10 lot order, and I could put a reasonable stop for a swing trade, maybe 100 ticks, and that order is gonna risk me 10 cents, but I could take that 10 lot off in 10 different pieces. So we look at some of the comments that you guys made, uh, trying to get more contracts, trying to be able to scale out, trying to let runners go. See, here we have a market with a Wanda. It's open 365 days a year. They never close. So we can come in over the weekend, take a swing trade, doesn't matter. We could let it go for a week. It's irrelevant. It will hit. Now, I will say, could they go bust? And you have to say, yes, anybody could. Refco did. Refco was huge. Anybody could go bust in this market. But I personally have placed literally thousands of trades at a Wanda, and I have never once had a trade that I questioned and said, didn't happen. Something's wrong. They ripped me off. Every single order that I've had, every stop was hit at the price that I had in there. Never had one ran through. Every take profit was hit right where it sat. I've never been shaded. I've never been requoted. If I want to take this 10 lot here and I hit submit, you look at my price, it's giving me a quote, 48 uh, here. There's a little spread, there's no commission. So if I take this trade, you'll see this trade appear up in my window, and I'm going to just submit this trade and buy the euro right here, and here's my trade. And you can see my profit in US dollars. You can see, my long position is there. It's there instantly at the price that was there when I clicked it. My stop loss is in place. If I took this back out on the time frame a little bit, um, scale it around, you can see it's got my take profit order sitting up here. My stop loss is here. I can trade it off the chart. I can say, no, I only need to risk it to right there. The position is just instantly filled. I've got a slight negative profit because there is right about a 1 pip spread, but that's the cost of doing the business. The execution is good. The stability of the platform has been outstanding. Everything has worked for years, and it's a ugly, gimpy, basic little platform, but the thing works beautiful. And I could take this trade, I could shut it off, and the platform doesn't have to be on. The orders are on their server. Um, that goes down and hits my stop. It don't matter whether my computer's crashed or not. It's sitting on their server, and they just take me out of the position. Everything's fine. Nothing to worry about. But the thing that it allows the guy to do, again, is you can take something that's appropriate to your account size. So the downside to this, if I wanted to look at indicators, they're fairly basic. I don't even know how to add indicators. I don't use them. Oh, add study. You can see here in this list that they do have some basic indicators that you can put on. And it's not a fancy charting platform, but you notice that you can't get like a true volume. You can't get a time in sales. And so does that defeat everything that we're trying to do? Well, here's the thing I'm going to do is I'm going to take this as a 5-minute chart, And then I'm going to bring in a 5-minute chart. And let me just scale this around if you'll bear with me for one moment. Actually, let's do this. I'm going to reset the recording, and I'm going to get a couple things up here in the window. And then we'll go through this, and I will show you guys a way to do this while you're still, um, while you're still reading tape and still using your NinjaTrader platform. Let me get Brian's question first. How does it know how much cash you are putting up per trade? Um, when I go to place an order, let me just pull this order in here. I have it sized in units, and if you want to look at the actual position, and let me just drag this back down. I took a 10 unit position in the euro US dollar, and so the exposure tab will show me what that actually breaks down to. What that did to get me 10 units of the euro long, it meant I had to sell $14, convert that into euro to get 10 euro. So the US dollar value of that position, the short, was $14, and my long position is 14.05. So I don't know if that answers your question, but when you look at the cash per trade, you can size that a couple ways. You can come in here on your default settings, and you can tell it what you want it to be. Like, we look at the default order size. I could say US dollars, and I could say I want my default trade to be 10 US dollars. So I'm going to just apply that. Actually, let me put that on the euro. And they have so many currency pairs. They've got so many exotics. You can do whatever you want. But I'm setting this default order size will be $10, and then I'm going to go ahead and put this over here. And you notice, because on the forex market, this is trying to get me long on the euro. I said the US dollar position needs to be $10. So to do that, this is going to tell me that would be essentially buying 7 euro. So it's going to calculate that out for you. If you wanted to do that differently, if you said do me 1,000 units, that would get me 1,000 euros. So it would be at 1,400 US dollars to get that position. I've got 50 to 1 margin. So technically this tells me I have available 1,769 units. If I put on full size on this thing, my 40-point stop is going to cost me $7. But it's allowing me to take a position somewhere around $2,400 US with my little $50 account. You can do that manually, Brian, or you can, it's just part of the forex market and you get used to it. But let me reset the recording, and I'm going to pull in a 6E chart, and I'm going to adjust this chart just a little bit so that it's a little easier to see, and then we'll explain how this could work to your benefit. Even if you still trade the S&P, even if you're still trading the NQ, when you go back to Sim, instead of going back to Sim, you can go over to the 6E. And when you go to the 6E, you can chart that. You can use the 6E time and sales, the 6E volume, uh, and you come in here and take your position on the spot market. So let me get that set up. I'll be back in about 2 minutes. And in fact, actually, let's just do this. Let's just take 5 minutes if that's okay, and we'll go through this, and then we'll hit some of these other topics real quick. Let's just say, well, what time is it? Let's just say 25 after. We'll be back in here at 25 after. Okay, so we're back here and fighting the platform. You guys should be able to see the screen, I think, okay. What I've got on here is I've got a 6E chart of the December contract, and then the euro US dollar does not expire on on the spot forex market, which is a slightly different animal, but it doesn't expire. Long story short, it's nothing magic there. It's fairly simple to figure out. But I essentially have got uh, my little charts there side by side, and when you look at them, you can tell there's slight differences in the price that it trades at, but essentially it is the same chart pattern. If I get that over here where they're roughly spread out the same, you can tell that they essentially follow pretty much tick for tick what the other contract is doing. So you can come in here on this market and you can chart this, take advantage of everything that we have. For example, let's just come in here and put a, if I can find it, we'll put a couple indicators on here. Um, let's just come in and we'll put the volume. Now all of a sudden, where we don't have that volume on the euro US dollar, we can come in and we can see the volume picking up. And it's interesting because it reveals some information that most Forex traders may not be aware of. You can see the volume spike here on the futures, and it left a big topping tail, indicative of sellers coming in. We see the same exact thing on the spot market. If we saw that trade setup, price action setup, high volume spike showing some evidence of sellers coming in, break off below the slow, we could see that on here and say, boy, I need to go short. And all I have to do is reach over here and say market sell. And this, unfortunately, it pops it back up on my main monitor. Here's my market sell order, stop loss is in, take profit is in, click submit, and I'm in the position. If I want to add tape to this, I come in here, bring in my tape on the 6E, and now I can sit here and read tape on this, and I can see what's happening in this market. And again, I can just come right back in and execute over here on the spot. But the reason that I mention this is you can take a little account. It takes about 48 hours to get your account open and funded, typically with Oanda. And you can open up this little account and you can kiss sim trading goodbye and start putting on trades that matter to you and that force you to use good money management rules. And I have to say, the traders that have done this, that I've worked with, typically are the traders that have become successful. It'll be the first time in your life, if you do this, it'll be the first time where you can ever put on a real trade that feels fairly comfortable because you can size it to fit your account. Yeah, you can still do gold and silver on Oanda, Brian. Um, you know, they have a number of different crosses, and they have made what I would say technically is a um, it is a CFD to me, but it's available to U.S. residents, so it says it's not a CFD. But here's silver, and if I wanted to come in and chart silver, I could put silver up on my on my chart and on my time and sales. And again, you're going to see the same thing when you look at the chart patterns. The chart is exactly the same. It's just going to mirror silver. A little bit more of a spread here, but again, I could take a trade, and let me just bring this in. This tells me that I have available 101 units of silver. So I could size this and say, well, I want 5 units. And I could put this for where I want my take profit. Let's say that I wanted to go short silver looking at this chart pattern. And in fact, I'll just put a little trade on. Let's say that I wanted to take a target down here at 24. I don't know if you can, actually, let me just get this out of the way. Let's just say this. Let's say I want to go short and I want to take a profit down here into this prior low. So I'm going to take my take profit order and I'm going to just put this to 24. I'm going to take my stop loss and say, if it goes off over this high, that's good enough. So 24, 54, 70. It breaks down into smaller increments. I look at my trade down here and it says if I need to be on the sell side. Sorry. Pay attention next time. Do this again. Take profit 24. Stop loss 24, 54, 70. I look down here and it says if I hit my stop loss, it's going to cost me 79 cents. If I hit my take profit, it's going to cost me $1.97. So I can see that before I place the trade. I can figure those parameters right in, put the stop where I need it to be, or I can auto configure it. And I'll just submit the trade. Who cares? We'll just play with it. I look at that and say, boy, that might be a little close because of the spread. So I may want to give this, just a few ticks because of the spread, and put the stop up here. I've got my stop there. My position is the blue line. I've got my take profit there, and I can just shut it down and let the thing go. If it works, it works. The microcurrency futures, Kevin, you're asking, would the microcurrency futures be the same thing? Microcurrency, what the industry refers to as a micro lot, is a $1,000 lot. Initially, a standard lot for most firms was 100 grand, and then a mini lot was 10 grand, and then the micro lot was 1,000. So on the euro, a micro lot would be 10 cents a tick, and I could literally get this down uh, 1,000 times that small. The other markets that they do, Peter, when it comes to, uh, I guess they don't do energies. They do have gold and silver, which would be the only metals. They don't do the S&P. They don't do indices. They don't do anything of that nature. It's all currencies except for the gold and silver. They um, have for currency pairs, if you want to look at an exhaustive list, let me just get a quote list here. And I'll pull that in. For the currency pairs that are available, there's a million pairs in here. I don't even know how many they have, 60, 70 different currency pairs. And, so all of these would be Australian dollar versus something. All of these are the Canadian versus something, Swiss franc versus something. This is the euro versus other currencies. GBP is the pound versus other currencies. We'll scroll on down here. We've got the New Zealand dollar versus other currencies. TRY, that's the Turkey, the lira versus the yen. And then all of this stuff, USD, is US dollar versus something else. And then ZAR, that would be the rand, South African rand against the Japanese yen. So they have the ability to take just about any currency pair into any other currency, or any currency into any other commonly traded currency, more than most firms have. Most of them, there, I wouldn't trade them. There's not a whole lot of point to them. Your majors are the ones that you can get. You can get time and sales, and you can get volume off of the 6E or the 6B or the 6J. So, yeah, Sean, you say you're guessing that all currency pairs would mimic the corresponding currency futures on NinjaTrader. When you look at NinjaTrader, with what's available as far as a currency future, and by the way, there's some of the firms set up where you could use Ninja to trade the currency, but you lose the scalability, and it's with firms that are definitely not reputable in the way they treat their customers. But with these currency pairs, you think of what you have on the instrument manager. And I'm gonna just bring that in real quickly here so you guys can see where it's at. When you open up your instrument manager in NinjaTrader, you're going to have a series of contracts that start with the numeral 6, and they will typically come up right at the beginning. And so you've got the 6A, which is the Aussie dollar, 6B is the pound, 6C is Canadian, 6E is the euro, 6J is the yen, 6M is the Mexican peso, 6S is the franc. If you look at those, the 6E has the most volume by far. The 6B is going to have the second most volume, the pound, and that would correlate directly back to the pound US dollar on your spot platform. And then you're going to have the 6J, which is the Japanese yen, which would go back and correlate to your US dollar Japanese yen. The other contracts, to my way of thinking, that are available on currency futures do not really have enough volume to be worth tracking them and using that tape to make the decisions for the other market. And the other factor that you're going to look at on a currency platform is the spread. And the euro US dollar, 40% of all transactions that occur in currency on any given day, 40% of it goes off on the euro US dollar. So you're talking 1.6 trillion dollars worth of transactions going back and forth, either euro into dollar or dollar into euro. $1.6 trillion a day. As a result of that, the 6E has a very, very tight spread, which means you take less than one tick to get to a break even state on that. So while they will mimic the currency futures, the other currency futures, to my way of thinking, don't have enough volume to justify doing that. No, if you're going to do gold and silver, because the gold and silver is not a currency trade, that would be metals. Uh, so I'm sorry, I was addressing your question specifically about currency futures. But if you were going to do gold and silver, yeah, you would still be able to go in there, look at your NinjaTrader charts, your NinjaTrader time and sales. When you look at where these are, and let me just get rid of this stuff. When you look at where these are in terms of a quote, I don't know if I can turn off my position, show average position. Um, the quote is 2440, and then they will break that down uh, even less than what because when you trade on the SI contract, the silver contract, the futures contract, that trades in half cent increments. And you can see this goes out actually 5 decimal points. So you would read this as $24 like where it's sitting right now. You would read this as $24. Sorry, my cursor's in the way, trying to keep everything out of the way. $24.39. And if you look over here at the SI at the futures contract, it's $24.38 and a half by $24.39. So they're trading essentially at exactly the same price. The chart pattern's the same. The volume, we've got the ability to put the volume on here and look for volume spikes and so forth. But essentially it's going to give you pretty much exactly the same picture on it. So not a lot of volume on silver. You can trade it. Uh, Ironically, I do trade silver a fair amount, and for the most part, I will not trade the silver future contract. It is a very, very violent contract, and I've seen spikes, buck and a quarter spikes, where someone will come in and throw a 500 lot market order, and it'll move it a buck in the middle of the night and stop everybody out, and you wake up and all you have is a tail sitting there. So same thing goes for gold. Gold can be pretty dangerous to trade on the futures market. If you're trying to short gold near a high of day or buy gold near the low of day, be careful because it can go 4 or 5 points on a 2 second spike and be right back. So you can definitely get hurt on those big contracts. Ironically, it doesn't happen in here on this contract. When gold spikes on futures, it doesn't spike here. So it's just something that I want to put out there for you guys. Give it a little bit of consideration. I didn't intend to go on this long about it. I've already taken up most of our time this morning with this. If you guys have any questions about it, please throw your questions out there. And if it's questions about Forex trading as a separate deal, I will deal with those questions at a different time. But if you guys have questions about the Forex marketplace, email those to me. And I don't mind making a little brief video here over the next couple weeks, and I'll just put that up for everybody that has questions about it. But I look at it, like I say, it is a way that we can come in there and successfully trade real money without putting ourselves at tremendous risk. Worst case scenario, um, you put $50 in there and you trade real money on it, then you get ripped off for the $50 by the broker. So as long as you're careful about who it is and the way they treat you, um, it can work out pretty good. The only thing that I would say about a Wanda, and most complaints about Forex firms actually stem from their practices around news releases. And all brokers will widen their spreads around news releases because they were getting destroyed by news traders. And so when a big news release pops, a Wanda will not fill you for about 20 seconds, and they will widen the spread from 9 tenths of a tick. They will widen that out to 10 ticks, and then it will come right back together and trade just like normal. So for your trades that you're taking off a 5 minute chart, stuff like that, just don't be initiating positions right into the news. These are markets that tend to trend very well, and because they trend very well, it is related or suited well for those kind of strategies. And you know, you get a news release that moves the S&P 6-7 points. Very common for that same release to move the you know, the euro you know, a good 100 ticks. So it definitely can move them around and make some money off of it. Like I said, I've taken thousands of trades off of my Awanda account, and I cannot point to a single trade um, over those 7 years. Cannot point to a single trade where they gypped me, ripped me off, slid me, requoted me. Just filled and done. Very, very fair firm, and they felt that from the very beginning was be fair to the customers, and you'll always have customers. So, any questions about that? Throw a quick yes out there. Otherwise, I'm going to shut these platforms off, and if I don't see something here in the next 30 seconds, then we'll keep going on something else. Okay, so I'm going to close this out and close this out. Um, the other things that I wanted to do today, we're going to talk a little bit about you know, the things that we can try to do as a proxy for the tape. You know what? And actually, maybe this, because we're kind of getting to the point. We've only got about 15 minutes left. Maybe we can take a couple of these things and go through them tomorrow, because I know the sessions we've been running over 15, 20 minutes, 25 minutes each day, and for some of the guys that are overseas, it ends up getting pretty late um, for them. I was trying to think if there's something. Let's just do this. We'll take the you know, trying to determine the relevant size on the time and sales. Let's look at this, and I'm going to just put up a couple time and sales windows. And I don't know if somebody has a specific market that they want to look at, that they're really interested in, or if not, I'm going to just pick a couple things. 6E, 6E, okay. Here's what I'm going to do. I've got an unfiltered time and sales, and I've got a filtered time and sales. And if you guys have the ability to put your time and sales up, I would put it up. Um, Look at your own. I don't want to get this lagging too much, but it would be pretty easy for me to get lagging 8-9 seconds. I'm going to take my filter and I'm going to shut that filter down, and I'm going to filter out the one lots. I'm just going to set this at 2s, and that will give us a little more time. If the tape gets going too fast, it's going to slow down and I won't be able to do this. So I'm going to just, the time and sales on the right, we'll start putting some numbers out there. Um, those numbers are going to be, you know, one lot are gone, so it's just 2 lots or bigger. And here's what we've got. This is showing 55 lines here. And so we've got the screen where it sits right now. We've got the 4033 print at the top. And we'll just let that 43 clear off. But we can say right now, out of 55 prints, when we scan down that list, we've got an 8-lot, and that was the biggest print there. The 8-lot's gone. We've got a 10-lot there. That's the biggest print. And you'll probably see this a tad bit delayed. 50's gone, an 8-lot. 50's gone, an 8-lot. 50's gone. We've got an 8-lot. Somebody's trading 8-lots today. 50's gone. The 7 is the big. So we've looked at a couple hundred prints here. Here's another 50 showing 2-lot is the biggest print. Can you guys see this okay on your end? Or you've got your own up? It looks like from what I can tell, it looks like I'm running about 3 to 4 seconds behind. We've got another 50 visible there. Largest one I see is a 3. Another 50. Largest one I see is a 4. So here's what we're going to look at. It's pretty consistent out of every 50 prints. 6 or 7 or 8 is about as big as it gets. We look down the right-hand column, we don't have a single double-digit print out of 50 filtered prints. I'm determining the 50, Brian, because I've got 55 lines tall on my time and sales. So if I look at, like right now, where the 4036s are up at the top and I've got 5 1 lots, when those are gone and they disappear off the screen, when I glance at that screen, I've got 55 lines. So I'm just rounding it and saying, okay, out of 50 prints there, the largest one visible right now is a 6. See, I'm just letting it clear and scroll down. Here's a 9 lot that's the biggest visible on there. So if that's the case, could I watch this for just a couple minutes like that and say what's relevant on that market? Well, this would show you what's relevant through the doldrums, the early afternoon. And if we come in there in the morning, there might be some bigger prints. So we can file that away and say, so far we still have only had one double digit print on this. We had one 10 lot that went by out of all the ticks that passed. So now we go to step 2 of this. What do we see for bots? And let me rephrase that. What do we see that looks like bots? See, there's a 24. That's 2.5 times bigger than the biggest print we've had. But what do we see that looks like bots that would be the way the exchange is processing the orders? And this would be for stuff that just drops into place. See, we could still say there's big trades there, because we've got a series of prints that are dropping in all at the same exact time. Like I'm going to just freeze this here with my screen draw. But if you look at this section here that starts at the top and runs down to here, every one of those trades had the same timestamp. All of it dropped into place simultaneously. So we look at that and say this was a market order 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 orders, 16 lots that all dropped into place simultaneously at the same stamp. Very likely that was a 16 lot market order, and it was all ones in the queue with the exception of that 1 2 lot. So does that make sense? We can see there's some market orders going on there that are still sizable, but for the bigger executions, if we were trying to filter it out for the bigger executions, we have to say there's really not that many. So to me, if I look at an instrument like that, I would say the 20 and 30 lot guys, those are going to be significant traders. Whether it was 20 or 30, or whether it was one print at 20 or 30. So I could look at that and I could start tracking this and saying on any given flurry that just drops into place, what kind of size do we have? I'm seeing these flurries like all the 38s that come through with an 01 timestamp. Let me just freeze it again. Sorry, I forget that this is coming in and you guys aren't seeing it for a few seconds. Again, we have the same thing happening here where all of these come in with the same timestamp, all at the same price. Again, we look at it, can we do just a quick estimate? If we know we got 55 rows, we're just shy of half, could we confidently say there's probably 25 lots there? We could count them up 1, 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So I look at that, just the size it was, my guess was 25, there's 22. So when we look at that type of behavior, we can then start to say what would be indicative of a larger trader. We get half a screen that drops into view all simultaneously. That was probably a large market order. The reason those will be the same color, I've got a question from Pete. It says, is the coloring right on that current screen? You have the 4038s green and red all at the same time. Uh, there were some of those, but that's the difference. Remember, we were talking about the bid and the ask colors, the bid and the offer. So remember, the bids were red, and then when we immediately get green at the same price, that tells you that that price moved as far as where the inside bid and the ask was, they're moving. Does that make sense? The best bid ask price ticked up or ticks down, and so they can come in with the same timestamp. Could have been part of the same order. It could have moved price up one tick, because those were not any longer at the bid. The question, when they all come in with the same timestamp, is that a bot? Karen, that is the behavior that looks like a bot, but because um, there are essentially in that queue that's waiting to be filled there, the majority of them are 1 and 2 lot guys. And so if a 15 lot comes in, it may take 15 1 lot prints to show on our tape. A year ago, you would say, yes, that was a bot. Now, when you look at it, you just say that's the way they're now presenting it. They're not showing it any longer on the basis of being a 15 lot order. They're showing it on the basis of being uh, how many executions did it take to fill that 15 lot order. Pete, when you asked, do you think that really happens where price moves up a tick and back down? It happens very frequently. In fact, let's just put a dome in here, and again, it's not going to transfer instantly. If I can get my dome. I've got so many windows from this GoToWebinar thing, I can't even drag stuff in and out. I don't know what's going on. Don't want to let me drag it in at all now. Huh. Try another one. Oh, I've got my screen draw on. I'm trying to figure out what's going on, why it wouldn't let me drag the the dome into view, and it's because the screen draw had the whole thing froze up. If you get your dome up, Pete, and watch that move, if somebody comes in and puts, let's just freeze this so we can talk about the current number. Let's just assume that somebody comes in and places a 30 lot order, and they take that order, down here it's 30 lots, and let's say that they come click into this spot right here. Now, for anybody that's using Ninja, what you realize that's going to do is that's going to place a limit order which will instantly execute off at 36. If you put a 20 lot order there, that will instantly clear out this 14, and it will leave your remaining orders sitting here as a new offer. So what happens then if instantly the guy here says, no, I'm gonna put more at 36? He can come back in and instantly hit the remaining portion of your order, and you see that where it drops and it went offer and then just immediately was lost and went back bid. And so we go flash flash and the color changes on the time and sales. It goes red prints, green prints, right back to red prints. So that was what I was talking about with the drills, is as you watch those prints change, where you've got the same prints at a price. Like we see green prints. Remember what green represents in our time and sales? We get a green print. Let somebody throw an answer out there. Right, Brian. Green print is the offer, the bid. Remember, the green print, that is a market order that came over here and hit the offer. Remember, the green has 5 letters, offer has 5 letters. The bid and red, they both end in a D. I don't know, whatever you want to do, 3 letters. So we see a green print over here at 37. We see a red print here at 37. So we think about what that represents. If the red print at 37 here at this price, let me clear off the arrow there. We've got a red print here at 37. The red print would indicate to us then that the bid was sitting right here. Somebody sold at the market to 37. And then we've got the next print is green at the same price. That would indicate that this was now the offer. Does that make sense as you look at this here on our tape? We had a red print go off at 37. That means that was a market seller that hit the bid over here at 37. And then the very next print is green 37. So if a green 37, green means a market buyer, and a market buyer came back across and hit 37, and that's what resulted in the green print. So we see red 37 turn to green 37, we know price just ticked down. We see, the opposite of that. We see a green 37 turn to red 37. That tells us that price just ticked up. That's part of that, like with those drills, if you can get your time and sales right there by your dome, and you start kind of drilling that, watching that in your mind, you'll understand where the market is moving and whether they're able to hold levels and what they're doing with those levels, um, without necessarily seeing that on a chart or seeing that on your dome. Now, just one thing I will mention as a proxy for this, if you have trouble keeping track of that, again, it's beneficial to have those time and sales close, get them up snugged up on each side of your dome. And if you have to watch it flipper back and forth here in the middle, where, because you've got this green, which is your last, and green, your gray, which is your last print, you can watch that flicker back and forth as to where the bid and the offer moves. You've got your momentum running down the sides, where you can still see on the sides that momentum change. I don't know if I've got all the questions there. Let me read back through and make sure. Yeah, I don't see anything there as far as unanswered questions. Did that make sense to everybody, or do I need to go through that again? If anybody wants me to go through it again, okay. Somebody asked if I can go through it again. Let's do this. Let's turn it off, and I'll turn the screen draw back on, and let's look at the prints that are sitting here right now. Let's just go back to this flurry, starting right in here, and we're going to look at this little section of our tape. We had prints, and this is at a 17-second timestamp. We had prints that came in green, red, green, and these prints came in with the same timestamp. Okay, so let's analyze this again with what this meant. The green print at 37 back here, what did that indicate to us? We see a green print that was a market buyer, and the market buyer had to come over here, and he hit 37. Okay, next print we see a red print at 37. So we think about the red print, that means that somebody hit the bid, right? It was a seller who came in and hit the bid. So that tells us now that seller came in, he hit this price immediately at the same time as this one here printed on the opposite side. So again, what does that tell us about the price? What did price do? Price lifted. We went green, red at the same price. That means price went up. And then we go back to green. Again, to go back to green, that means if we think about where the offer was for a market buyer to come hit the offer, that means the offer came back to 37. So if we were to reconstruct that little sequence right there, we would say, where the initial prints here, these initial 37s, at that moment in time, because that was the buyer coming in, the offer was at 37, and then it came up and the bid went to 37 on these red prints over here, and then it came back down again, and the offer moved back down into that spot. So if we were watching that on our time and sales at that point and understood it correctly, we could build that in our head and come back over here and say, what happened? We saw the bid go from 36 to 37 back to 36. And Pete, in thinking about the question you had asked earlier, you had asked about this some months back, or just, I guess, well, it's been a couple months ago, about seeing some differences in your TradeStation versus your Ninja. And in looking at that, and I've asked questions of a couple people that have both, they felt that their Ninja was running faster and more accurately than their TradeStation was. And remember, the criteria that we placed on this when it comes to coloring those prints was based on whether it went off at the bid or the ask. And they felt that they were updating more quickly where that bid and ask was, uh, on that basis, than what it was updating on their trade station. So I don't know if that's the explanation for that, but if you watch that happen, just take your dome. If you've got your 6E dome up, watch how frequently the bid will move up and then it drops again, moves up, drops again, and it just instantly it moves up, drops again. Uh, Gary, you ask, when you see what you're explaining, what would be your outlook on the market at that time as far as long or short? Um, that would not push me into a trade one way or the other. See, first of all, I would have to go back and look at where it was on a chart. What did the chart look like? Was it rallying up into resistance? If it was rallying up into resistance and I see them raise a level and immediately lose it, and they raise a level and immediately lose it, and they raise a level and immediately lose it, and this keeps happening, and they cannot hold that level, that's what I'm talking about when I say they can't go bid. In other words, they can't get the bid back up to this price. And they try and they try and they try. And every time they get the bid back up to this price, it immediately gets kicked back. It's an indication to me, one, I'm at resistance. That means I'm interested in a short. Now they cannot get that level to stick. They could get the bid there to 37, but they could not hold 37, and the sellers immediately knocked them back. So if I combine that fact with some selling coming in on the tape at 37s, and I see a big flurry of sellers coming in 36, 37s, then I would go ahead and look at that as the basis of a trade. Brian, your comment, the bid moved up and then down. That's confusing. You're thinking the red print at 40.37, so thinking market is going down, but actually it ticked up. See, remember, Brian, that those prints, when they just come in very quickly, back and forth, back and forth, back and forth, it it's trying to hold a level. Now, when we put a series of those prints there, and let's clarify this. Let me just get rid of all of this, and we'll freeze a new section. And this is, maybe this will explain it a little better. What I'm referring to specifically is tracking where the bid and the offer is. But we could also look at this, and we could start down here, and we could say we see this go 57s, and then and let me just draw the arrows this way because price is moving down. We go 59s to 58s to 57s to 56s, and then it goes back up. From 56s we get some 57s, we get some 57s selling, 57 selling, 56s. So when you see that sequence on the tape, where would you say the tape is actually going? Granted, it's jiggling back and forth, but we're talking about a market where on the dome at this moment in time, that inside market is only 5 lots. So if guys are coming in and they're placing 10 lot, 15 lot market orders, that can bang it around 2 or 3 ticks. But bottom line, the sequence of momentum at this moment on this visible tape that I've stalled, the sequence is primarily down. Even though they ticked it up a couple times in that sequence, overall it's down. They lost it from 59s down to 56s. So is that, let me look at it this way. Is that harder to track, the bid and offer, on an instrument like this or on an instrument like the ES? And I would say it's harder on the ES. You think about why that's harder. I'm sorry, it's harder on the 6E. But you think about why I would say it's harder here, is it changes, the bid and ask changes so quickly on instruments like the 6E and the crude, and it's just up, down, up, down, up, down, up, down. It just jumps and jumps and jumps and jumps. Back and forth, twitchy. So we might come into a market like this and say it's more important to have the sequence of trades, the flow of the trades, than it is just to say, did they tick the bid up? Did they tick the bid up 2, 3 times? Because it will jump around, it will move around. I mean, I look at it at any given point here. We're looking at all 5 levels combined. we're only talking 100 lots. We come over on the S&P and we look at the S&P and say, there's 2,000 there. They go back and forth, red, green, red, green, red, green, red, green, but it's all at the same price. The bid actually didn't move up. It's just the red prints and then the green prints and then the red prints and then the green prints. So price didn't necessarily move. The execution moved, but the bid ask spread didn't change. You come onto a thin one and you're going to see the actual bid ask spread ratchet up and down considerably more. Karen, your comment, I think spending more time on this kind of stuff would be helpful even on the YM. Uh, you mentioned you were watching some replay last night and it's still a bit confusing. And that's what I'm going to go through a bit more on the YM because um, to me, if a guy was going to trade just off the tape, it's easier to do it on one that ratchets up and down a little bit. But if we're doing it, with a chart, and that's why, one of the things that we're going to be discussing over the next couple days, uh, sitting here with this and saying, with the instrument that I like to trade, what method of tape reading do I need to use there? So, Gary, appreciate the comment, and we'll see you tomorrow. Have a great afternoon. So. We'll keep doing that. It is the nice feature with the replay. We can come in here and essentially freeze frame the market. It is kind of difficult with tape reading, and that's the thing I've never liked about tape reading from the standpoint of a mentorship or a live session with people is when I put it up and it's moving fast, you're going to be 6, 7 seconds behind. It will literally slow down my voice. It will slow down the entire transmission. So, sometimes we're going to have to freeze frame it and just break it down with what's visible right there. I don't know if this section may be a little confusing. Go back and watch it a couple times if you need to when I get the recording out tonight, and then see if it makes more sense as you watch it. Again, we're simply, we started out talking about where the bid ask was moving, and that's not necessarily the best thing to do for this instrument. We would be interested more in looking at the sequence of prints. Um, just for example, trading this on the basis of the tape, I see them lose 59s and they lose it back down to 56s. And we look at how long it took them to go from 59s to 56s. We start out clear down here at the bottom. I don't know if you guys can barely see that, but we were printing 59s at 05 and 4 seconds. And they went to 58s at the same time. We're still 05s at the very last bit of this. That's 15 seconds later. It took about 15 seconds to go from 59s to 56s. Now we might turn around if we're watching that continuous flow, and they may be right back at 59 in 2 seconds or 3 seconds. And so you watch that and say, it took them a while to get it down here, but they came back instantly. So now you watch them again and they push from 59, they push back to 56, and it takes them 25, 30 seconds to get back to 56. And then 3, 4 seconds is right back at 59s. What does that tell you just from a logical viewpoint? If it's taken you 15, 20 seconds to knock it down 3 ticks, but you can come back those 3 ticks in 3 seconds, what would be a logical conclusion if you're going to scalp this on the tape? You see this repeat half a dozen times. They try to knock it down, takes 15, 20, 30 seconds, takes 3, 4, 5 seconds to come back. And then the next time it goes down, maybe it takes 5, 10 seconds longer. And then it's 3, 4 seconds, it's back. Yeah, so we've got a couple good comments here. Brian says sellers are losing. Absolutely right. They're trying to knock it down, and it's a struggle to get it down. Karen says pay attention to those levels and watch for it to repeat. Well, we start watching that. If we're trading something that's $5 a tick, we're not going to do very well trying to get a tick out of the middle with our commissions. But if we're doing something that is where there's some tick value there as a scalper, we may be able to come in and get 2, 3 ticks, make $30 and out, make $30 and out, make $30 and out. Kevin, you're saying buy, and if that fits with your chart analysis, You're absolutely correct. You're coming into an area where you would expect some support, and they're trying to drive it down and they can't drive it down, and very quickly they come back. You may see this over the course of a minute or two and say, forget it, we get 56s, I'm going long. And I'm going to put a stop at 54s, 55s as a scalper, and see if we can get 60s. If they ram it back up, let's see if we can get 60s out of this thing. But when it indicates to us, we don't know subsequent to this how long it took to push back up, but we see that changing, and that momentum is definitely to the downside, and they're just in 15 seconds they've lost 3 levels, and we get a wiggle back up, and that wiggle is kind of slow coming back up, and they can't get it back up there real quickly, and we're against support, or excuse me, we're against resistance, and we close it. We've got just an immediate short trade in play. So, would that work out? Well, price ran right back down into the 40s. We've got our jumpiness going on. It must be some news there. You see that how the tape has accelerated. In fact, you guys probably aren't seeing it off of my display. It's being recorded there, but you can see the dome going crazy, and that's what I was thinking is we've got something there going on with it, and you could see it on the tape as soon as I unfroze it. It was like, huh, what's going on? I'm not looking at news this morning to see what's happening because I'm not trading. So yeah, that's what I've. Several of you got the comments there at the FOMC Fed. Yeah, it's kind of funny because it's we're talking about the tape and looking at the tape, and I unfreeze it, and I'm sitting here looking at it frozen up on my end, and that first screen flashes by at 1 second, and it was like something's going on. Got some news coming here. That's what I was talking about. Seeing that momentum and the pace of the tape, and very quickly being able to tell that something's changed in the market. We forgot a news release or some unexpected news came into the market, and but anyhow, well, let's do this. I'm going to get rid of the time and sales in the dome. And if anybody has questions, let's go ahead, throw those questions out. Just give me a quick yes if you have questions. We're gonna talk about this topic anymore. Ken, some people, Ken is asking why would anyone want to trade from the tape and not use charts? Uh, some scalpers are definitely interested in that. And it's not that they won't use a chart, but they may look at the chart and say, I think it's going down, and they don't want to watch the chart at all. They just want to trade off the tape and scalp from it. But I think probably the most common thing is there's a bit of a mystique about being able to read tape and trade from a chart. Takes away from that mystique. It's kind of like sometimes price action traders get all belligerent acting with somebody that uses uh, one moving average on their chart, and it's ludicrous. If you can make money with it and that moving average helps you make money, who cares? If I want to paint pink dots on my chart and it helps me make money, I'll paint pink dots on the chart. It's um, I do think though that sometimes people view a tape reader. You're not a tape reader if you still have a chart up. You have to go with no chart whatsoever. And to do that, you still have to have a number in your head. You still have to have a general indication of where the market is in its structure. So, uh, Sean, your comment, you see enormous activity on the 6E. That's what we've been talking about with the FOMC statement or FOMC meeting. Um, I already closed out my spot platform. It will be moving tick for tick. It's going to be a 10 tick spread. It's going to ratchet up and down very quickly, and then it'll come right back to a 9/10 of a tick and run. But the bad thing, I was kind of watching. I have a little tiny screen that's about I don't know what it is, 3 inches wide, 4 inches wide, and it lets me see what you guys are currently seeing. And for the most part, it's running about 1 second behind. If I change the slide, it's taking about 1 second before you guys see the slide change. But when I put up those 2 time and sales, I was running about 8 or 9 seconds was what it looked like to me when they were running fast. So it is kind of difficult to put that through. As far as all you guys that are here now, if is there anyone that does not have access to a time and sales at this point? Because we're gonna, especially next week as we get into some trading, um, I'm gonna tape mine, but it will actually slow my voice down where you start hearing me 7, 8 seconds after the fact, and it would be better not to be broadcasting those. So I just, if someone still does not have a time and sales in a dome, uh, please put it out here, and I will direct you to a couple brokers that can get you set up very quickly, um, so that you have a platform. So far, nobody has said that, so I'm assuming you all have that. Because when we go forward with this, um, it is going to be easier for you guys to have your own up and to be watching them and have my voice coming in a quarter of a second later, than it would be to have it up and have mine coming in jumping and blocky and flashing black, and it doesn't transmit real clean. I mean, you can see that if you've got your 6E open still. Um, if you take your 6E, set it up right next to this, you'll notice it is just sending you a snapshot like every second or two, or 5 or 6. So it doesn't broadcast real well. The recording will be clean, but it won't submit out to you guys very well. Tom, those are pretty simple to get them running. Did you get that version 7 demo set up yet, or okay? And do you know how to get your time and sales open? And I think I sent you a link to the little video on setting up. Okay. Shoot me an email if you run into any weird issues with it. I'll I think the videos that I sent you link to on the screencast, they explain pretty well how to do it, how to set it up. What are you guys seeing, if one of you has your 6E up off of my broadcast? Does it look like you're running considerably behind? Oh, really? Gerardo, I 1 or 2 seconds. I would, on my end, it looks like it's running 7 or 8. I mean, it's definitely not fluid. If you look at yours, and yours is not time compressed, mine, it's not going to be very fluid. Hey, Brian, if you're still here, would you mind checking on yours? Because I know you're on 7, and so you're going to be uncompressed. When I look at the snapshots that it's sending through to you guys, it looks like it's just sending still photos, and I'm clicking through a slide presentation really fast. It's not fluid at all. So appreciate the comment there. Any of you guys that need to go, we'll probably just a little bit of chit chat here. Appreciate the comments there. About a second. Oh wow, I didn't figure it would be pushing through. Is it pretty blocky looking compared to yours, Brian? A display interval of 0. That would be no time compression whatsoever when you do that on your properties. If it's a 0.25, that would be 250 milliseconds. Mine is 0. See, on mine, it's just screaming by. In fact, let me just do this. You guys won't see it. Oop, I can't even hold it there. It just disappears.
I was trying to put up the little window that lets you see what I see, as far as it shows me a little mini screen of what you guys are viewing, and it won't even let me put it up in that window that's broadcasting. I was going to try to just record it there so you guys could see what it looked like. If I hold it, I can hold it over here and make it happen. And then if you guys watch the tail end of the recording from today, you'll kind of see the difference between the way mine is screaming by and the little snapshot that you guys are getting. So just out of curiosity, if you guys want to know. Well, guys, I sure appreciate all the questions. For any of you, I still have I've got a couple trade setups that people have asked me to go through. But for any of you guys that indicated your willingness, I still only have a couple of them, and all we need is just a simple screenshot. We're going to go through some of that. Maybe Karen, are you going to be around on Friday? If you're going to be around on Friday, maybe we can go through yours on Friday. Huh, still 1 or 2 seconds, Gerardo. I mean, it's not going to be as smooth, but at least it's not delaying it for hours. Okay, so Karen, we'll go through yours on Friday, and then I don't know how to pronounce his name for sure. He had to just leave, but Abhijit, he sent me some stuff that he's been working on, and he's trying to get away from some indicators, and he wanted to go through some of his. So anybody else that wants to get those in, just a simple snapshot. You can do that right out of Ninja as well. If you're on your chart. I don't know if you guys are you guys aware of how to do that? Like if I wanted to get a snapshot of this here. You can come down in, just right click on your chart, and you go down to image, and then you go save as, and that will just take a screenshot of your chart. So if anybody that wants to ask, just get a simple screenshot of your chart, and I can let you just explain what you're kind of looking at, or what levels, whether it's high of day or low of day, or exactly what you're looking at. So, well, I'm going to stop. I'm going to stop here. I'm going to double check this to make sure we don't have any more questions out there. I've got my euro position is in a profit. I was up 40 ticks at one point. I was up 150 ticks on that spike, but the 40 ticks has only got me 3 cents of profit. So you can kind of see little teeny positions like that. Even if a guy put $10 in there, you can do a lot of back and forth and back and forth, without doing serious financial damage to yourself. To get a screenshot, a complete screen with more than one chart, Brian, there's a techsmith.com. They've got a product called Jing, and I'll send you a link to that. It lets you get a good screenshot. You can do a trial for Snagit. That lets you get a really good screenshot. You can actually get multiple monitors on that. But if you've got multiple charts, it may be easier to get multiple charts open, and just shoot each one individually and say, okay, I'm looking at this and this and this, and it might be a little cleaner if we get more than one picture and just cycle through a couple of them. So I must have stopped out on that spike. Yeah, I spiked out on that, stopped out on that trade on the silver. You can see it definitely took a big spike. Shot up, what, all the way to 24.90 on that release. Must have been some information on the release that nobody was expecting, because boy, it went one way and then the other, spiked fast. So anyways,
So what I get for opening a sub account, now I got a loser on there. So, well, I will quit there, and we will talk with you guys tomorrow. We'll cover the final couple topics that we didn't get to today. Anybody that has questions specifically on the Forex stuff, send me an email, and I will get you some more information there privately on that. But I do encourage people just to think about it, at least, even if you keep trading live on your futures account, use something like this instead of the sim. You'll still be able to come in there and do some live trades with real money, still practice your skills, still get a little emotion in it, and it will let you do it, where it's not going to hurt you financially. So, well, you guys have a great afternoon. I'm going to cut the recorder off here and cut the broadcast off here, and we'll see you tomorrow at 12 Eastern. Thanks for the comments too, guys. I appreciate it. Usually they come in so fast you can't respond personally to everybody there, so appreciate it, guys. We'll get a video out to you guys again this afternoon, and like I say, if you want to see kind of the little teeny shot that I show, it's kind of funny. It's like having a little miniature TV on a wristwatch. So we'll talk to you guys later.